provocative influencers, decision makers from the world of banking, financial services, the movers and shakers of policy industry coming here sharing their perspectives and outlook, which is subtly actionable, immensely provocative, and leaves you with a lot of residue and food for thought, which has the potential, the premise to shape the future of BFSI. Welcome to this exceedingly insightful summit called the BFSI Insight Summit, presented by Business Standard. Can we give it a huge round of applause, ladies and gentlemen? We had an action-packed day one, and we promised to bring you an action-packed day two as well. And to get started with really thought-provocative conversations, we have a set of most illustrious and eminent market experts who are going to be sharing their pragmatic outlook on this compelling stage. So to set the ball rolling and to set the context of all the speakers, I'd like to begin to call on stage Mr. Ramdev Agarwal, Chairman and Co-founder at Motilal Oswal Financial Services. So if you could please join us on the stage. And then we have Mr. Ridham Desai, Managing Director, Morgan Stanley India. You know, ladies and gentlemen, they say every time you clap, one of your gray hair is turning into black. It's just market experts, so yes. And then we also have the privilege of being here with us of Mr. Prashant Jain, who is founder and CIO at 3P Investment Managers. Thank you so much for joining us today, sir. And Mr. Andrew Holland, CEO, Avendus Capital Public Market Alternate Strategies with us. Welcome, sir. And to navigate this conversation and maneuver this dialogue, I'd like to call on stage Mr. A.K. Bhattacharya, Editorial Director at Business Standard. So with this context, let's set this dialogue going. Over to you, Mr. Bhattacharya.
Thank you, Ridhima. A very good morning to everybody here. I must confess at the start that this seating arrangement was not beyond my control. What I see is this on my right. There are two gentlemen who are known to be very bullish on the markets. On my left, not so bullish. So, but this allocation was completely coincidental. It is not at all my design. So let me start, Mr. Agrawal, with you. Everybody is worried about the state of the Indian markets, the global situation, the global headwinds, two wars going on at the same time, commodity prices not under control. There are issues at home, elections around the corner. In this kind of a situation, how do you maintain your bullish stance, and what are the pitfalls and what are the positive signs that you see, Mr. Agarwal?
Good morning to everybody. You see, you can keep on, there are always good factors, there are always bad factors.
Yeah.
Okay? So you counted all the bad ones, and the big one is, say, 30-35%, your own aggregates. Business Standard is one of the best newspapers to give you early in the morning the quarterly aggregates.
Yeah.
For this quarter, till date, your quarterly profit is up year on year by 32% for all the companies. Why don't you talk about that? Because that is the driver of the valuation of any market. If earnings are going to go up by, we also aggregate in Motilal Oswal, and there my own research analyst is saying that so far the results which have come, the earnings expected was about 26%, but actually what they delivered is 30%. So they're running, the earnings are running 3-4% higher, and this is a big change. What used to happen earlier, they used to start with 25% earnings expectation, and they used to end up at 12-13%. And Rhythm knows it better. So what I'm saying is that this is a very different cycle where earning upgrades are happening. In fact, analysts are so, disappointed in last 3-4 years that they're depressing the earnings call, and actual earnings are higher. So clearly, India is on the roll. Indian corporates are on the roll. There are challenges. In fact, the challenges, I don't count the ones which you are saying. Challenges could be FIs are selling, corporates are selling, promoters are selling. Those things can keep the market at a bay. IPOs are coming. So those are things which are to be seen, how far the market can be held back for some time. But basically, if you look at 5-10 years, I think we are going to double the index in next 5 years, and go 4 times in next 10 years. If you call this bullish, then that's where we stand.
Okay, we'll come to the challenges maybe at the second round, but just to, as a by way of, a supplementary, as they say in Indian Parliament, while the earnings are growing by 35%, as rightly pointed out, it appears every day in Business Standard's front pages, but the top line growth is actually fallen hugely to single digits. So is that something that you consider a worry point? Because top line growth of a single digit of 7 to 8%, which is fallen, compared, it used to be in double digits last year at the same time. So is that something that, we should worry about, where margins are probably rising, earnings are growing, but your top line income is, sales are not doing well?
Yeah. So there's a combination. That is important number. But what is happening is the commodity prices are deflating, logistic costs are deflating. So you are actually, you are doing very well. And margins which were depressed is coming back. So these are all cycles of change. But ultimately, markets are going to value the net profit growth. If current year net profit growth is 25%, and by chance, 2024-25, I don't have any view on that.
Yeah.
But if 24-25 also grows at 20-25%, it is not there in the price. Please believe me.
Okay. So you are essentially saying that productivity gains are huge, which is why the sharp difference between the top line and the bottom line.
Yeah, because commodity prices are getting deflated, and hence the unit prices of the products, say soaps and detergents and lot of stuff, they are coming down.
Okay.
So volume growth is better than the price growth, and hence the profits are much better. Last year the margins were very depressed. This year margins are somewhat better. So it's all combination. One has to look at company-wise. You can't make a statement that because sales growth is number-wise is looking a little lower, and hence it is bad.
Thank you very much, Mr. Agarwal, for this perspective. I think to start with, Mr. Desai, what are your takes on the overall markets? Are you bullish, as I had tried to paint you, or you are a little more nuanced?
No, I think, so good morning to everyone. It's great to have you here. So there are three things that I think underpin what is a structural bull market in India. India has made tremendous progress on macro stability. So just think about it. The Fed has increased interest rates at its fastest pace since 1980, and it has had no impact on India. Now, just go back 10 years. In 2013, in the middle of 2013, Ben Bernanke just said taper. He didn't even raise interest rates. He just said taper, and Indian stocks were down 20% in a month. This change that has happened with respect to how India is reacting to global interest rates is a consequence of the shift that has happened on what we call in macroeconomics as macro stability. What does that entail? It essentially means India's current account deficit is a lot lower than it used to be. We are importing a lot less saving from the rest of the world. In 2013, we were importing almost 6% of GDP. Today, we are importing just above 1%. And why has that happened? That's happened because there has been a seminal shift in India's terms of trade. So the oil intensity of GDP has gone down. Ramdev just talked about logistics. People don't realize that in 10 years, we have faster highways and we don't have toll nakas. That in itself has saved enormous quantities of fuel for India, because trucks used to line up for multiple hours waiting to cross state borders and were traveling on much slower highways, much to India's detriment in terms of oil consumption. The other thing that has happened is India's services exports have boomed. Just in the last 2.5 years, that number has doubled on a net basis. We were exporting $100 billion 3 years ago. Today we're exporting $200 billion. And that number, I think, is going to continue to rise. And even our manufactured export share of global goods export is rising. So there has been a shift in terms of trade. And the other thing that has happened is that the funding of this deficit has changed. Hitherto, it used to be foreign portfolio flows in the equity markets. Now it's FDI. And this means that we are a lot less sensitive to oil, because FPIs tend to be very sensitive to what the Fed does, what oil does, what US growth does. Actually, if you look at a chart, 30-year chart, Indian Sensex change versus US growth, every single US recession has produced a bear market in India. That correlation has broken down. So that's the first thing. Yeah. The second thing that underpins this bull market, and I think Ramdev has alluded to that, is that we are in a new profit cycle. And this is the cumulative effect of big changes that the government has made, not excluding the reduction in corporate tax rates, GST, the production-linked incentives, but an overall boost to corporate profits. So corporate profit share in GDP was at 2% in 2020, down from 7 in 2010, is now back to 4, and I think it's probably heading to 8 in the next 4 or 5 years. Now, if it doubles from 4 to 8, and nominal GDP growth just does 10%, that means profit growth in India could be compounding at 20% over the next 4 or 5 years. And as Ramdev said, that's not in the price. In fact, if you look at globally, it's the likelihood is that corporate profits are falling, not rising. And therefore, a lot of people struggle with Indian valuations, but Indian stocks are cheap when you consider the fact that India may actually be in this rising profit cycle. And the third thing that underpins this bull market is the domestic bid. It's not going away. This is similar to what happened in America between 1980 and 2000, when in 1980, President Reagan had allowed 401k plans to invest in stocks. In 2015, our Prime Minister allowed retirement funds to invest in stocks, and that set the stage for this change in household balance sheets. Even today, equities in household balance sheets are less than gold, and I don't think there's any reason for that to persist. We are in this likely 20, 30-year bull market. In the US, it ended with the NASDAQ bubble. We're nowhere close to bubble territory. In India, also it will end with a bubble. It will end very badly when it ends, but we are still far away from that moment. You did suggest that we'll come back to the risk factors later, so I'll preserve that for now.
Sure.
But this is what underpins what we are in a structural bull market. There will be corrections, like we just went through one, and they will keep coming. But I think every correction will be bid, and largely by domestic investors. I keep telling my trading desk, stop talking about foreign flows. They don't matter. Talk about domestic flows. Talk about the high net worth investors in India. Talk about people like Prashant. Okay, they are the ones who are the marginal price setters in India. India is no longer, the share price is not being set by foreigners. It's being set by domestic investors.
Okay, just one supplementary to you, Mr. Desai. You alluded to external sector being very safe and stable. But there are a lot of views on this which suggest that probably the external sector may be vulnerable given the fact that merchandise exports are not doing well, service exports may be doing well, but the manufacturing sector is in some way constrained by this rise of services sector vis-a-vis the merchandise exports because of the rupee problem. And you said FDI. FDI, actually, the latest data shows FDIs have fallen. Of course, globally it's falling. But what is your view on external sector?
Yeah. So we are going into the risk factors. I think the biggest risk for India is that the world looks very challenged.
Okay. So then I will come back to you later on this. Yeah, sure. Okay, Mr. Holland, your views on the market. Have you been rightly placed on this panel on my left, which is not so bullish, or would you like to correct yourself?
When you're asking me to pour cold water on with very bullish sentiments, I'm not about to do that because I think India is in a good spot going forward. But we can't run away from the headlines outside. It's very messy in the world. From higher bond yields in the US to oil prices to Gaza to all of these things which are going to, I think, impact the global economy. Whilst the interest rates have risen very quickly in the US, 500 basis points over the last kind of 8 to 9 months, the unintended consequences of that I still feel have to play out. We saw it with the regional banking sector in the US, but the commercial real estate, if that was to have any problems, which it's likely to do, then the Federal Reserve can't come in and save it. And that will have shocks around the world. So I think that's something that we have to take into account. Now, whilst India might fall less than the markets globally, we will be hit because sentiment, risk-off trade will come, and that will impact the markets. There's a good buying opportunity when that happens, but you have to look at what's the driver of that and how quickly the Fed will bring down interest rates. If we go to recession, then obviously that takes the terms of trade in terms of exports, that will slip for India, that's for sure. So whilst we're gaining market share, we'll also kind of suffer from that as well. I think in terms of earnings, so here's my dilemma with earnings. I know all the figures, and yes, it is better than expected, but one question, why has the banking sector been underperforming for virtually most of the year? And they've had great results, but the commentary from the banks has been, you know what, NIMS is under pressure and we don't know when that's going to change. Why is the RBI, kind of talking about unsecured loans rising so quickly? Why would that unsecured loans be rising in a growing economy so quickly at this stage of the growth? So I think these are the dilemmas I kind of face on a day-to-day basis in terms of, at 17.5 times 1 year forward PE, it's not cheap. It's in line with kind of the historic kind of valuations, but it's not, what's going to get it going? And it can only be upgrades to earnings, which can only come in the back end of this year into 2024 as the multiplier effect of government capex, private capex starts to play through. But that's not going to be everywhere. So my view is that whilst we can talk about the Nifty, going higher, I actually think the best way to make money in India is through themes which play below the index. That's where you're going to make most of the money. For example, we know the defense spending is going to continue, not just in India, but globally. So, those stocks have run up, I know, but, over a 4 to 5 year period, there's a lot more to go because that spending's not going to go away. So I think it's below the index I would look rather than look at the index.
Okay, you suggested that markets are expensive. How expensive are they right now? I mean,
so let's take a scenario. One of our scenarios is that the US will head into recession going into next year. That would mean that interest rates would start to fall, and the markets would look through that to say, okay, when growth occurs again, globally, who would be the beneficiaries? Now, obviously, you look to the exporting countries for that. It would in emerging markets, so your China, Koreas, Taiwans will all be a play. And they are cheaper than India. So first flows will go to these kind of markets. And we've seen that, actually, if you look at the Korean market, it's actually, I think it's still up about 16, 17% compared to our market. That tells you where the flows will go. And that's why we've been seeing flows move out of India, maybe because they're expecting some big stimulus in China. Yes, they've been using a pea shooter or a water pistol with some of the kind of announcements they've made. But if they came with a big bazooka, which was to get consumer confidence back, the property market back, then flows would go back to China. I know 2 months ago, everyone was, love India, don't like China. That can change very quickly in terms of where, if investors feel they can make money, they'll move there. And it's a much cheaper market than India.
okay, thank you, Mr. Holland. Let me turn to Mr. Jain. Mr. Jain, you will recall that a few years ago, there were a lot of critics of your public sector banking strategy. And probably now those critics must be wondering what went wrong with them. So today, how do you see the markets? Are you on the bull side of the market or the bearish side of the market? What are your perspective, given the fact that you proved everybody wrong?
No, good morning, everyone. I think Ridham took a masterclass on the long-term economic prospects, and I would wholeheartedly agree with that. I think India has grown around 6% last few decades. I think it should grow higher maybe between 7 to 8% for the current decade and next. I think as far as profits are concerned, at some stage, I mean, I respect Rhythm a lot, and when he says profit should go from 5 to 8%, I mean, it may happen. I really haven't discussed that with him in detail, but even otherwise, I think even if you build in a 15% profit growth, slightly ahead of nominal GDP growth, I think these markets look reasonably valued to me. Short term is always uncertain. I started my career when index was around 2000 and today it's 60,000. And we have always had positive factors and negative factors. I think the key is to focus on, unless you are overpaying, it turns out right that if you are bullish on India, medium to long term. And I think that's how it will turn out this time as well. So if 2 years back someone had said in 2 years US yields will be at 5% and you were at 1% then, so what would happen in India? I am sure people would have been extremely worried, but look at what has happened. So I think India is structurally extremely well placed, macroeconomic parameters are very strong. I would say if US yields were to rise even higher from here, it could lead to one more round of selling, one more round of volatility. But that is part of the equities journey. I would look upon any dips as opportunities to buy. And structurally, I think the volatility in India is headed lower. And look at what happened 18 months back. Foreigners sold 2 lakh crores worth of equities and markets didn't fall. If you look back, similar selling over the last 20 years, markets used to fall 30 to 60%. And this time there was no fall. So I think the structural flow of local equities, of savings towards equities, reduces the volatility of India, makes the case for Indian equities even stronger. So Andrew mentioned about personal loans. I think yes, it could be worrisome. If you look at India's debt service coverage ratio of households, it is coming closer to global levels, but I think the wage inflation in India next 10, 20 years will be very rapid, given by increase in offshoring of a lot of jobs are moving to India through remote working and manufacturing is coming. So I think wage inflation in India, both white collar and blue collar, will be pretty strong. And there could be some concerns around personal loans, but I don't think it is worrisome to my mind, not yet at least. As far as elections are concerned, I always say in lighter vein that no elections are a far greater risk than elections. The good news in India is that there has been broad uniformity in policy direction. So reforms in India have never reversed, even if the governments have changed. And therefore, there is a very weak correlation between election outcomes and medium-term markets performance. Of course, if the election outcome is not to the market's liking, it can again lead to a knee-jerk reaction, but I would once again look that as a buying opportunity. One last thing, inflation in India has structurally come down. So last 9 years, inflation is sub 5%. So the nominal GDP growth in India has also moved lower in rupee terms. Cost of capital has moved lower. So I think we should also be prepared for a more moderate returns from equities compared to what we used to get prior to 2000. So I would say longer term Nifty, assuming it remains fairly valued, should compound 12% or slightly ahead of that. Thank you.
Yeah, thank you, Mr. Jain. Did I hear you correctly when you said that there is a possibility of retail loans becoming a bit of a problem area in terms of retail banking coming under stress? Is that something that you would like to expand on?
No, I mean anything in credit markets, if it grows at a very high rate for a sustained periods, there is potential for things to become excessive. So I was merely referring to what Andrew mentioned, that he is concerned about rapid rise in unsecured personal loans. And RBI also has been mentioning that. But when you look at India's debt service coverage ratios of households, it is not at alarming levels. So I would say one should be observant, but I would not worry too much about that.
Yeah, because the RBI appears to be a little worried about it.
So yes, as a regulator, they should be.
Yeah,
They should
yeah.
be. They should be.
Okay, let me, before we go into the challenges, let me now reverse the thing. But one quick, quick fire round, so to say, quick answer would be, there is this view that the next year, because of the volatility in the market, debts will be the preferred route of investment, and equity will not because of the volatility. Now, what would you say, Mr. Jain? Debt or equity?
No, I don't think there can be a right answer to this. It would depend on individuals. I think both have a place in anyone's balance sheet, and I would feel, I mean, long-term money should go towards equities to my mind, but it should clearly be in line with your tolerance for volatility.
Okay, Mr. Holland, debt or equity in the next 1 year or so?
If I was positioned now, I'd be more in debt because I think interest rates will fall, and I think you can make some very good gains in debt. But then I'd be shifting that into equity going forward. So short-term debt, long-term equity.
Mr. Desai, your debt or equity?
Yeah, I'll make two comments. So one is, as Prashant said, it's a portfolio call. It's an individual risk appetite thing. So this asset allocation has to depend on that. And the second thing is about the time. Longer term equity outperforms. It's as we have done a lot of research on this. Equities is the best performing asset class over the long run. So it's also a question of what horizon you're looking at. Very certainly there is going to be more volatility in the next 12 months in equities. So you have to have the risk appetite to handle that.
Okay.
Volatility has been particularly subdued over the last 2-3 years, and it's likely rising now. So.
Okay. Mr. Agarwal, debt or equity?
I think as far as India is concerned, I think equity is the only way, because one has to go all the way in equities, because debt, I'm at what about 6.5%, 7.5%. I mean, it may be another 50 basis point up or something like that. See, the real dramatic changes in European and American markets. From 0 or 0.1, 0.5 or 1%, it has gone to 5%. So they have a dramatic change. We don't have dramatic change. We were always getting 5-6%, and now we are getting probably 7%. So what is so big deal about it? My inflation is also 5-6%. So net, it takes 72 years to double my money at 1% real this thing. But in equities, if you make 15% and 5-6% is the risk free, you are making 10%. So in 7 years you double. So do you want to double money in 7 years or 72 years? That's your call.
Yeah. Okay. That's an interesting take. So the audience loves your response. But we will come to the audience for their questions. But I must finish this round of challenges. And what I could make out from all Mr. Jain, Mr. Holland, Mr. Desai, your responses is that there are 4 areas of concerns. I mean, I would not say concerns, but uncertainties. One is, of course, the geopolitics, which is happening around the world. Second is elections at home. Third is the external sector. And the fourth is, I would say, the domestic markets, the economies, distortions, I would say, wages, inequality. Is that something that can blow up into a bigger crisis or not? So these seem to be are the factors that all of you have hinted at in different degrees. So what would you classify as the big challenge? Would you like to add to this list, or would you like to expand on them? And what is the challenge that you think, as a market expert, you would like to focus on?
See, there are challenges. There are not only 4, there are 40 more challenges.
Okay.
I don't know how to put the odds on that. The issue is there is a guy called entrepreneur. And in every company, every bank, every corporate, there is a thing called entrepreneurship. And that guy is the biggest magician. He's supposed to make profits irrespective of whatever the challenges. And newer challenges keep coming, logistic challenge, supply chain challenge, or raw material price just shooting up, or there is an invasion in Ukraine, and now everybody was looking at Ukraine or maybe Taiwan, and suddenly that damn thing happens in Israel. Who the hell knew about it? And what is going to be the impact of it? So we cannot figure out all that. So let's focus on something which we can figure out. That is the corporate earning. 90% time I spend in trying to figure out corporate earnings. And that's why in business standard, first thing I see in the morning is how much is the aggregate profit growth when the result season is on. Because that is what gives me some sense. So because we are buying the discounted future profits growth or earnings growth or dividend growth, whatever. So I am 90% focused on 10% for entertainment. We look at US interest rates, what is happening in China, what is happening in Taiwan, what is happening in a whole lot of other things. So yes, 10 minutes, definitely entertainment you must do by reading Bloomberg, by reading all sorts of newspapers and everything. Because they're happening. But ultimately, if you see G is equal to R, profit growth is equal to return of the stock. If your profit grows at 25% for 10 years, you will make either 23% or you'll make 26%. You can do any number. In any country you do it. Forget about India. So that is what my focus is.
Okay.
I have to figure out how much company is making profit today and how much it will make in next 10 years. If I get a company at reasonable price, see, reasonable price is very important. The real challenge is I think we should discuss whether the markets are reasonably priced, what Mr. Holland said. So yes, that point still remains, and even that concerns me. Buying companies, because now India is extremely well explored. Now let me give you what makes me excited about the market. It's not that I'm a blind bull or anything like that. The issue is that in last 25 years, total savings in the economy is about 10 to 12 trillion dollars. If you just add up all the savings, household, government, corporates, everything. Next 25 years, guess what is the number? It is going to be 100 to 150 trillion dollars. And it's happening by the day. If you do, your own paper published yesterday, Niti Aayog's projections. $30 trillion for 2047. Do 30% of that. What are we talking about? 9 to 10 trillion dollars of savings. 3x of the current GDP in next 25 years. Market is going to discount somewhere. Not 25 years, but maybe 5, 10 years. So what I'm saying is we are sitting on to a real tsunami of savings. Now, second thing, what is happening in the domestic markets? What Rhythm said, 2 lakh, 3 lakh crores of selling in last 2 years, and yet market didn't tank. Why? Because the domestics are coming. This is the biggest economic change after 92 delicensing.
Okay.
Where now truly 140 crore janta or 1,400 million people, they are participating in equity markets. For some reason, till COVID, they were not coming into the market. Only 4 lakh customers were coming into the market, demat accounts. Today, guess how many customers are coming? 3 million per month. From 30 million demat account, 40 million demat account pre-COVID, it has gone to 130 million and 3 million every month. If it goes to 250, 300, 400, my sense is we are heading for 500 million in next 10 years. Guess what happens in the morning when a billion cell phone starts with 500 million people trading? So what I'm saying is in last 20 years, the corporates work without equity, only debts. Now, next 20 years, there will be tsunami of equity. Just imagine. And the Indian entrepreneurship. When you combine the deluge of equity, domestic equity, not foreign equity, and fantastic bank. Yesterday, Mr. Kamath said what? He has never seen structural change in the banking system in India. So when you have fantastic equity, fantastic supply of credit, and top-class, world-class entrepreneurship, that's what you need.
Okay. So Mr. Agarwal says the tsunami of equities. Yes, there are challenges, not 40 challenges, but what you focus on as a magician is on those, whether the earnings are intact or not. Am I right?
Yeah, because there are very few corporates who can deliver earnings.
That's right.
Like in banking, there are very, very few good bankers. This is a good time. All the guys, they look to be good. They're not good.
So challenges are there, but you need to. Mr. Desai, your take on the challenges.
Yeah, so you highlighted 4 challenges, so I'll rank them in my assessment of importance. So the least challenge is the domestic situation, which you alluded to. I don't think that's a problem at all. I think domestic is in great shape. You highlighted inequality, but that is just a reflection of the early cycle that we are in. It will fade as the cycle advances. In fact, actually we are dealing with much lower poverty in India than we have in the last 10 years. So anyway, that's one. Second, in that, so from the bottom, the second would be, I think, geopolitics. So I'm really not that concerned. Again, if you were told that there were going to be two major wars, one in the Middle East and one in Russia, you would anticipate oil to be at 130 and not 87. So it tells you about the oil market dynamics. So the only problem from geopolitics for India is that oil prices rise. But they're not doing that. So I think that's the second least important. The third, and again, I'm saying all this from a 6 to 12 month perspective.
Sure.
So the third is the global situation. That is certainly concerning. If US yields rise and they go to 6%, it will leave a trail of volatility in India. India cannot escape that. India is the 5th largest stock market in the world. It's not a small cap stock. It's a large cap player in a world. So if the topmost stock is in trouble, then that trouble will filter through. There are other concerns also about the global economy. I think China is an issue. China is in a debt deflation situation. Pricing from China is likely to be weak. It will compete very hard in various markets, and that will have some effect on India's external situation. And the topmost concern I have from a 6 to 9 month perspective is obviously the fact that India is in an election cycle. I think Prashant was absolutely right. It reflects the work that I've also done. If you go back of 30 years or 35 years of elections, they do not leave enduring effect on what the economy or the market does. But in the short run, they can produce a lot of volatility. And I'll quickly remind this audience of 2004, when on a single day the market was down 15%, and 2009 when the opposite happened. So you have to be prepared for volatility. My base case view is that the market will be pricing in its favored outcome, and then in May of 2024 it will figure out whether the outcome was favorable or not. And if it is not favorable, then there will be a sharp drawdown, which again I concur with Prashant will be a buying opportunity, but it will be very taxing. So I think that would be my topmost concern. So that's how we are. I think longer term, the key risk is the world. Remember, the world is not in a very good place. The world is struggling with demographics and debt. This is very different from what China had as a backdrop when it was growing. China had a very strong global growth environment and therefore was able to export its way out of its poverty and grow as an economy. India may not have similar conditions like China had. So it will therefore be more challenging. But the good news is that India is starting from a very low level of market share. So in goods, India has 1.9% of global goods market share in exports, just 1.9%. Just to put it into context, we are 4% of world GDP, okay? And Morgan Stanley view is that we will be 20% of incremental global GDP over the next 10 years. So we're under 2% of physical good exports, and we're about 4.7% in services. Both these numbers can easily double in the next 5-7 years. So we will gain share. Therefore, the external sector as such will do well, but it will not be as easy as it was for China.
Okay, two quick supplementaries. One, you talked about the inequality issue. Does it not have a bearing on the demand side of the economy? That's my first supplementary.
So see, that is what has happened in the last 2 years because of COVID. The first section of society that was out of the problem was the more affluent class. And now that filters down, and already the rural economy is doing better.
Okay.
And you will hear about this in 6 months.
Okay.
So the narrative will change. So my view is that the filtering has, the trickle down has happened, and the overall economy is going to be in better situation. So that inequality gap will actually narrow. There are a few structural changes that are also helping this. So you must understand that some policy decisions of this government have been very good for poor people. For example, the decision to move to direct benefits transfer using Aadhaar. It was not a given in 2014. but it happened. And as a consequence, the leakage in our social transfers have dropped. Now, if you exclude the extra spending that we had to do with COVID, government subsidy spend is at multi-decade low. Why? Because they're far more efficient than before. So that's one. And therefore, the intended beneficiary is getting the intended benefit. Not only that, the intended benefit is also being spent in the area in which the government has to do. And I won't go into greater detail, but for example, the girl child's school fees are not paid in cash, they are paid in QR codes.
Yeah.
So you are ensuring that the girl
Absolutely.
child is going. So the effect of this is that India's infant mortality is down 25% in 5 years. India's female feticide has crashed. You know, 10 years ago, we were giving birth to 109 males to 100 females. That's not how nature does it. Nature does 100.
Yeah.
So very clearly, we were killing the girl child in the womb. That number is now down to 106.
That's an improvement.
So we have reversed female feticide. So this is great progress on the social front. And you may have seen the UNDP report. It suggests that India's poverty is at near all-time lows. So that's one thing. And the second thing about the social structure in the country is that because we are focusing on corporate profits, we're likely to drive an investment cycle which will create jobs, and it will create jobs exactly where the problem lies. Yeah. And that, I think, will cause inequality. Whatever inequality is there will to go down. The only problem that remains on the table, and I'm really hoping that the next government fixes this, and we didn't discuss it, it is a long-term problem, is India's farm sector. So the farm laws, I think, were very good, but they have not been implemented, and I hope that they get implemented sometime in the next 3-4 years, because we need to fix the farm sector.
Okay, let me add to your optimism a bit. You refer to 2004, and in 2004, the one single factor that brought down the stock market was a statement by a left leader on disinvestment Jai Bhanme. Now, in the last almost 20 odd years, do you think the political classes have also matured not to make such outlandish comment soon after the elections? And in a sense, politics in India has also matured to an extent that the kind of market fall or volatility that one fears after hypothetically a reversal of the current regime and through the election results, will the political reaction be little muted relatively, or do you think it will be the same?
Ashok, not everything moves in sync. So India's financial economy is progressing much faster than its physical economy, and that is progressing much faster than its political economy. I mean, I don't think the pace is the same. Otherwise, we wouldn't have this freebie culture right now.
Okay.
So that tells you that the political economy is still catching up with our progress. We have become a near $4 trillion economy from $1 trillion in 2007. Okay. I think, of course, the political class has made progress, but not at the same rate.
Okay, good point. Mr. Holland, your listing of the challenges that lie ahead of the markets?
Yeah, so I think we spoke about the challenges, so I want to put it slightly differently. You know, with all the optimism that we've heard, a question. Yes, earnings growth is great. India's standing above everywhere else in the world, fantastic. Why is the market not really reflecting it? I mean, it's up 5% this year. I think probably made nothing over the last 2 years, despite all of this. What is that reason? I'm not sure I know, unless we're looking in the rearview mirror of what has been the best in terms of earnings, and maybe there's a slide down because of global factors, not necessarily local factors going forward. So I'm just cautious of why that should be. Yes, we went to new highs, but you know the global markets themselves have been near new highs. It's not as though markets are crashing globally as well. So we've been helped by the fact that despite all the global problems, you know, the US market hasn't fallen. Yes, held up by certain stocks. If you look underneath that, then, you know, a lot of those sectors like banking and the Russell 2000 small cap companies, you know, are in correction phases. But what I'm trying to say is, why is our market not reflecting some of this great optimism which we have in the very short term? And that's why I said that the challenge is on the index, and therefore I would recommend you look below the index for the themes that will play out over the next few years, or multiple years. So for example, electronic manufacturing, it's not going to go away from us. We're at the start of the runway, and that's going to be a multi-year kind of growth story. If I look at beverages, the premiumization, both non-alcoholic and alcoholic, we're just at the beginning of the runway. We have a very young population who are willing to try and move up the price range very, very quickly. So these are the kind of themes which I think will play out and make you much more money than maybe the index over the next 1 year, not just because of elections, not just because of global factors, but because maybe, and just maybe, that earnings we've seen the best in the very short term.
Okay, thank you. We're running out of time, and I will come to Mr. Jain. After that, we will go for a quick 2 questions, maybe from the floor. Mr. Jain, your listing of the challenges, apart from elections that you already listed, your thoughts?
So I think I would worry about spike in US yields further. I think this time, beyond this, they should impact India, because Indian yields should move in tandem, and one more round of selling can come and it can lead to a knee-jerk reaction. So that's one. I think the small mid-cap space in India seems to be having excesses. I would be very cautious in that space. And Ramdev ji mentioned India is a land of entrepreneurs. That's great, but also it leads to huge supply of equities. So if you look at the last 6 months, it's almost 2 lakh crores. So I think supply will catch up with demand. So, and I don't think just because the flow of equities, flow of savings to equities is rising, we can make a case that index can go to any level. I think we have to focus on valuations, because supply of stocks will catch up even faster. And I do see a lot of excesses taking place in the IPOs. So I would be cautious on the small mid-cap space. Third thing, what would worry me, and Rita mentioned that despite 2 conflicts going on, oil has not risen. But the fact is that investments in conventional energy have dropped in the last 5-7 years. And that was because of the narrative that we'll quickly transition to renewable. I think the world is more realistic now, and you can see how India is also adding up a lot of thermal plants. So I think when you underinvest in oil and coal, and these are long gestation projects, and the world is even today not keen to invest in these projects, because the payback period could be 20, 30, 40 years. And there is a natural depletion in mines or wells. So I am not an expert on this, but there is a possibility that over the next few years, if demand of energy keeps on rising, the conventional energy and supply does not catch up, it could lead to a significant spike in conventional energy prices. And let's not forget that a large part of the population in the world is now coming to a level where the energy intensity in the world will go up. So I think the demand for energy will grow at a faster pace, and India is a great example. 18% of the world's population and moving out of poverty, so the energy demand in India will grow extremely fast. So I think these are some 2-3 points that I would like to.
Sure. Just one quick answer. How thick is the froth in the mid-cap segment?
I think quite high, if I may say so. I mean, I find it very hard to justify. If you look at 50 companies, maybe 2 or 3 will offer you some value.
Well, that's on that somber note. Just 2 questions we have time for. Please go ahead. Yeah. Where are the mics? Yeah.
Good morning, everyone.
Yeah.
My name is Ishan. My question to Ramdev sir is, sir, we all admire you as India's Warren Buffett. Sir, I just want your view on the discretionary spend, the ride, and the way from which, as a retail investor, we can get benefit from India's upcoming discretionary spend, sir.
We'll go for the second question and then we'll round it up, Second question from there.
May I, sir?
Okay, go ahead.
Ankush in this side, sir. So my worrisome area is India really growing, or the informal economy is transforming into the formal economy in the form of GST number, direct tax number, also the double trading going into the formal equity market? So that's my question.
Good. I think,
Thank you.
Mr. Agarwal, the first question is addressed to you.
Yeah. So, yeah, discretionary spend is going to, doubling of GDP. Say you are at about, say, 3.75, 3.8. And in next 7 to 8 years, you are going to go to, say, 7.5, $8 trillion. So what is doubling of GDP would mean for many categories of discretionary expenditure, 5x to 10x kind of a demand growth. Like, say, for luxury cars or for travel, for tourism, a lot of things could be quite explosive for them. Now you have to figure out, see, beyond doubt, premiumization and discretionary spend is going to build up. You have to figure out the company where there is going to, the sector where there is going to be growth, and the company which is going to act on it and capitalize on that. So, so it is very important that stock selection has to be, and it is quite possible that those companies are today expensive. So that part also have to see, are you behind in the race, in the sense that if something is trading at 70 P multiple, the story is fantastic, but at 70 P multiple and the terminal P by chance turns out to be 35, you're not going to make too much of money. So you have to be very careful about this discretionary spend. Markets have already discounted bulk of the stories, and they have discounted rather too much. So you have to be very careful in choosing a stock. But the discretionary spend story is explosive, and you will find stocks where you can invest.
Okay. Would you like to respond to the other question?
Yeah, of course, there's formalization that's happening, and in part that's giving a lift to India's economy, and I think that's a process that will continue. It will continue in the area of, say, credit, where a lot of informal credit will get replaced with formal credit, so the banks will benefit. Consumers will benefit because their interest rates will be lower. It will happen in tax collections, so the government's fiscal balances will get better. They can spend more money on infrastructure if they choose to, which will again help the economy. So all this is very good, actually. And the seeds were sown, I think, many years ago when we first decided to attach the PAN number to transactions, and we decided to make IT returns electronic. And it's only gained momentum in the last 15, 20 years.
Any you would like to add to this? Okay. I think we have come to the end of this very, very rich discussion. As always, very difficult to sum up a discussion that is as varied, as rich. Nevertheless, I will try to sum it up in 3 quick points. One is India is a market for equities for a long time to come. There are structural changes that have given it the kind of muscle that India was looking for. The second point would be still there is the political economy is still relatively fragile. And the third point, I would say the mid-caps are probably an area that you need to be watchful about. With these words, we come to the end of the discussion. Ridhima, all yours.
Thank you so much, Mr. Bhattacharya. Wow, I think immensely objective, supremely lucid with razor-sharp comments. I think some of my takeaways are being invested in long-term equity, and the entire insight that India is touted to have about 500 million people registering for their DMAT accounts was truly eye-opening. And on a stage like this, getting to know the perspective that female feticide has reduced by 25% really not only financially talks about the progress of India, but socially, structurally talks about the progress that India has made. Thank you so much to all the speakers for such an enriching session, truly insightful. Thank you. Can we give them a huge round of applause? And can we present them with a set of mementos? Mr. Bhattacharya, can I request you to present all our speakers with it? Ladies and gentlemen, we are going to get started with our next session in this very hall, which is with the movers and shakers of the insurance industry. So can I request you all to be back in hall number 1 in the next 2 to 3 a stellar set of panel members. I'd like to invite on stage Mr. R. Doraiswamy, Managing Director, LIC of India. Welcome, sir. And joining him on stage is going to be Mr. Anup Bhakchi, MD and CEO of ICICI Prudential Life. Welcome, sir. Thank you so much for joining us today. We also have with us Ms. Vibha Padalkar, CEO and MD, HDFC Life. And Mr. Mahesh Balasubramanian, MD, Kotak Mahindra Life Insurance Company. And Mr. Naveen Tehliani, MD and CEO of Tata AIA Life Insurance. Welcome, sir. And to navigate this conversation, I'd like to invite on stage Mr. Manojit Saha, Banking Editor at Business Standard. Over to you, Mr. Saha.
So, good morning once again. It's a stellar panel we have today with the general life insurance panel, where we are saying that life insurance is it the new sunrise sector. Now, before that, a bit of a background can be added, can be helpful. The insurance regulator, the IRDAI, has committed to enable insurance for all by 2047, where every citizen has an appropriate life, health and property insurance cover, and every enterprise is supported by appropriate insurance solutions. These are industry where the regulator is extremely facilitative. The regulator is pushing for growth and penetration. So first we will have the opening remarks from all the panelists, starting from Mr. Doraisamy, that our insurance industry ready to take up the challenge, which is set by the regulator, insurance for all by 2047?
Thank you for having me in the panel today. Yes, I think the answer should be a wholehearted yes. The industry is all poised to rise up to the expectation of the regulator as well as the country in terms of providing insurance for all by 2047. The companies have already started working on that. A lot of initiatives have been taken, particularly on the regulatory reforms by the IRDAI on addressing the three issues of availability, accessibility, and affordability. Particularly in the area of life insurance, the industry has also grown with two more players joining the industry and many more waiting to join, perhaps. So, the focus is clearly on taking insurance to every insurable person in the country, and with the new initiatives that are being now really talked by IRDA, which is expected to hit the market maybe in a few months' time, we should be able to take this quite forward.
Thank you. Mr. Bakshi, your opening comments. Are we ready to take up the challenge?
No, absolutely. I think if you look at this industry, it is meeting a couple of societal needs. One is life protection, because we are a country with very demographics. So it means life protection, credit protection, because when you borrow, and if something happens to you, it's really a deep responsibility product. Then reinvestment risk and retirement planning. I think there are no substitutable products in any other industry which meets the societal needs. And as the per capita increases and different demographics really come up, I think the need for these products, which is now latent, will become explicit. And as an industry, we have to position ourselves for that. And I must say that regulator is really doing a very good job of nudging us, encouraging us, and also in a way facilitating many of these issues around this. So I think there is a great future ahead.
Thank you, thank you. Yes, of course, the regulator is extremely facilitative, which is something unprecedented. Ms. Padalkar, what is your views on this? Your opening remarks, please.
So while we are very enthused with all the opportunities, and our regulator has been perhaps in living memory, extremely facilitative, but I also want to focus on what the industry has achieved so far. When you just look at the sheer expanse in terms of reach, whether it is the 27 lakh agents that we have, whether it is the 11,000 plus branches to get, and this is beyond almost, there is no region in India wherein we don't have in some form or shape collectively as a sector a reach which is in terms of penetration. If you were to look at overall number of people covered, we're looking at 14% in terms of individual lives that have been covered. If you also were to look at the new business that's coming in, for a lot of us, over 50% is less than 35 years of age. So also younger people. I think where we have to have focus, and that's where our regulator, whether it is through Bima Sugam, Bima Vistar, Bima Vahak, on how do we expand the reach, because when you peel the onion, some messages start percolating out. For example, 30% coverage in urban areas versus only 5% coverage in rural areas. So there's a 1/6 in terms of paucity of insurance for various reasons, which I'm sure we will discuss.
Right.
Also, when you look at male-female ratio, 18% penetration of males versus only 9%, so half in terms of penetration. So rural female, which is also giving the idea towards Bima Vahaks. And so when we cover more uniformly across our demographics, I think naturally the growth outcomes in insurance for all will come through.
Correct. Sir, your opening remarks, Mr. Balasubramaniam.
No, I think in addition to what my co-panelists have said, I think the biggest opportunity for us, or I would say an obligation or a duty for us, is to take care of two important things as far as insurance goes. First is the protection, because we find the protection gap in India is extremely high, as much as about 83% protection gap with about $16.5 trillion as the protection gap estimated, right? Only 12% of the retail households have actually taken insurance. So there is a huge addressable market which is staring at us. And that's where all the initiatives which the regulator and all of us are taking is going to help us bridge the gap. The second is on long-term savings. I think people must understand that insurance is a little bit of a challenging category because we are not in the instant gratification game. And today I think the world is moving towards more instant gratification. This is real hard work because this is long-term savings where we're asking people to save money for their future, for their pension. For instance, the pension gap is estimated about 55 lakh crores by the end of 2050, right? So I think this sector needs a little bit more attention. I think we need to build awareness a lot because people still are looking at insurance. Insurance zaruri hai, right? So I think that feeling is not coming into the minds of our customers. And that's where we need to get in. I think it's a new dawn, I would say. I think very shortly the sunrise will happen. The flywheel is in motion. I think let's hope the momentum picks up and the dawn goes into a full-blown sunrise.
Mr. Tailani, so are we set, the stage is set for a takeoff?
Very hard to close the opening remarks. After all that has been said, I have run out of things to add. But the only thing I would just say is, you know, as LIC has been there for a very long time, private sector industry is now 23 years of age, right? And if you compare that to when banks were privatized, we are about 7-8 years behind.
Correct.
The first private sector banks came into being around 93, 94.
Right.
The first set of private sector insurers came into being 2000, 2001. And one statistic which, you know, I would just add to everything else that my colleague said is, if you look at the capital deployed in life insurance industry, it's about 1.2 lakh crores.
Okay.
But if you look at the capital deployed in the private sector banking industry, just private sector alone, it is 150 times that. 150 times. And when you add the public sector banks, the total capital of the banking sector is 250 times the capital deployed in the life insurance sector. So to your original question, are we a sunrise sector? Yes, we are. For all the points that all the panelists made in terms of protection gap, pension gap, you know, number of households which are penetrated is small. I would also say when you look at sum assured to GDP, India has one of the lowest sum assureds to GDP. It's a different way of looking at the protection gap that Mahesh talked about. We are at 25%. Most of the markets will be upwards of 100, 150%. So the opportunity is there. I think we have now regulatory tailwinds. We have a regulator who, for a change, is pushing us to say what more can be done, is very supportive, is very constructive. So I think this is the time to grab the opportunity and change the game. I think if you were to hold a panel like this, maybe 6-7 years later, it should be recognized as the golden decade in life insurance.
Right.
Where
right.
we catch up with private sector banking in a big way.
Right, right. You talked about capital. Do you think 100% FDI will solve the problem?
I don't think necessarily FDI is the issue. Today, when you look at the companies which are there in the sector or companies which would come in, I think there is no dearth or inability for them to raise capital, either from Indian promoters or foreign promoters or from the capital markets. So I don't think availability of capital, scarcity of capital is an issue, particularly given the macro and the geopolitics in India today. Case to case, yes, maybe some companies would want to be 100% FDI instead of 74%, but I don't think that is affecting the overall picture in any shape and form. I think also if you look at the reforms that the regulator has put out on capital, for example, now the limit on tier 2 capital, sub-debt, has gone up by 2x. Earlier it was 25% of net worth, now it is 50% of net worth. The ability for investors to come in has also been streamlined significantly. So a single investor can now hold up to 25%. That's also been liberalized. So I don't think availability is an issue. I think what is an issue is now as a sector, given particularly the regulatory tailwinds, how are we thinking about using that capital for increasing awareness? So, for example, all of us are watching the World Cup matches nowadays, particularly when India is on.
Right.
And one of the most frequent ads, at least I see, I'm sure many of you also see, is mutual fund sahi hai. And they run a marvelous campaign. They run a marvelous campaign on mutual fund sahi hai. And, they've used celebrities, they have used, common folk, they have talked about very conversational topics. And what that has done is raise the awareness of mutual funds in the minds of the customers that this is an important product. We need to do the same. Now, that takes capital, for example.
Insurance zaruri hai.
Insurance zaruri hai. We had a campaign a few years back as an industry, which was, I thought, a very good campaign which said, Sabse pehle life insurance.
Right.
Sabse pehle life insurance, right? So I think that, so we need to invest in, awareness. Vibha mentioned the right point that we have come a long way. We've got 11,000 branches today as, life insurance. But when you compare 11,000 branches to any large bank, as an example, some of the larger banks, PSU banks have more than 11,000 branches. One bank has more than 11,000 branches, right? Some of the larger private sector banks have 6,000, 7,000, 9,000 branches, right? And they are rapidly expanding. So I think we need to invest to reach rural India in a very, very material manner.
Right.
Investments in terms of technology. Today, I'm sure we will talk about it.
We'll come to technology in a minute.
But I'm saying that will need investment. That will need capital. So I think what we need to do as a sector is think through how we are going to expand awareness, reach, distribution, invest in technology. Supply of capital, in my mind, is not the issue.
Right. So all this leads to the penetration issue. I will put it a bit differently with some numbers. Now, while if you see the premiums, the growth on premiums is most probably symmetric across most of the players. But in a country like India, which is a developing country, we need to ensure that more people are buying the policies. The growth in the number of policies sold on a year-on-year basis till September is for the private sector insurance players, it's in single digit, I think about 8% or so. And for the entire industry, it's flat. So if people are not buying more policies, then how are we going to ensure insurance for all by 2047? Ms. Parilkar, what is your thought on this?
So it's a combination. I think some of the building blocks that we talked about, term, annuity, both ends of the pure protection, if you like, spectrum, all of these will start meaning that we are able to pitch not just savings-led insurance, but many other solutions which are covering one or more of risks. It will take some time, but already you've started seeing, especially this year, wherein the number of policies has started growing. Maybe it's high single digits, maybe for some it's low double digits, but it has at least started growing. Sometimes you put the cart before the horse. Naveen mentioned about this, wherein do you set up branches and then business will follow. So some of that will be, we are relatively nascent, but I think it's very well understood, especially more recently when the tax changes happened, that the focus is that how do you cover more and more people. Ticket sizes have gone down, have crashed, at least in certain segments. So in a way it is that, okay, how do I get to that? Also with some of the new aspects that we talked about right at the beginning in terms of opening comments of Bima Sugam and Vistar and so on, we will start covering more and more people in a very simple bundled products. It could be bundled with life and health, because that is another artificial construct that, a person has only life cover, a person has some other cover. It's the same person. So when is a person unwell and when does the person pass away? It is the same. He's looking or she is looking for solutions to it. So hand in hand with some of these options that open up for the sector, I'm very confident that the number of policies, which means more and more people will come under the insurance net. Another anecdotal, maybe thanks to the pandemic, is that no longer, and my colleagues I'm sure will agree, no longer do people say, why do I need insurance? Which they used to ask earlier. I have my son, I have my daughter, why do I need it? It's a waste of money. That I think is slowly going down.
Okay.
Second is on retirement. 15 years ago, people used to ask, why do I need retirement? I've educated my kids, or I have gold and real estate. That question is almost not being asked anymore. So these are all both socio-economic changes.
Yeah.
No, these are very, very tectonic changes
Shifts.
in socio-economic outlooks of the average middle-class Indian, and maybe even one level below. So, and this is happening during our one generation. So this generational shift wherein at 60, I don't want to embrace sannyas, I want to see the world, I have aspirations, I'm not going to live with my kids, I might want to live nearby. Those sorts of things are a generational shift, and that is it. And last point is on per capita GDP. As there's increase in per capita GDP, it is absolutely inevitable that insurance penetration will go up. So it's really where are we today in the life cycle of many of these things. Some of them realization, some of them accessibility, some of them in terms of products availability, some of them in socio-economic. As all of these things come together, we are all very, very confident that more and more people will come under the insurance net.
Right, right. Mr. Doraisamy, how can we ensure that more people are buying insurance policies?
Two, three things, sir. One, first and foremost, the awareness creation is one very, very, very important area. And towards that, if you take the socio-economic profile, the middle income group and higher, this question is no longer being asked as to why I need insurance. But when it comes to the set of people below the middle income group, there is an awareness, there is an acceptance of life insurance as a product, but when we are talking about pure term, it doesn't go well with them at all.
Yes,
because
yes.
they don't want to make this an expense. That writing off is not happening. So a certain amount of savings, or at least a premium back kind of a term insurance, is what it's likely to be catching up with us. People do not want to write off life insurance as an expense and not get anything out of that. So that is one thing. So we are trying to increase the number of agents in that kind of a segment, which needs to be, all said and done, life insurance is even today a push product. It's not a pull product, as my co-panelist Mahesh was telling about. Instant gratification is something which stands in front of you, whereas something to take care of family, something to take care of my old age, something to take care of something which is untoward likely to happen, that doesn't come in front of me. So there needs to be some kind of a nudge, there needs to be some kind of a push. So the focus is on building up the agency's strength, towards which industry has done very well. Now today we have crossed 27 lakhs, and more than 50% of that is from the private sector industry as well. So that is one area which we are clearly focusing. And two, yes, touching the bottom of the pyramid,
right,
through micro insurance schemes and through group covers, some of which are state sponsored or some of which are being individually paid for, is one more area that we are focusing. And I'm sure by the end of the year, this whatever growth rates you are talking about would have completely changed. We would like to have reach a stage where we reach the target towards reaching this insurance for all by 2047.
Right. Mr. Bakshi, is term insurance the real problem to solve, to make people buy term insurance policies? Because that is the pure protection, that is what the insurance exactly is.
So if we look at two parts of the equation, we look at it from a customer's end, and then we look at it from the ecosystem end. So if you look at it from a customer's end, in general, when you look at the cash flow from a customer, first goes towards EMI, then it goes towards consumption, then there is liquid money left. Now liquid money, if you are short of liquid money, then you will put it in investments which are liquid, so bank deposits, to some extent mutual funds, because you can redeem it, etc. And then if you have slightly excess, and which is where the point about per capita comes in, you can get into long-term corpus building products, because it is locked in. So when you look at it, then what kind of protection you require? You would certainly require life protection because you have to replace the income, which is your consumption part. You certainly require credit life because if you borrow and something happens, you would want the house to be with you, not a home loan remaining with you.
Right.
So credit life and this both are very, very critical. And then you come to the corpus of long-term corpus building. But if you look at it from the other end, which is what ecosystem is required, because everybody recognizes that it's a latent need. If I were to look at the ecosystem vis-a-vis other BFSI sectors like banking and capital markets and all of it, one of the big issues that is there here is that it is illiquid. And so there, if you oversell or if there is volatility in the income, you end up having low persistency, which gives a bad customer experience. Whatever be the reason doesn't matter, but it gives a bad customer experience. And whenever there is a bad customer experience, it's a bad sector experience as well. That is one. Second is on the term part, as far as underwriting is concerned, if you look at the Indian scenario on the banking sector, because that's one successful area, you will see that the inflection point really was the credit bureau. Because only when the credit bureau came in, you could price the risk well,
Right.
and you could really have the courage of underwriting it well.
Correct.
Now the equivalent of that is insurance bureau. And there is now push from the regulator because from the insurance bureau, you need to know, and I must tell you the numbers. In banking, the leverage ratios are 1:4, 1:6 of the balance sheet. In insurance, for 25,000, you get 1 crore cover. It is 400:1. 400:1, not 6:1, not 10:1, 400:1. And so you just cannot go wrong. On top of it, it is long term. So naturally, the whole industry comes back and becomes very conservative. And without data and without basis of underwriting, you really cannot expand. Because it is not true that the mortality rates of tier 1 and metro is the same as mortality of tier 3. And it is not about income, it is also about the healthcare ecosystem that develops. So the one big enabler has to be data so that you can underwrite well. And if you can underwrite well, then only you have the courage to actually go out. The third thing is simplicity. Anything you make it very complex, you will get intermediated. Anything which is intermediated and complex, large part of the surplus will flow out from the customer and will go to the intermediation.
Right.
And that will again reduce the experience of the customer. So that is the other part from the ecosystem perspective. So data, making simple products, which is why PMJJY is a fantastic product. It's a simple product. Bima Vistar, in the shape and form when it comes out, you will see, it's a simple product, easy to understand, anybody can sell it, anybody can buy it, and it is non-missellable. It is
Right.
non-missellable.
Right.
Because the product should be very simple. Only when the products are simple, customers have the trust of going and buying, and they have the confidence of going and buying. Otherwise, they get very, very diffident about buying, and if the customers get diffident, the other part of the equation will never work. So awareness has to convert to consideration, has to then convert to intent to buy. And when it converts to intent to buy, then the process and the policy and the communication must be simple. And products must be available, they must be accessible, and they must also be affordable for the customers to buy. So this part of the equation, I would say that it is work in progress, but slightly faster work in progress than it was earlier. Right. And when these two parts of the equation works, suddenly you will see an explosion. But I must again and again emphasize that data, just like you had bureau, insurance bureaus has to play a very, very vital role in just making sure that data is available to have basis of underwriting. Otherwise, the whole industry will move towards savings. Because that is where the underwriting requirements are less. It will move towards saving. And when it moves towards saving, then the issue is that we have to work on making sure that the consumer surplus remains in consumer surplus and doesn't go too much to distribution and other places. Because then you compete with other BFSI products, like mutual funds, like NPS, like PPF.
So the bureau is basically needed to understand the risk better.
On the term side, definitely term better, otherwise it will move to savings. When it moves to saving, you have to make sure that it is competitive vis-a-vis other products. In term product, there is no substitutable product.
Correct.
While in all others, there is substitutable product. So we have to see it holistically. And not just look at life insurance as life insurance, because customers have choices. And this sector is one of the choices among in savings, long-term savings. But on other, there is no substitution. And there, if we have more courage through basis of data, one can actually expand quite seamlessly and make the product simple, complex, and understandable.
Thank you. The point Mr. Bagchi is making about per capita that, the priority is to first to pay EMI, then consumption. So is it, now in post-pandemic, we have seen a K-shaped recovery. Are those per capita, this K-shaped recovery, these are the real challenges for penetration to increase for people buying insurance policies?
So I think Anup put it very well. I'll share a different way to frame that. So I work with the Tata Group. Tata Group, as you know, is present across all kinds of consumer products. Hotels, airlines, consumer products, foods, beverages. So our Tata Group CMO had done a very nice survey recently. Very comprehensive survey all across India, different income segments, different geography segments, urban, rural, metro, that what is today's Indian consumer spending the money on. And he had translated that into different Tata Group companies. And it's just a different way of illustrating the point Anup made so nicely. So people, in a certain class, for example, aspire to have a great holiday, great vacation. People want to buy a car, good car. Maybe the younger people want to buy their first car. The slightly middle income, older people want to buy a second car. People want a loan for the car. People want jewelry, which obviously, is fueling the growth of something like Titan. But, in the top 10 categories, there was no mention of life insurance. There was no mention of life insurance, and of course, people are aware. And as Vibha rightly said, the pandemic created that awareness and fear of life itself, and therefore the need for life insurance. But here is one interesting thing. All of you can do this, which is if you go to Google and ask them to run a correlation between pandemic mortality, deaths, and the digital searches for term, you will see a perfect correlation. So when wave 1 was going up, wave 2 was going up, searches for digital term was at the highest. Now, all of us have forgotten pandemic.
Right.
Right? And in some ways, all of us have also forgotten to some extent life insurance. So what we need to do as an industry, I keep on coming back to this point, is we need to continuously build awareness. If we build that awareness, people will realize that life insurance is important. It will move up the pecking order of the financial surplus that they have. The second point, Manojit, which is very important, I can take any bet, almost any bet of whatever amount you want, that everybody in this room is underinsured, which is the other important point. People may believe I have insurance, I have a life policy, which is fine, but is it the right cover? So if you have a car which is worth 10 lakhs and you buy a cover for say 2-3 lakhs, obviously you are underinsured. Valuing a car for a common layman is very straightforward. But valuing a life, what is my life worth? How much should it be insured for? Do I have that kind of insurance or not? Is a big problem as well. So you put these two data points together. Vibha mentioned 14% of the population of India has life insurance. If I translate that into working population, it goes up a little higher, 37%, right? Mahesh mentioned 91% protection gap, which means if we should have 100 rupees of cover, or say if I take a larger number, a normal number, 1 crore of cover, instead of 1 crore of cover, a common citizen only has 11 lakhs or 10 lakhs of cover. So I think we need to work on both problems. One of our life insurance companies had run a very nice campaign a few years ago, which was called Kam Insurance Lene Ki Bimari. I think our country is afflicted with that bimari of Kam Insurance Lena, but again, we have to create that awareness. So I think if we work on the awareness aspect, the demand will come. On the supply side, I just want to add one point on what Anup said, and maybe broaden it a little bit, that nothing will move without the right data, and the right data will have to come across different verticals.
Right.
What I mean by verticals is, today when we are underwriting term, why is term not selling? The usual angle is Indians want return for their money, all that is true. But the one big angle is, what does it take for a customer to buy term? Many of you would have bought term. Think about what your experience was. You would have been asked to submit bank statements, income tax records. You would have been asked to go for medicals. Now, that's not a happy, pleasant, easy experience. So a lot of people postpone the term purchase decision. because of the process that is being followed today. Now imagine if we had a platform which said, if you give consent as a customer, obviously, but we are then able to access all your financial records of your bank statements, right? We are able to access your health records, which is coming up on this National Digital Health Mission. We are able to see what policies you already have across different life, general health companies. We are able to see, with your consent, what kind of health claims have you taken in the last 10 years, right? Then underwriting can be on the spot. No more medicals, no more ITRs, no more financial statements, no more salary slips, no more business statements. By the way, 70% of policies we write is to the self-employed sector, right? Assessing their income is a big challenge. So Anoop's point, I'm just broadening it to say if we had data across all these areas, and it's not just one vertical, it's across banking, life, general, health insurance, claims, original health data as ABDHM kind of builds up, that will change the game on underwriting, both financial as well as medical, make consumer experience very different and really drive the penetration of term. And that is one part of what the regulator wants to do with Bima Sugam. Probably the most important part, but that is the core part of what the regulator and the whole industry is now driving towards for Bima Sugam.
So it seems that there are two issues we need to address. One is the data part and one is the awareness part. Is there anything else that needs to be done so that we ensure that more policies are sold, particularly term policies?
Well, I think first and foremost, I would probably little bit deviate from what Anoop and others said. I think it can't be, insurance investment can't be coming from consumer surplus. It has to be the most important thing because preservation and sustainability is the most important aspect of life. Growth comes later, right? As we say in lending, return of capital is more important than return on capital. So I think the entire Maslow's hierarchy needs to be looked at, right? Today, insurance is looked at as something from my consumer surplus, I'll put it. That's okay for long-term savings, right? But as far as protection goes, I go back to saying insurance bahut zaruri hai. There is no choice. You'll have to take it, and we have to make sure that the awareness gets built up, and thereafter everybody spoke about affordability and accessibility. I think that's where technology and data can play a huge role because the wastage in protection is very high. I'm sure across this table, all of us will agree that 35 to 40% is wastage because we are unable to underwrite for lack of information, and frauds are a very important part of our industry, unfortunately, right? That's where if we can eliminate frauds, it will become more affordable because otherwise the reinsurer would price it inbuilt in the pricing, right? So I think that will probably help make it more affordable. We also need better reinsurance capacities in this country. That's something that some of us have been speaking about for quite some time. So I think a combination of increasing the level of awareness, the decibel level has to go up very, very high. Right. And all of us, I think, if the mutual fund industry has spent 840 crores roughly in the last 3 years, we are at a paltry 140 crores across the last 5 years. So I think it's important that we, along with the regulator and the industry, life in general, make the customer conscious that, look here, this is my necessity. This is not a luxury. Protection is a necessity, and we all need to make sure that customer thinks about this. The first thing you should be looking at, when there's money with you, is am I protecting myself?
Correct.
Everything else, according to me, should come later.
Right. Now, I have a specific question to Mr. Doraisamy. You have worked extensively in the area of information and technology. Now, what is your view as compared to banking? Do you think the life insurance industry has evolved in terms of technology?
I'll say it's evolving, sir. It's evolving with a lot of companies focusing on digital customer onboarding and as Mr. Anup was putting, trying to disintermediate also has been happening, towards which technology has a tremendous capability. When it comes to LIC, we have been focusing not only on customer onboarding, we have been focusing on the entire customer journey and particularly working towards improving the persistency. That's one area which needs to be done. Actually, when we are talking about insurance for all, what I've been looking at, last 5-6 years if you look at, the total number of policies in force of the industry has been stagnating.
Correct.
The number of policies which are added is good, but only thing is equal numbers get exited, either due to lapsation or due to claims. So we need to grow, and there needs to be a clear net increase of at least 5%. of net lives added every year if we have to touch that 2041
Can
mark.
technology do that?
Yes, towards that, technology has been doing a great job. We have been evolving. And I think that this progress will happen for a few more years when we reach that kind of a stage. But the regulator is also trying to put in place, as they were mentioning, a common platform or information sharing and stuff like that. Technology, leveraging that and going on to make life simple for the customers is going to be a very important game changer.
Right, right.
Technology, can I just come in? Yes. I think we must also appreciate the fact that this industry probably bore the brunt of the COVID pandemic. We settled more than 72,000 crore worth claims in a pandemic year, working from home largely. I don't think anybody would have envisaged a BCP of this nature, but we all stood the test of time and everything was done digitally. I must admit the regulator also supported us in terms of giving us the ability to do digital. End to end, we digitized everything, right from a claim registration to documents to verification to payment. And I think, honestly, technology has already played a very important role in our internal customer processes. I can say very proudly today that almost many of us are seeing 80 to 85% of customer service today on digital platforms.
Right.
My IVR volumes are going down. My call center volumes are going down. Does not mean my customers are contacting me less. Do it yourself is becoming a way of life. And we are seeing that things like WhatsApp, almost 70, 80% customers are migrating to platforms like WhatsApp and Google Forms, etc. for customer servicing. So revolution is already underway on the customer servicing side with Bima Sugam and the platforms for acquisition improving. I think technology at the front end in terms of making it viable for the customer to buy, account aggregator, eKYC, OKIN database, GST data if it's available, we can use it for self-employed accessibility of income. I think a lot of stuff is already there. I think we just need to sew up the pieces.
Right.
And I think
right.
we'll be on our way to redefining the way insurance is purchased in this country.
Right. So right now, it's more servicing part, but the way it is purchased, that area we have to look at. New additions to
integration, I'm saying.
Yeah.
Each of us are doing very well on our own, but we're not dipping it into any common base, whether it is insurance bureau or whether it is the Aadhaar ecosystem, UIDI, or the account aggregator systems. No?
And Bima Sugam as
and
well.
Bima
as it
Sugam.
comes
Yeah. So I think those platforms need to be leveraged more, and we need to drive the usage of these platforms.
Correct.
I think today we have the capability of insuring a person without collecting a single document. We have the capability today. As a percentage to our volumes, it may be single digit. The moment we are able to move it to 25, 30% and more, I think we'll redefine the sector.
Right, right. Now, I have also a question for Mr. Bagchi. Mr. Bagchi, in ICICI Securities, you pioneered the 3-in-1 trading account, where, which gives the convenience of opening a demat, trading, and a bank account. Can we do something similar for the insurance sector?
No, see, we can certainly do it. The big difference between capital markets, banking, which is where it is mostly compared, and life insurance, is that life insurance is a low frequency business. In a low frequency business, the feedback that you get is not that high, and so you can't correct it fast. So banking is a very high frequency business. Capital market is an instant feedback loop. So you put money, whether you lose or gain, you get to know immediately, and there is liquidity in both products.
Correct.
You take a loan, you want to repay, you can repay. You take a deposit, you want to break it and take it away, you can break and take it away. And so what happens is that customers' level of trust and confidence on a counterparty as well as the product is much higher. Because I know that if I make a mistake, I can exit. Now, life insurance, and in general insurance is also relatively high frequency.
Right.
Life insurance is a low frequency product. And when there is a low frequency product, you have to be absolutely sure when you are underwriting or when the customer enters the product that they are going to stay for a long period of time. Because if there is lapsation, it is the customer who makes the loss.
Right.
And they don't feel good about it, obviously. And if you make a mistake on underwriting, because of the regulations, you can't take them out. And so you will bear the brunt of that. And so the data structure and the way data ecosystem has to develop has to be right upfront. You just cannot allow the defect to come in.
Right.
In all other industries, you can allow defect to come in because there is exit route for the defects to go out.
Right.
In life insurance, there is no way for defect to go out. So we have to be absolutely careful at the time of underwriting that defects must not come in. And because in our industry, it is largely assumption and underwriting is not, because there is not much of data, there could be an arbitrage on the risk perception of a single person itself. because risk is going to play out after a long period of time. That also gives a differential in courage.
Right.
That whether the customers can come in or whether the person can underwrite. So I would say that it is similar, but they are not identical. On the processing part, certainly 3-in-1, banking, all those can be done and has been done in COVID times. And so if you see actually life insurance as advanced as any other sector, as far as digital processing is concerned, but as far as risk underwriting is concerned, because there is no equivalent of insurance bureau across verticals, because you have to tie in health.
Right.
Because ultimately what is mortality? See, longevity and mortality, the bridge is basically health. So all the three data have to be combined to get a view on the customer.
Right.
And then you have to get a view on the income. So 4 things, you require KYC, you require income estimation, you require health estimation, because you have to get to the probability. Okay, and then the claims come. All the three have to be integrated. So it's a similar industry. They are not identical industries. So you can pick up things from different industries and use it. Certainly doable on the process side. Much more work needs to be done on the underwriting side.
Right. Thank you. One of the narrative of the life insurance industry in last 6 months or so was the budget proposal of taxing high value insurance product. So I want to know from ma'am that how does that change your product mix, this particular tax decision?
So first of all, while there's been a bit of a distraction, nothing's really changed. And reason is there is no other product by any other financial services provider that can give a long-term guarantee. And we're talking about next 20, 30 years guarantee.
Right.
Bank fixed deposits will have reinvestment risk. Mutual funds will have some other objectives. Government bonds will have GSECs. Public are not really directly buying into government securities and so on. So that proposition has not changed. Right? Second point is that when you look at parity, these products are also now have tax parity. Ultimately, money it will not go under the pillow. Maybe we will defer the decisions for some time, but ultimately people will start making more rational decisions. Some of those decisions were perhaps advanced to March because there was a grandfathering that was going to happen. So now that we've had a 6-month hiatus, and maybe if I can add a little bit of sulking to say tax has been taken away by the customer, not so much the insurer, money will flow. I have no doubt about it. So even in this segment, I'm a firm believer, it's a matter of when and not if that these products will continue to be topical. People increasingly are becoming aware and are aware of reinvestment risk. And some proportion wherein my salary after retirement, that concept is still very prevalent. People buy annuities, the annuities are taxed, this will also be taxed above the 5 lakhs. Below 5 lakhs now is continuing to grow at very similar levels that companies have grown in the past. Now, while we are waiting for this engine to turn, sometimes this Jorka Jhatka is good also, and I'll be the first one to admit, because you've seen the growth in term. So when something is taken away, a line will align to say, okay, let's sell term, nothing's changed there. Let's sell annuity, nothing's changing there. So some of those, kickers that you've seen in terms of growth kickers that have happened. Another aspect is that product innovation. So new products, new relevant products there are, whether it's with wellness, whether it is in terms of insurance for all that we talked about, whether it is in terms of tier 2 and 3 strategy. Today, for example, 70% of our new business is coming from tier 2 and 3, right? Which perhaps might not have been the focus area earlier because, there were relatively, more known markets of salaried, middle class, top 10 cities kind of a profile. Now you are working a little bit harder to go and look at the top quartile in tier 2, top quartile in tier 3, wherein whatever Anup just mentioned in terms of wherein I have some level of information so that I can underwrite.
Right.
But I have to work a little bit harder. So I think to summarize, nothing has changed. Even in the non-par guaranteed segment, it will come back. And some of the other options of pure protection, pure mortality protection, and some of the combination products will start happening. And this is without even, hopefully, health will be allowed down the line it is at least reached up
I
to
will
the
come to
draft.
that. I will come to that in a minute.
Right.
But overall, you are saying that there is not much change in the product mix, but it's good that, I mean, this decision, which you describe as Jor Ka Jhatka, will fuel product innovation.
It'll continue to have product innovation, and things will normalize. When you look over the next couple of years, things will normalize.
Okay, okay. Mr. Balasubramanian, I have one question to you. The IRDA's recent norms on expense of management, do you think that's not giving a level playing field to all the players, particularly who are the slightly smaller players, that large players can take away give more commission to agents? Is that a disadvantage?
See, let me put it this way. Any industry has impact on scale and size and the recency of players, right? So it's very difficult to actually have an industry where all the players are of uniform size and of the same vintage, right? So I think these are some things which will happen as we move towards this regime. Right. Was this regime required? Absolutely yes, right? Because I think it helps market conduct, it helps companies do what they believe is right for a particular distributor or right for a channel. Because ultimately, the expense of management is giving more flexibility. I keep saying this in very many forums. When I was young, my father used to give me 1,000 rupees, let's say, as pocket money when I was in college. Earlier, he used to say, spend 30% on food, 40% on health, and 30% on entertainment. Now, dad is saying, same 1,000 bucks, you decide how you want to spend.
Right.
That's all that has changed. Right?
Right.
So I think it's put the onus on companies now to be efficient. There will be differences in terms of scale and evolution. But I think the regulators also open to looking at those, and if there are any serious anomalies, I'm sure they'll be looking at those anomalies. But to my mind, I think it's one of the best things which have happened in the recent past, because it gives more, responsibility to the insurers to align their business strategies accordingly. So I think differences would be there, but that's expected, I would say. As it is today in a banking also, there are banks which have a 2,000 crore capital. There's another bank which has got maybe 2 lakh more capital, right? So there will be always this difference.
Always there, okay. So we are almost there, one last question, very short answer in yes or no. Should the life insurance player be allowed to sell health insurance policies?
Of course, yes, because obviously we have 26 lakh agents, and we also believe that one of the reasons we are unable to add agents is because we need to probably have better streams of income, more streams of income coming from the same customer.
Right.
Some of us have worked in banks, Anup has been one, I have been in banks, and even Naveen. I think cross-sell, upsell on a customer database is the way retail banking has grown in this world, right? So therefore, if I have a customer, I should have the opportunity to sell multiple products. To manufacture or distribute, we can discuss, but distribution, I'm very firm, it needs to be done.
Manufacture also?
My answer is we are already allowed to do a lot. We can do health insurance. It's of a certain nature, fixed benefit, long term. So I think as an industry, we need to do more with what we have. Second, we are allowed to do a lot with health and wellness. And maybe that's a separate discussion. I think Anup made the point that we are a low engagement industry.
Right.
But health and wellness offerings can make us a high engagement, more attractive industry, more digitally oriented industry which can appeal to the youth and some of the younger segments. So that's the second point. Third, now if the specific question is should we be allowed to manufacture indemnity, which is the only thing we are not allowed to.
Correct.
The answer is yes, we should be. Only because if you go back to 2015-16, we were allowed to.
Correct.
And for some reason it was taken away. And if you look at the penetration of health insurance in the country, same story as life insurance. It's very low. Mahesh said we have agents, we have distribution mechanisms. Today, in Asia, an average Indian has the highest level of spend out of pocket on health. 63 to 65% is the highest in Asia by far. So again, we need to do our bit for the nation and drive health insurance.
Right.
We can do a lot, but we should be allowed to do a lot more as well.
Right. Mr. Bakshi, manufacture?
No, I think manufacture and distribution, certainly health goes more closely with life than property, casualty and motor insurance.
Right.
So whether it is there, it's okay, but certainly it should be with health, life and retirement because it is one continuum. That is number one. Number two, which is what Naveen pointed out, that we require high frequency in the sector to engage, because that is where you get the term and retirement as a bridge through health, and that is very important. And third is whether manufacture or distribute certainly. you should be able to bundle and also manufacture. Because you get more data on the customer, you can underwrite them well.
Right.
And you can underwrite them for the full term. So I think it is yes, for sure.
Mr. Dorai Sabi, will LIC launch a health product if it's allowed?
No, we have been in the health market for quite some time, particularly on the assured benefit part of it. And we are very clear that mortality and morbidity has got a very strong linkage. And an insurance company, life insurance company in health insurance business will also give you better standing in terms of underwriting life insurance, on the data building and stuff like that. But the only requirement I am looking at is the cost of healthcare, which is going tremendously up with the introduction of insurance. The entirely different kind of a billing happening if you are an insured patient and if you are not insured patient.
Right.
That needs some kind of a regulation for life insurance company to be profitable, one thing. But of course, if we have to reach this insurance for all, we have to look at purpose before profit. That's one area which LIC has always been looking at, that's for sure. So health insurance, yes, we should be allowed to do, but there should be enough reinsurance support for that also. That's currently a question to be answered.
Ma'am, I will give you the last word on this.
Yeah, so we have to look at the customer. Look, today if there's a customer X, okay, who unfortunately passes away on a business trip abroad, look at the nominee claim. There's a claim for life insurance that comes. If there was a cardiac ailment, that will come to a life insurer. For health indemnity, it goes to, say, a standalone health insurer. For overseas mediclaim, it might go to a general insurer. Just imagine, it's not about us. No one's thinking for the customer. Just because it is convenient or for whatever reasons, this is how it is. Right. But should the nominee make 5 claims? Right? And isn't there overall in one product, wouldn't there economies of scale wherein we can be competitive, we can customize products? So I think we need to keep customer in center of what we think going forward.
Thank you, thank you. Well, we have completely run out of time and we'll take one question from the audience because the next session, the insurance regulator will announce, will join us. So,
thank you so much, Manojit, for allowing a question. I just, first of all...
Can you introduce yourself?
Yeah, so I'm Praveen Kumar Dwivedi. I represent an organization which works for RBI and SEBI on financial literacy and financial inclusion called Evoke India Foundation. Based out of, we work in North and Pan India, but primarily in UP. And,
can you please make your question sharp?
Yeah, so my question to, I think, this eminent panel is that we all spoke about one common thread, which is awareness, I do a lot of work with villages for awareness on banking products. We do all these linkages also on Jeevan Jyoti Bima and Durghatna Bima Yojana. But in terms of awareness levels, I think what insurance industry and the captains of industry are here, what is the initiatives and being done? So that's where I would put my question to anyone of them.
I'll start with one, maybe others can add. I think there's some development in the recent past, about a year or so, on state level insurance committees. The way SLBC was used in the banking sector to penetrate villages and make banks as the nodal bank and then work with other banks for the particular district. I think there's a landmark initiative done by the regulator of bringing in state level insurance committees, right? So all of us have adopted states. For instance, Kotak has adopted Pondicherry and Tamil Nadu. I'm sure everybody else in this room and the general insurers have adopted. All of us are working very hard at the grassroots level. We are looking at the panchayats, we're looking at villages. We are promoting insurance literacy. We are also promoting healthcare because we think healthcare goes hand in hand with insurance. So all of us are working very hard at the districts. We have also roped in other insurers for every state. So this is a collaborative effort by the industry. So we'll have 2 states where we are the lead insurer and everybody else will be participating. There are other states where maybe HDFC is the lead insurer and we'll all participate as co-insurers. So huge activity is happening and I think along with Bima Vistar, Bima Sukham, that will probably propel more awareness. The others can probably add things which I could have.
I think we have to wind up now, but it was an extremely fascinating discussion. We covered many grounds. Of course, one hour we cannot discuss everything, insurance sector, but extremely thankful to all our panelists. Thank you so much for joining us. Thank you.
Thank you so much, Mr. Saha, for that very thought-provoking conversation. So the insurance companies have set themselves a lofty target of coverage of everyone getting insured by 2047. And the fact that that sum assured to GDP ratio is 25% also gives us humongous scope to improve, and WhatsApp and Google Forms, and doing it yourself emerging as a huge trend in customer service. I think very intriguing and pragmatic conversation and dialogue unfolding on day 2 of India's biggest BFSI summit called the Business Standard BFSI Insight Summit. Ladies and gentlemen, at this juncture, I would request you all to please vacate the hall and go outside in the expo area. For security reasons, we'll be starting our next address at sharp 12:15 p.m. with the chairman of IRDAI, Mr. Debashish Panda. So I request you to please make your way outside to the expo area and please go
as well as globally. To set the context of the theme and the speaker, I'd like to call on stage Mr. Shailesh Dhobal, editor at Business Standard, to set the context. Over to you, Shailesh, sir.
Thank you, Ridhima. Good afternoon, everybody, and very sorry for this power outage. On behalf of Business Standard, let me extend a very warm welcome to Mr. Devashish Panda, Chairman of Insurance Regulatory and Development Authority of India, to Business Standard's BFSI Insight Summit 2023. Mr. Panda is a 1987 batch IS officer of the Uttar Pradesh cadre. He joined as Chairman IRDAI on 14th March 2022. Mr. Panda has served as Secretary, Department of Financial Services, Ministry of Finance. He's a postgraduate in physics and also done Masters in Development Management. He has an MPhil degree in Environmental Sciences, and he has undergone foreign training in public administration from USA and Philippines. Under Mr. Panda as Chairman, IRDAI has effected many changes aimed at improving the existing players' ease of doing business and attracting fresh capital into the sector. Mr. Panda has committed to increasing insurance penetration, and the aim is that every citizen should have an appropriate life, health, and property insurance cover, and every enterprise should be supported by appropriate insurance solutions by 2047. IRDAI has also assigned the insurance companies aspirational targets for a period of 5 years to double the country's insurance penetration. And in order to help them move towards this target, the insurance regulator has taken a series of steps aimed at reducing regulatory and compliance burdens. Many thanks, Mr. Panda, for agreeing to be with us and the trouble you took to travel from all the way from Hyderabad to be with us. May I please request you to please take the stage and begin your address to this audience and thousands who are watching this summit's proceedings live. Thank you very much, Mr. Panda. Yeah. Remove the repeat. Yeah, sure. Please, can you? Should I just move it? Just move it.
So that I can. Yeah.
We're using a podium on this mic.
Want this mic?
Whichever you're comfortable.
No, I think this is fine. Namaskar. Very good afternoon, ladies and gentlemen. It's my pleasure to address this very distinguished audience today, and also I am humbly privileged for this opportunity. I would like to place my sincere appreciation for Business Standard for conducting the BFSI Insight Summit and encouraging free flow of ideas and meaningful conversations. I will try to focus on the major issues that we are going through and leave sufficient time for question and answers that my audience would like to raise. The summit, I think, would provide an opportunity to reflect on the past, to confront the present, and to shape the future of the BFSI sector. In this rapidly evolving landscape, I think it is very essential to engage in open dialogues, foster the exchange of ideas, and collectively address the challenges and also harness the opportunities that lie before us. Ladies and gentlemen, these conversations today have become much more relevant considering the changing global situations, technological disruptions, and the evolving financial landscape. Now, in an era marked by dynamic global shifts, where the tides of geopolitics ebb and flow, the financial services sector finds itself at the intersection of these kind of forces. While at the same time, technological disruptions have ushered a new era of possibilities, reshaping the way we conduct business and interact with our financial institutions. Now, while bringing in innovation and adaptation to change, it has become even more necessary to embrace the dynamism of future while safeguarding, I will underline safeguarding, the principles that have long stood as the foundation of our financial systems. It is time to explore these intricacies, seek common ground, and chart a course that ensures the continued resilience and growth of our financial sector. The strength of the financial sector actually gets bolstered with the existence of a robust protection ecosystem and insurance being at the core of it. And let us understand that insurance is not just a financial product, it is a promise of resilience. It stands as the guardian of economic stability and the protector of individual, corporate, and also economic interests. It enables businesses to grow and expand, knowing that they are protected against losses, and it provides individuals with a peace of mind in the face of life's glorious uncertainties. The importance of this industry cannot be overstated, making it imperative to foster an environment where insurance can thrive, can innovate, and meet the ever-evolving needs of the consumers. The trajectory of the insurance sector, ladies and gentlemen, has been one of profound evolution, spanning across centuries and characterized by a relentless march towards sophistication. Beginning as community arrangement to pool resources in times of adversity, we know the joint family system where the joint family would come up in the event of any unforeseen event. So the modern insurance industry today stands as a testament to human ingenuity in risk management. From the advent of formal insurance companies way back in the 17th century in London, offering structured risk mitigation, to the extensive and diverse range of insurance products which are today available, it's clear that the insurance sector has continuously evolved to meet the ever-changing needs. However, to harness the full potential of the insurance sector and to ensure its continued relevance, development and technological advancement are imperative. In an era marked by increasing interconnectivity, complexity, and rapid change, the insurance industry must embrace innovation and enhance its capabilities, not only to meet the evolving demands of the customers, but also to proactively address emerging risks and opportunities. Policyholders today would demand accessible, transparent, and responsive services. And therefore, it is imperative that insurance companies must invest in streamlining policy process, access, claim processing, and interaction through digital platform, embracing tools like mobile application, chatbots in order to enhance the customer engagement and simplify insurance procedures. Now, I'd like to quote a few instances as how technology is rapidly changing the insurance landscape and creating a watershed moment in the insurance. We all know how the advent of artificial intelligence and machine learning has changed the way we function. Now, these technologies are also creating significant transformations in the insurance sector. Now, by processing voluminous data, such technology are enabling insurers to go ahead with predictive analysis, more accurately assess the risk, determine the premiums, and enhance the overall precision of underwriting processes. This not only benefits insurers by minimizing risk, but also empowers the policyholder by offering premiums reflective of their unique risk profile. This is further aided by the burgeoning landscape of Internet of Things, which has enabled real-time monitoring. Insurers can encourage the use of these devices to establish risk profiles and customize policies accordingly. Now, furthermore, if we look at innovation in terms of wearable devices, telematics, they offer real-time data that facilitates personalized risk assessment, as evidenced in the motor insurance segment. Insurers today, through telematics and wearables, are able to incentivize safe behavior, ultimately benefiting both the policyholders as well as road safety. Likewise, the employment of AI-driven chatbots and virtual assistants in customer service is revolutionizing the insurance landscape. Now, these AI-powered entities They deliver immediate response, they function round the clocks, they free human agents to tackle more intricate inquiries. And that is leading to enhanced customer service efficiency. Now, as we embark on the journey towards a digitized world, cybersecurity assumes a position of paramount importance. I firmly believe that the insurance sector is rising to the occasion by providing comprehensive coverage against cyber attacks, data breaches, digital vulnerabilities, thus safeguarding individuals and businesses against the perils of a digital age. Another monumental change with respect to climate change has also set its sights on the insurance industry. The increasing and frequency of natural disasters necessitates a proactive approach. There is a need to adapt by leveraging advanced climate modeling to anticipate and mitigate climate-related risks. Policies aimed at promoting sustainability and resilience while factoring in climate-related concerns must be developed. The financial world is evolving at a breakneck speed with the advent of fintech, insurtech, blockchain, AI, ML, and we can go on. Times are not far when the quantum computing will become a reality and the current encrypted ecosystem would be a thing of past. We need to remain at the pace of the industry's relentless innovations, and at the same time, we got to be future ready. For example, I am certain that there would be a time when even the need for filing insurance claims would be eliminated. And we have to be ready for such times. Let me quote an example, say in travel insurance. If you have a smart travel insurance contract, which is operating on a public blockchain, it would include the details of your booked flights. It would be programmed to monitor flight data continuously and react accordingly, triggering an instant payout. In case of, say, a delayed flight, using such real-time flight data, so what happens? Simple, fast, automated, and effective. The money is already there in your wallet. You don't need to file a claim. Similarly, in the banking sector, blockchain technology can be used to create smart mortgage contracts. These contracts could automatically execute payment schedules and manage accounts. Say, for example, if a borrower misses a payment, the smart contract could automatically adjust interest rates or maybe initiate foreclosure proceedings, making the process more efficient and less reliant on human intervention. Similarly, if you look at the capital markets, algorithmic trading can react to real-time market fluctuations and news events, executing trades much faster and more accurately than human traders. Another example could be the tokenization of assets, which involves converting the real-world assets like real estate, art, or company shares into digital tokens on a blockchain. This would enable fractional ownership and make it easier for investors to buy and sell these assets. So I think this is the time when the financial sector regulators must take cognizance of such innovations happening in the sector and build such scenarios into the regulatory framework. However, it's a big challenge. The biggest challenge for any regulator is to draft such regulation which can actually foresee, which can predict, and which can provide guidance for the events of the future. We need to create an agile framework which would allow for revisions and adaptations to accommodate emerging trends and risks, and thus to preserve the relevance of the industry, the insurance industry, in an era of rapid technological advancement and emerging risks. The regulatory framework must display flexibility and adaptability. It must be proactive in recognizing emerging risks, and regulation needs to be continuously adjusted to effectively address these challenges. This may involve, revising your capital requirements. It may involve introducing new reporting standards or implementing specific regulations tailored to the emerging issues. So therefore, the sum and substance is that regulation is a continuous job. It doesn't remain static. You've got to be on your toes all the time. Ladies and gentlemen, if we fail to do this, the regulation might become more of an obstacle or an hindrance rather than enabler or a guardian. So at IRDAI, we have started the process of framing regulation through a very, very extensive consultative process, including engaging with the public and the stakeholders. And we finally framed the regulation going through the Insurance Advisory Committee and the authority. Now, what we have done now is every regulation that is framed has got a sunset clause, meaning at the end of the 3 years, the regulation becomes defunct, unless otherwise you go back and get it renewed. But we are also stipulating that before the end of 6 months of the validity of that regulation, you need to undertake a review. Whatever feedback, inputs have been received should be carefully considered in order to bring about necessary changes that would help the sector to grow, and also the regulatory apparatus remains very, very agile and vigilant. So such an approach actually would reflect the dynamic scenarios and would also examine the continued relevance of that regulation. So ensuring adaptability is never an easy task. So there you got to do that fine balancing act. It's about creating an environment where the industry can thrive, innovate, and respond effectively to emerging risks, while ensuring that consumers are protected and the overall stability of the sector is maintained at all times. This leads to the heart of the recent insurance initiatives and reforms that has been started since the last financial year, with a focus on building a progressive, a facilitative, and a supportive insurance ecosystem. Consequently, a new insurance landscape is emerging, emphasizing policyholders' interests primarily, and also focusing on the key pillars like ease of doing business, enhancing the growth opportunities, promoting healthy competition, and extensive technological adoption. This environment would encourage innovation, it would reduce regulatory hurdles, and promote business flexibility. So what has been done is more empowerment to the boards for taking business and operational decisions, and that too independently. Insurance can launch a majority of products without waiting for regulatory approvals and collaborate with multiple distribution partners. The registration regulations, these are the regulations for setting up of a new insurance company, has been revised to allow new entrants and attract more capitals with reduced timelines. A dedicated facilitation cell crops up the moment an application is filed for establishment of a new insurance company. They do the hand-holding to every applicant which is desirous of entering the insurance market. To make the sector future-ready, mission mode teams at the IRD are actively working on industry developments such as the adoption of the risk-based capital regime, the risk-based supervision framework, and convergence to the IFRS. Now, the risk-based capital would enable the insurers to have capital commensurate to their risk profile and also reward for better diversification and risk management. So moving away from the factor-based solvency capital regime to a risk-based capital regime would actually allow the insurance company to more efficiently utilize their capital. Similarly, convergence to the IFRS would enable the insurers to align their financial statements with the global standards, and thus it will help improve transparency and also build investors' confidence. While the industry moves away from a rule-based regulatory regime, it is also important that the supervision framework is strong and personalized. When I say personalized, it is enterprise-specific, necessitating adoption of a risk-based supervision framework. So these three pillars, again, are something which we have taken it up on a mission mode, and work is in progress, and we are expecting to bring it on the ground maybe by 2025. All of this, again, may not be possible without the extensive use of technology, and therefore the insurtech players are being encouraged in a big way. So not only for regulatory purposes, but in every aspect of insurance, technological advancements are a big focus, including we have started the regulatory sandbox experimentation, we have held hackathons. InsurTech mission mode team is working day in and day out towards these objectives. New risk coverage options are also being introduced, like recently the surety bonds, warehouse insurance, and we are looking at other possibilities where new risk coverages can also be brought under the fold of insurance. Efforts are also being made to enhance customer experience. For example, in the health sector, moving towards 100% cashless claim settlement and interoperability with the hospitals. Here, the work is in progress, and going forward, I'm sure the customers will enjoy a very delightful experience as far as health insurance is concerned. Efforts are underway also to strengthen the Insurance Information Bureau as a valuable data source for the entire industry, for the councils, and that will play a significant role in supporting the insurance sector's growth. Proposed amendments to the Insurance Act also aims to create even more robust and innovative insurance landscape with various players catering to different needs and different regions. The focus is on expanding insurance coverage to smaller towns, to the rural areas, to the semi-urban areas, through both physical and digital methods. Phygital, as you may like to call it, involving multiple stakeholders. A state-level insurance plan has been introduced to increase insurance inclusion. Heretofore, the involvement of the state governments wasn't there in the extent which it was desirable. If you look at the banking sector, you have a forum called the State Level Bankers Committee, and it has done a wonderful job over the years. Similarly, a similar arrangement is also being envisaged, and work is in progress as far as the state insurance plan is concerned. The Bima Trinity is also being deployed, which includes Bima Vistar, a simple benefit-based product with parametric triggers to be distributed by Bima Vahak, which would be a localized, women-centric insurance distribution network, and an electronic marketplace protocol called the Bima Sugam. The e-marketplace aims to streamline insurance processes, offering end-to-end solution for policyholders, access to real-time data, and a platform for intermediaries and agents as well. However, the regulatory reforms will not be much successful if the process lacks sufficient consultations, collaborations, and cooperations amongst the stakeholders. The insurance industry is a complex ecosystem that encompasses insurers, regulator, technology experts, and other stakeholders. Now, to maintain an adaptable and an agile regulatory framework, these diverse stakeholders must work in synergy. Such synergies enable the pooling of expertise and insights from the various sectors of the industry. It further fosters an environment where a profound understanding of the challenges can be gained and opportunities can be effectively harnessed. The mutual understanding would allow creation of regulations that are well informed and balanced, simultaneously promoting the growth of the industry and also, most importantly, safeguarding the consumer's interests. Moreover, collaboration allows for a proactive response to emerging challenges. When various stakeholders work together, they can collectively identify and address issues as they arise, whether it is cybersecurity threats, changes in customer behavior, or the impact of climate change, and so on and so forth. Collaborative efforts ensure that the industry is better prepared to adapt and respond effectively. It's also worth noting that collaboration can take various forms. It can involve regular dialogues between the financial regulators and the industry stakeholders. It can be the establishment of industry-wide best practices, or even it could be joint research and development initiatives to address specific type of challenges. The goal is to build an ecosystem of shared responsibility and collective problem solving. At IRDA, we have multiple forums now for such interactions. For example, the quarterly Bima Manthan meetings with the insurers, the monthly open house for all the stakeholders, dedicated open house for insurtechs every month, meeting with the councils and the other regulated entities. Such regular interactions and feedback helps in framing the regulatory architecture which reflects the current realities and it promotes innovation. However, we are also mindful that while promoting innovation is critical, it must not come at the expense of safeguarding the interest of the policyholders and stability of the sector. This is where the second pillar of adaptability lies, the preservation of necessary safeguards. The regulatory framework should establish standards and rules that ensures responsible and ethical conduct by the insurance companies. And for this, a robust corporate governance framework is integral. Such governance standards ensure transparency, accountability, ethical conduct within insurance companies, and also heighten the public trust in the insurance sector. However, no matter how robust the governance framework is designed, its success and efficiency cannot be fully realized until and otherwise the institutions perceive that it is not merely a regulatory necessity, but as a strategic investment. It is an investment made with a clear and unwavering focus on nurturing the long-term health and sustainability of the company, steering it towards a more robust and prosperous future. In order to accomplish this, institutions must embrace board diversity, understanding that diverse perspectives enhance decision-making and mitigate groupthink. They must uphold independence and accountability, empowering an independent board with the authority to question and challenge decisions. Institutions should prioritize transparent reporting, going beyond the minimum reporting requirements to providing meaningful disclosures. This comprehensive approach forms the bedrock of the governance framework that not only adheres to regulatory standards, but truly invests in the company's sustainable success. But still, any regulatory or governance framework, even if adopted fully by the regulated entities in complete letter and spirit, may not be successful if the end customer or the policyholder in the insurance space is not an active participant in the process. And thus, the primary responsibility of any regulator is to empower the customers, keep empowering the customer. This involves actively promoting financial literacy, awareness, and education, equipping individuals with the knowledge and tools to make well-informed financial decisions, encouraging consumers to be inquisitive and to seek information about financial products and services is essential in enhancing their ability to make prudent choices. Consumers should be able to make a choice understanding the product or the kind of value addition that is being made. So this will overall, bolster the integrity of the financial sector. Furthermore, focus should also be on the consumer advocacy groups and organizations dedicated to the safeguarding the rights and interests of the financial services users, thus ensuring that their voices are not only heard, but also heeded. Emphasizing transparency within the financial institution is also another crucial aspect. For example, policyholders should have a clear understanding of what are their rights, what are the policy terms, and how their financial resources are being managed. A case in point is that recently we have issued a customer information sheet. We have made it mandatory for the insurance company. The regulator has made it mandatory for health insurance, which would provide all the vital information of the policy as a snapshot, enabling policyholders to have a clear understanding about their policy as to what is included, what are the exclusions, what are the limits, and the like. Similar exercises in other lines of insurance are also underway, particularly bank assurance, etc. And we believe that going forward, this would empower policyholders, consumers to make well-informed decisions. And I think that will automatically build their trust in the insurance product and the company from which they are buying this product. Additionally, there should be robust mechanisms for dispute resolutions. Now, customers, consumers with the means to address these grievances and dispute with the insurers. Effective dispute resolution mechanism will empower consumers, grant them avenues of recourse, and should they perceive any kind of unfair treatment. So work is also in progress, both at the level of the government as well as the regulator. How do we build a more robust mechanism to address grievances? Regulations should further enable financial entities to operate in the best interest of the consumers, ensuring that their actions are not driven by self-interest, but by a commitment to fairness. As we move forward with the vision of insurance for all by 2047, we must emphasize the adaptability of the regulatory framework and the crucial importance of collaboration in achieving this ambitious goal. It cannot be done alone or in isolation. Our journey is not merely a challenge, but a collective commitment to shape an industry that is resilient, technologically advanced, and consumer-centric, aligning perfectly with the evolving landscape of the 21st century. The vision of insurance for all by 2047 has been set, and it is our resolute determination to see it comes to fruition. The vision signifies our unwavering dedication to make insurance accessible and beneficial to every individual, every business, irrespective of their circumstances. It encapsulates the core principles of the insurance sector as a guardian, as an enabler, and also as a stabilizer. Through the adaptability of regulations and the collaborative efforts of all stakeholders, we will be able to translate this vision into reality. By 2047, we aim to ensure insurance stands as a steadfast companion on the journey to financial security and resilience for all. Now, striking the right balance between regulation and development would necessitate navigating the thin line with agility and precision, ensuring that the insurance sector in India thrives, adapts, and serves the need of our diverse and dynamic society. This challenge is a testament to our ability to uphold the principles of financial stability, fairness, and consumer protection while fostering an environment of innovation and growth. I would like to once again commend Business Standard for facilitating this platform where leaders, thinkers, experts, they all come together, share their insights, and inspire each other. By doing so, we collectively contribute to the progress of our industry, the broader financial ecosystem, and thus the progress of our country. Together, we can navigate the complex currents of change, ensuring a bright and sustainable future for our financial services industry, striking a right balance between innovation and security, responsibility and growth, and above all, trust and integrity. Thank you very much. बहुत बहुत धन्यवाद आपका. Thank you very much. Thank you.
Thank you, Mr. Panda, for that exceedingly informational address. And my greatest takeaway is that collaboration is at the cusp of driving not only insurance industry growth, but financial industry growth as a whole. Over to you, Shailesh, sir, for the next set of announcements.
Thank you, Mr. Panda, for such a rich and brilliant lecture. It's very difficult to summarize it. I'm sure everyone has a different takeaway. For me, the biggest takeaway is the regulators' promise of acting as an enabler for both the industry and the customer to meet both the opportunities and threats that arise out of technology, climate change, the demand dynamics, capital requirements, different business models. So that was essentially the biggest takeaway for me. Thank you, Mr. Panda. Couldn't have been better. And Mr. Panda has kindly agreed to take a few questions from the audience. Can you please raise your hands, identify yourself and your organization, and please be direct, and let it be a question and not a comment. Yeah, the gentleman there.
Hi, hello sir. My name is Sarthak. I am the co-founder of Mitigata Smart Cyber Insurance. From IRDA's perspective, India ranks #2 in terms of cyber attacks. Specifically in terms of cyber insurance and commercial cyber insurance, what is the take on designing the product, encouraging the companies to get more, awareness about cyber insurance, and having the robust mechanism to underwrite these policies? What is IRDA's take on, how exactly the regulators would take it forward, spreading more awareness about it?
I think if you can give us some ideas which the regulator can mull over it and see what necessary guidelines can be given or guidance can be given, not guidelines, guidance to the insurance companies, that will be very useful. You see, we are constantly deliberating on these kind of new and emerging challenges. And I'm sure this question should have been addressed to the industry better as to how exactly, what kind of underwriting practices they are pursuing and how they are trying to minimize the risk. So I think a variety of things are being stipulated through the insurance policies in terms of timely audits, etc., and all other mitigation measures that could be in place so that these kind of risks are contained in the first place. But however, if there are new ideas, we are absolutely open to such ideas. We have, as I said, an open house for the insurtech players in the insurance space. So you're welcome to come and give any presentation or ideas that you may have. Thank you.
Thank you, sir. Happy to share.
Yeah. On my left, please.
Yeah, thank you, sir. Thank you so much for a wonderful address, I think, covering all the aspects of the industry. And just before you, were listening to the captains of the industry, and it was such an enlightening session, let me tell you. I never ever experienced like this. So, you know what my question is, you talked about the last part, because we, Evoke India Foundation, I represent and work in the area of financial literacy, financial inclusion with regulators like SEBI and Reserve Bank. We are implementing their projects. So you spoke about SLBC like a structure which can certainly come at a state level, which will bring all the stakeholders and do a lot of brainstorming to bring ideas. So that is one question, is that how far it is that vision to come fructify, number one. Number two is that at a level much below state, I think at the block level or district level administration, I think this is one area, if we have to achieve the vision of 2047 insurance for all, I think that needs to be expedited. So I would just want to hear from you on that.
Thank you for that very brilliant question. You see, the idea is that, as I said, the effort has to be collective and collaborative. If all the stakeholders don't come on board, then your job is only half done. And I would say that the state governments are a major stakeholder if we have to really push penetration, and not alone penetration, but more importantly, close the protection gap and cover even the person who's sitting in the last mile. For that, technology is the enabler, and as I said, the trinity of the Bima Sugam, the Bima Vistar, and the Bima Vahak. I think much has been already discussed in public forum and even in newspapers and in various groups. And there is no doubt that such kind of a public digital infrastructure will be a big game changer. So that is one. Now, the state insurance plans essentially tries to address your question, where you try to identify state-wise what are the protection gaps, whether it is life, whether it is health insurance, whether it is personal accident, or whether it is property insurance. Of course, the state data will have to be disaggregated, and you have to go down the block level, or even I would say the Gram Panchayat level, then it gets aggregated to the block level, Tehsil level, district level, and then at the state level. So the SLBC concept, in fact, I've already got a request for my colleague, the RBI governor, that why can't we have the SLBC also include insurance, because there is a lot of complementarity as far as the banking institutions and insurance is concerned. So that proposal of mine is already under consideration. Hopefully that happens fine. Otherwise, the state governments, many of the state governments have already taken the initiative to constitute the state level committees, and some of the states have also constituted the district level committees. The district level committees will be a very potent unit for driving this insurance penetration. We have seen that in the banking sector. So that is one. Similarly, the targets will be also broken down up to the Gram Panchayat level. And the Bima Vahaks are essentially a women-centric force that doesn't deny the men entering into that distribution force, but a community, a woman from the community will have the trust, will have the understanding, will be better able to convince the family the need for an insurance product. So the Bima Vistar comes as a bundle product, easy to understand, at a price which will be industry agnostic, which means it's a uniform price across India, and every insurance company will be selling that product to cover the people who are at the bottom of the pyramid. And that's how we are looking at insurance for all before 2047, and also to enhance the insurance penetration. I hope I have answered your question.
You have two last questions. One, this gentleman on the right. Please identify yourself and your organization, and be quick, please.
Yeah. Very good afternoon, sir. I'm Hitesh Dodia from Precision Group. We already serving the insurance industry. An extension to the earlier query where you stated that give us some ideas. I have a couple of them. One is where why don't we, while I say this, I don't want to promote any industry or any OEM as such, but why don't the automobiles have some kind of sensors or some IoT kind of devices already inbuilt? Some already do have, wherein as a regulator you can help the insurer to price the product accordingly, stating that okay, if you have 1, 2, 3, 4 products ticked, then the cost of the pricing of the product will be considerably low. That's one. Second thing is also we have the other regulators like the capital market regulator or the banking regulator stating that they have given us some circulars to safeguard the the already information which is there, centrally stored, like the one when you mentioned about the customer information sheet. So some of the, insurtechs can help in, checking the recent sheet with the already saved sheet which is there. So historically, is there any change? Is the consumer trying to, escape any information or hide information? Also, additionally, the app that these insurance companies can develop can also enable location-based sharing of the user. Then they'll know during the claim whether he was at the right moment or, the whole idea was during the claim. So these are some of the points that I want to just discuss.
You're most welcome. As I said, we have an open house for insurtech players. If you got a technology solution, end-to-end solution,
we'll be in touch, sir.
You are welcome to come and make a presentation. What we do is, post the presentation, we find that it is useful, then we forward it to the councils and ask them to, through an insurance company, file a sandbox application. So you can actually test your product in the market, and once the proof of concept is established, then you are allowed to mainstream. So that is the first thing. The second question with regard to the devices or the telematics, you were talking of, I think, motor insurance, right? So as far as the pricing is concerned, you see automatically that this is open for all the insurance companies. There are 70-odd players today in the market, and we are expecting more to join in. So why should we determine the price? Then it becomes, imperfect price.
Yeah.
So the market will determine the price. And I'm sure with these kind of devices, the costs will automatically, deployment of technology will bring down the costs.
Thank you. One last question. The lady there at the back, please. Someone give her the mic, please. She's standing right there.
Good afternoon, sir. I'm Ekta from Z Business. Sir, अभी आपने mention किया कि एक customer information sheet है. तो क्या ये आपने ये भी बोला कि ये बैंकिंग सेक्टर से भी जल्द ही इंश्योरेंस से भी जुड़ा होगा. ये कब तक होगा? हेल्थ इंश्योरेंस पूरी तरह से कैशलेस कब तक होगा? और जो सबसे ज़्यादा ये है ग्रीवियंस. हर कोई ये कह रहे हैं कि इंश्योरेंस सेक्टर का जो ओम्बुड्समैन है वो उतना स्ट्रॉन्ग नहीं है. अगर हम बैंकिंग सेक्टर से स्पेसिफिकली कंपेयर करें तो वो ग्रीवियंसेस सिस्टम सॉर्ट आउट करने का सिस्टम कब तक रोबस्ट होगा?
मैडम, मैंने अपने संबोधन में ये सारा चीज़ें आपके सामने लाया. पहली बात है कि जो पॉलिसी वर्डिंग्स है वो बहुत ही लीगल लैंग्वेज में लिखा जाता है, क्योंकि वो एक कॉन्ट्रैक्ट है. अब जो आम आदमी कैसे उसको समझ पाए सहजता के साथ और सरलता के साथ, उस दिशा में हेल्थ इंश्योरेंस में हमने ये काम शुरू किया. इसमें काफ़ी समय भी लगा कि हमने उसको पब्लिक डोमेन में भी डाला, ताकि पब्लिक का भी उस पर कोई सुझाव आए तो उसको भी हम लोग विचार कर सकें. तो वो सारा प्रोसेस कंप्लीट करने के पश्चात कस्टमर इंफॉर्मेशन शीट को एक तरीके से मैंडेट किया गया है 1 जनवरी 2024 से, कि कोई भी ग्राहक पॉलिसी खरीदता है तो वो कस्टमर इंफॉर्मेशन शीट में क्लियर रूप से दर्शाएगा कि उसका सम एश्योर्ड क्या है, उसको क्या मिलेगा, क्या एंटाइटलमेंट है और क्या एक्सक्लूजन है. कि बहुत लोगों को पता नहीं रहता है कि क्या इंक्लूडेड है क्या नहीं है. तो वो उसको सवाल कर सकता है, अगर उसे चाहिए कि कोई एक्सक्लूजन ना हो तो उस प्रकार का भी प्रोडक्ट खरीद सकता है. तो उसका मूल उद्देश्य है कि कस्टमर को कैसे हम एम्पावर करें और वो एक इन्फॉर्म्ड चॉइस ले. ग्रीवांस क्यों रेज होता है? इसलिए रेज होता है कि उनको नहीं समझ में आता है कि पहले क्या कवर्ड है क्या नहीं था. तो उनको लगता है कि इंश्योरेंस कंपनी ने उसका पैसा जो सही बनता है वो नहीं दिया. तो ये इससे मैं समझता हूँ कि काफ़ी ग्रीवांसेस रिड्यूस होंगे. एंड गोइंग फॉरवर्ड, एज आई सेड, वी आर हैविंग ए क्लोज आई ऑन एवरीथिंग. वील सी व्हाट मोर वी नीड टू डू in order to protect the policyholders' interests. Thank you.
Thank you.
उस पे मैडम कार्रवाई चल रही है, बहुत शीघ्रता से चल रही है. Not only cashless, interoperability of hospitals, and also all the insurance claims will now get, insurers and the third-party administrators are getting onboarded on the National Health Authorities Health Exchange platform. We have entered into an MOU and understanding. So insurance claim processing also will become completely automated, and faster and expeditious claim settlement will happen.
Thank you so
Thank
much.
you.
Thank you so much, Mr. Panda. Thank you for being so candid in your lecture and the question and answer session.
Thank you very much.
Mr. Panda,
Thank you very
please.
much.
Thank you so much, Mr. Panda, for taking the questions in such a candid fashion. बहुत ही सरलता से और सहजता के साथ आपने अपनी धारा हमारे सामने यहाँ पे रखी. Ladies and gentlemen, we are going to get started with the CEOs of private sector bank session at sharp 2 p.m. in Hall
post-lunch. In the previous session, which was navigated by Mr. Panda, he clearly delineated the importance of collaboration and the infusion of technology in the growth of insurance. And if we really talk about the banking sector too, there's a lot of conversation and insight sharing being shared on the aspect of infusion of technology and AI in the banking sector. And the topic which we'll be exploring in this panel discussion is going to be, do private banks need to become tech companies? I think supremely pertinent and relevant topic again. And to chair this conversation, I think I'd love to call on stage the stellar luminaries from the banking world who have actually made time to be here with us for this stage. So it gives me immense pleasure to call on stage Mr. Amitabh Chaudhary, MD and CEO of Axis Bank. He's coming, all right. And after that, we have Mr. Ashu Khullar, CEO, Citibank. So if we can have your presence on stage. Ladies and gentlemen, you remember that activity that I showed you in the morning, which has immense health benefits, right? So can we do it together? Hands up in the air. And the timing needs to be perfect as I call on stage the next set of speakers. Mr. Hitendra Dave, India CEO, HSBC. Mr. Rakesh Sharma, MD and CEO, IDBI Bank. Mr. V. Vaidyanathan, MD, CEO, IDFC First Bank. Mr. Zareen Daruwala, India CEO, Standard Chartered. Ms. Zareen Daruwala, my apologies, ma'am. And to chair this conversation and maneuver the conversation, I'd like to call on stage Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard. So over to you, Mr. Bandyopadhyay.
Good afternoon. Welcome to the post-lunch session, interesting one. You can see on my right, foreign banks, on my left, Indian private banks. So we have clubbed them together. Amitabh Chaudhary of Axis. Amitabh Chaudhary, Axis, any moment he will join us. And subject is very interesting. In fact, just the previous session when IRDA chairman was talking about, he was giving so much of emphasis on technology, and he was actually referring how even the mortgage loan is getting changed and how the insurance sector also, InsurTech, is changing the life of customers and everything, products and processes and all. So it's a very, globally this has been discussed now. I mean, do we need banks in that old format, or banks should become tech companies? So we are running little out of meaning we are running, I would say that we are late by 15 minutes to start, and the culprit was there was a power outage. You have seen that, so everything got delayed by 15 minutes. So we'll start from there only, Mr. Dave sir. So we'll have a general comment from all of you, and then we have some micro things and all. Given a time, we'll take a few questions, but no grievance addressal question. Okay? And as I said, we really need to quick, almost like quick fire discussion kind of stuff. So Dave sir, to give the perspective, HSBC now, you are reinventing itself, you are into wealth management and everything else. And why probably Ashu, because Ashu has got out of his bank, has got out of corporate, so you want to grab that space among the foreign banks. There are multiple things, I don't know. But tell us about technology. How important is this? And particularly as we speak, one Indian private bank has named the next CEO who has a direct tech background apart from a banking background. Over to you, sir.
So I think, well, thank you, Tamalda, and thank you everyone for joining us. I think it's clear not just banks, but every business needs to be technologically enabled much more than we were historically, right? So whether you're running a little store, you need a QR code, you need new billing systems, new payment systems, cash collection systems. So it's nothing unique. I think it's, all of us realize now that because close to 100 crore Indians now are, whether they are financially literate or not, they are digitally literate now, right? Because of Google Pay, Phone Pay, all these fantastic companies that have come about and taught us as an industry a few lessons. So the answer is yes, and an answer is a no, because the core aspect of banking still remains taking care of people's deposits, lending it out to people who repay you on time,
that process largely will still remains a a classical old style where you make sure that you handle their money with care and you handle it with safety. But the delivery of services, whether it is doing KYC, whether it is assessing credit risk, whether it is enabling payments, that clearly is increasing. The last mile is very, very technology driven. So my answer to this opening question would be yes and no, so that we don't become a complete tech company and completely forget that at heart, people deal with a bank because they feel comfortable placing their money with us. I think, just for the benefit of the audience, I would say that banking is a unique business, right? Many people don't tell their spouses what their incomes are or what their wealth is or where their locker is, but they come to a bank branch, tell a complete stranger who's a teller that please keep this in deposit with me. So it's a business of trust. In our quench for technology, we should not forget that part is what I would open the session with. Trust is the most important word associated with banks and banking. And wherever that trust has got broken, we have seen the consequences for that institution.
Thank you. So technology at best, not at best, is an enabler, but the basic banking being the same. It must be run by bankers. So let's hear Mr. Vaidyanathan, or shall I call you Vaidya? What? Vaidya. Sir, over to you. Welcome, sir. We're just starting. Please. Take your breath. We'll start. So Amitabh Chaudhary, Axis Bank, joins. You see such an interesting combination here. Amitabh Chaudhary, he has made an acquisition recently. Ashu, as a part of the global business, Citi has retweaked its business. So Ashu and Amitabh, in that sense, they are linked. IDBI, its real privatization is going to happen. HSBC reinventing itself, becoming big, wealth management, etc., etc. Under Zareen, Standard Chartered has taken a very different approach, again getting into retail and everything else. And Vaidyanathan is, people say he's a techie, massive investment in technology and all. And he carries his bank and everything in his mobile. So you can't get a better combination than this and a better topic than this. So over to you. You heard HSBC India boss.
To keep a opening comment, like you said, see, banking has these 4 or 5 typical needs. People need savings, people need to borrow, people need to invest, people need protection, and people need payments, transactions. So these needs are time immemorial. I'm sure they were there even 1,000 years ago. That today they'll be tomorrow also. But most of these services traditionally in India have been on the top of the pyramid. So my opening comment would be that as we take this to the bottom of the pyramid, all these services, we will also improve lives, and it will also be a huge banking opportunity.
Very brief comment. Ashu, I'll rather ask you this. You are rejigging your business here in a different focus. You got rid of retail, but mainstay of your thing remains, and with much more vigor and focusing on the corporate thing.
That's
right. So tell us use of technology in that context. Not generally we are talking about retail and the last mile, because they are not applicable to you. So tell us, for Citi, what's the technology mean? Because Citi never sleeps. That's the traditionally we have been hearing.
Yeah, we still don't sleep.
Yeah. But you look so fresh. Huh?
I think it's the lights.
Okay.
So I think, first of all, before I get into the specific question about how we look at technology.
Mike. No, take it.
Yeah. So I think I agree with what Dave said. I think the question of technology is critical to any industry. And I think it's a nice provocative point, which I think a good journalist like you will never miss sight of, Tamaldar. Should banks become technology companies? Frankly, I'll say no. Because I think what technology companies have taught us very well is to take a single problem, go deep, and found a great solution. And I think obviously as banks, we need to try and make sure we partner with them, we learn from them, we are paranoid about them. But I don't think, given the principle of trust and regulation And I think it's almost demeaning, in my mind, to what banks do to try to equate it to just being able to process a transaction faster based on data, right? Because what we do, especially on the institutional side, which is what our business will be now, which is dealing with Indian companies, large, middle-sized, small, global companies, investors, it's a question of building a relationship. And that doesn't happen because you process his data faster. It's because you build a long-term relationship, you build a relationship of trust, giving the right advice. And then, of course, you want to make sure you use the full power of technology to make them more efficient, give better customer solutions. So we look at technology fundamental to our business. In fact, India for us is a major pivot to technology globally. 2/3 of Citi's global tech and analytics is done out of India, playing on the talent card. I think you may have just seen a number of them are coders. So Citi today has 40,000 people who code as a part of their day-to-day job. And we are planning to give generative AI to each one of them in January, because we believe that is going to be a major change in the way we look at world. A lot of the use cases are already there. So technology, absolutely fundamental. And in areas like transaction services, because a lot of people ask us, you sold your retail bank, how are you going to fund your assets? And I think the reason we fund it, and we fund it well, in my opinion, is because we have this incredible business, cash management and working capital solutions, which is all technology based now with UPI, using API, using more and more test cases. So yes, using it, but banks will not become tech companies.
Okay. So all three of them more or less saying the same thing. Amitabh, I wanted to start with you for alphabetically both Axis Bank and Amitabh Chaudhary, AA, but unfortunately we had a few minutes delayed. So, but I'll stick to Zareen as the last Z, and Oman should have the last one and the first one. So, you Amitabh, first preliminary comment.
Thank you so much, Tamal.
Should banks become tech companies?
Sorry for being a little bit late, but
No, it's okay.
well, you know, let me say how we are approaching this whole thing, and then we can decide whether we are a tech company or not. In my mind, as the entire marketscape is evolving, all of us have to think tech first. So it is, I don't know whether we are a tech company, but whatever we do for our customers, ultimately we are servicing our customers, bringing product and solutions to them. Our thought process has to change to think tech first in terms of how do we use technology to make the lives and solutions for our customers simple, easy to use, seamless, you can scale very quickly, and so on and so forth. Now, while doing that, obviously you need to ensure that you have enough people in technology who can understand this, people, tech-savvy people who can combine business and technology together. And if that makes us a bank, a tech company, then so be it. I think the intention is not to be called a tech company for tech company's sake. Yes, you need to have many more people who understand technology, who are comfortable with it, who know how it can be used and harnessed to actually make the life of the customer, which is ultimately what it's all about, better. Some of the things which are missed in this whole definition of trying to define tech is, technology companies believe that their motto is to scale fast, fail fast. In bank, we can't afford that. So we have to be very, very careful from a risk management perspective that we are managing it well. From a compliance perspective, maybe a tech companies believe that they can ask for forgiveness. We don't get a chance for forgiveness. So we have to seek permission, clarifications, and ensure that we are following the law of the land and what the regulators want. So there are some elements, as I think Ashu was also trying to hint at, that it is very easy to say become a tech company or a tech-savvy company or be dominated by tech people. There are a number of elements of banking where you can use technology innovatively to continue to bring solutions, have heavy usage of it, have more people who are involved in it. But to become a tech company overall, I think would be asking for a tall order.
Okay, so there are other aspects like risk management, compliance, underwriting, which the techies would not know. So yes, I mean, soul should remain banks, but the body be tech, that kind of thing. Is that you are hinting
You're
at?
putting it so well, Tamal.
Okay, yeah. Let's hear Rakesh sir. You are a sort of hybrid animal in the banking space. In many ways, you are a public sector. In many ways, you are a private sector. And again, you will be a real private sector sometime down the line, but that's a different question. But sitting in your perch, how do you see technology, sir?
Yeah, thank you. I'll put it like this,
And you are massively into retail. I think you are massively into retail also.
Yeah, massive in retail. Almost 70% is in retail.
Yeah.
So
India
I'll
is
put it
more.
like this, the banks, their core activity, as you know, it's a financial services, advisory, loans, advances, and raising the funds, and contributing to the economic development of the country. But yes, technology is enabler. All those banks who are not updating themselves as per the technological advancement and development, they will not be able to compete with their peer banks. So that is yes there. And as you see, the digitalization during the last almost 6-7 years, 2015 and 2023, if we compare, the digital transactions in volumes has increased by more than 10 times. And the value-wise, it has more than doubled. And RBI, that digital index has also increased from 100 to 395. So that way, digitalization is important, technology is really important, and we have to take the benefits from this. But technology, in my view, is enabler. Now, we have our core competence. And second, the regulatory, I think, as he said, the regulatory, regulations is so strong for banks. So if we go for the becoming technology company, it will be really difficult and risk prone. So the best thing will be, in my opinion, that there are fintech companies who specialize in core in technical activities. We can partner with them and take the benefit, of course, developing our own digitalization, but partnering. And like IDBI Bank has own subsidiary, IDBI Intech company, which handles all our IT part. So that can also be one way. So there is no need to become the tech companies, but yes, we have to make advancement toward digitalization.
Thank you. So partnership is the key. Ashu also to some extent said that you need to partner. Zarin?
Yeah.
Ma'am, you have the last word.
Yeah, most of the points are said. Coming last has the disadvantage. Anyway, having said that, I think technology is a hygiene today. I mean, whether it's onboarding, whether it's credit decisioning, whether it's servicing, I think every bank has made rapid strides. And as Rakeshji said, it's now, digital transactions are 76% of GDP. If I look at Standard Chartered Bank, we have two pure digital banks coexisting with our regular banks in Singapore and Hong Kong. And we find that pure digital banks cater to a certain segment of youth who are very, very comfortable, who actually don't really need, a branch kind of servicing. So there are different models that you can service. It's all a function of what kind of customer segments you have and what kind of customer digital evolution that you have. And based on that, you can offer different models. But it's been a very successful digital bank in Singapore and Hong Kong for Standard Chartered Bank.
So next round, and you said you are disadvantaged because you are the last speaker, so we will start with you only. Okay, it's just fine-tuning. Aditya Puri used to say that you can own a fancy car, IBM, Mercedes, but for that you don't need to really know how to drive. I mean, you can get a good driver. So my question is very specific. Is this, should a techie head a bank, or a banker should head a bank, but under him you have techies? You can do it. I mean, would you like to have a techie can head a bank and he or she can have bankers under him, so that you combine the two? Or it's the other way, the banker is heading a bank because of risk, compliance and everything else, and under him the techies, many techies and all. How do you see? And little thing, what you said, that what you have experienced in Hong Kong and Singapore, does this experiment work? Can it work in India too? Like for, there you have two Standard Chartered Bank, one for general and one digital bank? Because many of the Indian banks are talking about that. We are actually digital for certain section.
Yeah. So my personal view is that you should have a banker who understands, compliance and risk, because that's the backbone. You can always have a very, very high quality tech team which does all the build outs. And I think as a CEO, that doesn't mean that you don't understand technology. I think as a CEO, you need to understand technology and the trends for sure. I mean, today, if you don't have a CEO who has a big focus on risk and governance and compliance, you can almost be risking your license, right? So And having seen the way banks have sort of embraced technology, and most of the CEOs have been non-techies, I would say that that is evidence of how well banks have sort of fast-forwarded on technology, despite CEOs being non-techies. Your question on the digital bank and whether that India is ready for that, I would say in India, most banks have, for example, if you look at Standard India, almost 100% of our servicing is digital, onboarding is digital, large credit decisioning is digital. So to a large extent, I would say we are almost there in terms of our digital journey. We just give the best of both to our customers, digital and branch. And customers have the option to choose the better of what they are comfortable with. To my mind, that hybrid model is very suitable for India, and you can keep on enhancing the digital tools. Any customer who is not wanting to visit the branch today can completely do everything digitally without visiting the branch.
Thanks,
So,
Zareen.
yeah.
So you said you don't need to be a techie, but you must understand. So you don't need to drive your car, but you must should have the license, and you can drive as and when is required. That's the
Yes.
kind of stuff.
Yes, I think you should have, all CEOs should understand technology and the trends in technology also at all
Amitabh,
times.
let's ask you. I don't want you to lose your job. You are doing a great job. So tell me, tomorrow, some days your replacement wants to come, something you would prefer somebody from tech and the bankers working under them, or it's the other way. And of course, how digital you are. Can you call yourself a digital bank?
So firstly, you're making this assumption that a banker cannot be a techie and vice versa. I think you can. I mean, at least I worked in a technology company, became a banker later. So I don't know what you'd call me, techie. A banker, became a techie, then became a banker. But no, I think you have to find the right CEO for the job. And as Zareen has rightly pointed out, that any CEO has to have a balanced view across every element of the business. And today, given the minimum job requirement is, you have to understand risk, compliance, and some of those issues very well. If that is not there, forget about what you are. You'll never get to become a CEO. Or if you do become a CEO, you'll be out of the job pretty quickly. So in that sense, there are some basic requirements in a job, but today where the world is evolving, understanding technology, and I said being comfortable with it. It's not just about understanding and being a techie. Being comfortable with technology is a very, very different, I mean, you don't have to be a techie to be comfortable with technology. You need to understand what technology can do for you, what are some of the advances that are happening there, how it can be applied to your business, and then find the people who can actually apply it. You don't need to do that application, but you need to understand what can be done with it. So I think being comfortable with technology is more important in my mind than being a techie per se. Yes, if you're a techie, you can come up with some more harebrained ideas. Nothing wrong with it. But you can hire the people who can do that also for you. As far as digital bank is concerned, it's pretty much a given. Whether you have a separate license or it is part of the bank, it does not matter. Ultimately, there is a part of the bank which should be thinking digital. I mean, at least when I joined Access 5 years back, we launched a digital banking which was separate. No one had done that. We have 2,000 people working there. We just recently launched a campaign to convert our mobile app into a new brand called Open. So, the statement and the message which you're giving to the market is very, very clear. We do want to create a digital bank within the bank. We want to scale assets and liabilities, at scale, using digital, platform. And we will continue to invest in it as we go forward because we believe there is no other option but to embrace it and actually take advantage of it rather than trying to say, oh, because everyone is doing it, we'll do it. We want to be at the forefront of what is happening. And you will see us doing that not only just in mobile app, but what RBI is trying to do with its innovation hub or what are some of the other platforms which are coming up. We believe, and you will see Access at the forefront of each of those developments because we don't know which one will succeed. We don't know which one will scale up rapidly. We don't want to be waiting on the sidelines when it scales up. I've always said this, when the tsunami comes, you want to be standing in the middle of the river and flow with the tsunami rather than waiting for the tsunami to go and then saying, okay, now I'm going to swim. Doesn't work. You have to be in the middle of it. And so you have to see which one scales up, keep trying, keep trying. When you succeed, you will get ahead of everyone by a margin. And that's what we believe in.
So as a banker, you suffer from some paranoia, like every morning you get up and see that's what?
No, you have to, you have to read a lot, you have to see what others are doing, you have to see what technology can be used. And if you discuss it often enough, you get enough ideas to do on technology. I think last 5 years in Access, at least we've been on a journey. We are quite proud of where we have reached, but we also know that there is so much more to be done, which I'm sure all of the people sitting here on the panel will repeat the same thing.
Yeah, that's what people talk about Amitabh Chaudhary, that if some section 8 says that, sir, we are number one in this, his Then he says, I mean, number one is fine, but kab tak number one rahege, that is the problem. So, is that correct? That's the thing.
We have to look at the glass half empty, not a full.
Yeah, Vaidya.
See, when we, let me tell you the common applications of technology these days, okay, and then I'll build on that. So one of the big things is that all the internal processes that lead you to serving the customer, which are on what we call assisted manner, all that needs to be massively upgraded to be relevant. All the customer-facing interfaces like your app, all that, and what we call in our world DIY, do-it-yourself journeys, they all have to massive upgrades. All employee-facing applications, which are enterprise applications, all of these need massive upgrades. So when we see this, the amount of work involved, and then we see that all our bank has to get connected into all the ecosystems with the Aadhaar or Bureau or ONDC, whatever. So there are ecosystems coming up. So I'm giving you this, the amount of work that is there day in and day out to become more successful in banking. Now for this, you need an organization structure, you need people, rather you need leaders who understand technology definitely. Otherwise, you will have leaders who are running technology for you. You will not know what language they're talking. They will spin circles around you. They'll throw jargon at you like crazy. They will talk cloud, this cloud computing, this, that, etc. And you'll be clueless. You'll run around circles. And you as a boss will only be pleasing them all the time. Oh, I need to keep the person. I need to keep the person. It doesn't work. My sense, therefore, is that after all, end of the day, we're managing people, and people are implementing technologies. So I find that our ability to manage the human resources who are managing technology becomes super important, and even to be able to make organization change within the technology layer, saying that which is the infrastructure layer, which are the applications layer, which are the middleware layer, which are the engineering layer, which are the channels layer, which are the interface layer, the whole stack. If we understand it well, we can do it a phenomenal job. And I really spend time on this because I believe that without this knowledge, I'll be a superficial leader.
Okay. Now, Sharma Saab and Dave Saab, you want to add anything to this?
Yeah, no, I think...
do you also feel threatened by the fintechs and tech fins because the way they are mushrooming everywhere and charging, getting the customers which are not looked after by banks exactly, but they are making very fast inroads, even though quantum may not be very big, but their basis is technology.
Maybe just 2-3 things from my side. I think one is actually the customer determines.
Just hold it.
I think it's the customer who determines whether you serve them digitally or you serve them in the conventional sense. We can't, sitting in our corporate offices, suddenly decide. Now, take an example. You mentioned about our launch of the private bank. Now, we want 10,000 customers. That's it. I'm not going to invest in an app for 10,000 customers. It won't make sense, right? And that person wants to be treated with deference, with respect, with professionalism. It is always going to be in a closed door one-on-one. Or if I have to call on Mr. Chaudhary, it is for a let's say banking relationship discussions. It is there is no digitization in that, right? So, and on the other hand, if you're going to issue 300, 400,000 credit cards a month, there is no way you're going to do it by physically roaming around in streets and collecting forms and all that. So I think it is increasingly the case that the customer determines, the volumes determine, and therefore each bank will have a digital unit within it for certain sections of the market, and each bank will have a conventional channel. If you want to come to the branch and meet the teller and over a cup of tea discuss your family's issues, which is what increasingly our customers do in our branches, they don't come for banking services at all. They just come to discuss their family's matters with our old and loyal staff. That has to be in person. So I think that would be one part. But on the broader issue of, I mean, if the tech person also has capabilities on risk management, people leadership, etc., then so be it. And if the normal banking person, I think it's very difficult to believe there are leaders in any business, any business, who already don't understand technology and its implications. They don't need to be technologists, but they need to understand the implications.
So I can clearly see that he, prefers obviously, at least to that segment of private banking, he wants to give it personal advice through human beings and all that. But if you leave aside his, high-profile customers and his people like us who deal with mass customers into millions, or even HNI-ish customers, but really not the top-notch HNIs. If you see their needs, for wealth management is as much as for the wealthy people. But we cannot afford to give relationship managers to every one of them, rightly so. So we are trying to use technology in a way whereby the common people can get services which the private banking people can get. And that scale can come only through technology. I'll give you one example. Supposing one of his HNI customers, maybe 5 crore, 10 crore worth customers wants to invest in mutual funds. He'll probably send a wealth manager to the customer, and he will probably, he or she, he will probably send somebody, and then he or she will meet the customer, assess the needs, and offer a solution. But we are saying that, okay, we will help you to the common person. We will help, there are maybe, 7,000 mutual funds in the country. We will help you select the best mutual fund, not through human being, but through our algorithm. Now, our algorithm, depending on the age, income, profile, income flow, or stock of assets, etc., can take a good assessment of what is the mutual fund for that customer, which that RM would have done in his case, and can recommend the mutual funds to buy. So in this example again, tech can do the role what human beings do, probably do a better job. And I feel the common person can start getting wealth management services, because for a normal person whose monthly income is 20,000, for that person 1 lakh is wealth. For him it won't be wealth. So maybe for a rickshaw puller even 10,000 rupees will be wealth. So the definition of wealth is different to different people, and tech can help solve the issue.
Sharma sir, you want to add anything? Otherwise,
most of the things have already been said. I will only like to say, this banking is a very vast field. Technology is one part, the risk management, corporate governance, even in lending, retail, agriculture, MSME and all these things. Any person who is heading the bank has to have experience or something in all these areas. Then only he can be a successful banker, apart from, of course, leading from the front, what we say, the leadership qualities. Now, if the technology person also specifically has experience in all these areas, and he can handle. So there is no harm in whether technology person handles or that thing. But he should, having the knowledge of all these areas, then only successfully he can steer the institution. So that is what I will like to say.
So let's shift things little micro thing. Each of the banks, I'll ask you one question. Ashu, I'll start with you. You are a global banker. So what's your global consumer say at this point of time about India? Yeah.
Consumer, you mean?
Yeah, I mean you have global consumers, right? In the overall this thing. What's the perception about India? What's happening in India?
Tamalda again. Consumer, you don't mean retail, you mean global
No.
clients. Yeah.
I don't mean retail, I know.
Yeah. That's just one.
So what's the perception about India?
Make sure you got the memo.
Because we are talking about RBI governor says India is the growth engine, we are the best in terms of everything you see, the inflation and everything else. In the arbitrage between global inflation and ours is now much less. We are very close, and the interest rate stable, economy is growing. So what do your global consumers, not the retail, I'm talking about your corporate consumer, institutional consumer, what's the India story for them?
I think the India story is very positive, right? And I think we've all, for many years, looked at India, many times come very close to breaking out, and then something goes wrong. I think this time, it does feel we have escape velocity, we have the momentum. And I think it's a confluence of factors which is coming together, Tamalda, which are absolute and relative. And I think our global customers are seeing the situation, I think exactly as how frankly, Indian government presents it, how RBI presents it, how us all on this table see the India opportunity. I think there is no other market which has the size and the growth rate which India offers. There's no other market which has a median age of 27, 28, when even China, which has been a growth driver, is median age is 40. So that demographic dividend and the power of that, what it does to your economy size. And we're 5th largest economy. We will be 3rd largest. It's a question of 28 or 29. I think S&P or Moody's recently came out to 2030. Yeah. Now, the other thing which really resonated with my mind, there was a cosmetics global company, he said, I don't care about 1.4 billion people, But even if I can send to 100 million people, that's a Germany. So I think people are very excited about India on 3 parameters in my view. It's India as a market, which is easy to get your head around. It's India as a talent source, which has been driving the growth of global capability centers or service centers. Many of us have our second largest employee forces outside our head offices in India. It's the same for Citi. A number of tech companies and automotive companies I met recently are all trying to put their best product design and R&D capabilities in India. It's not only banking. I mentioned that we have 2/3 of our tech and analytics staff based in India. And the third one is India as a manufacturing story, which is the supply chain diversification story. It's a China plus one story. And there what I think we hear from our customers is China is far too important for them to leave. Nobody's going to leave China. I mean, especially if you look at some of the big German companies, 40% of their value or sales are sometimes coming from China. But they do not want them to be dependent for non-China sales or non-China operations on China. So it's China for China. Now, India, I think, is one of the beneficiaries of that potential supply chain movements. We're not the only one. There's Vietnam, there's Mexico, there's US with their Inflation Reduction Act and CHIPS Act. Everybody's trying to get a piece of that. India is going to get a piece of this action. Now, it's already started off in a very strong way on the electronic manufacturing side. Apple is selling more than $2 billion per month. But this takes time. So I think that's why we have to be careful to start analyzing year by year, month by month data to say, oh, the FDI is flat or the FDI was larger in 2019. Yes, it was larger because Reliance raised, I don't know, $25 billion in 2 deals. But I think the world is super excited about India. Every board wants to have an India strategy. A lot of global boards, as you know, are coming to India. So I think the hype is real.
Great to hear that, Ashu. Great to hear. Amitabh sir, just tell us very briefly, how is the life after the acquisition?
Well, life is going very, very well. Most of the employees who were part of the Citi franchise, I think 97% of them came in. We are almost 7 months into the acquisition, and the attrition rate is extremely low. Customer retention is extremely high. The leakage is extremely low. We are seeing new business come in. We are seeing synergy benefits flow in. So overall, we are extremely happy with where we are. Obviously, there is a milestone which is coming up. Right now, we are working off Citi systems, and we need to transition it to Access systems, which will happen sometime middle of next year. And that's where...
When does that happen?
Middle of next year.
Middle of next year.
So that has to go well.
Next calendar year or FY?
Next calendar year.
Gotcha.
And once that happens, then, obviously we have to ensure that the customers transition to Access very, very well. We are very confident. We are already preparing them for it. And what we're really delighted about is how the employees of Citi can see our platform and see so many things they can do with it. They're already, increasing the share of wallet with the customers they had. They're already doing jobs which they could never imagine, because Citi's platform in India was what it was. They're doing bigger jobs, doing different jobs. So from our perspective, things are going quite well.
Excellent. So by mid next year, entire thing, that the tech transformation will complete. Now, sir, about the timeline about your real privatization. So tell us. I mean, you would say that I am the MD, I would not know anything and all, but you attend all the board meetings.
But I can, yes.
Kahan tak ko chalega, sir, or EOU, I mean, whatever that, your expression of interest, EOI has been this, we have been hearing. Kab election ka pehle hoga, nahi, baad mein hoga, kya ho raha hai, sir? Whatever you want to say.
I'll only like to say that, the process is on. Apart from EOI,
sir, you were saying 6 months.
No, like now recently, I think you would have seen Deepam had advertised for the appointment of valuers also. That valuation process will be on once the valuers are appointed. So, it's a little complete because Deepam is also doing such disinvestment for bank for the first time.
Correct.
And then they have to follow all, CVC guidelines. The system has to be perfect and transparent. So that is why it is taken. The RBI is doing due diligence. They, the entire bank has to be sold to the new investor. So that due diligence is really required. So that process is on. But as Deepam has said, I think quickly it can be done.
You want to talk about who are the prospective investors, etc.? No.
No, no. That I come to know from media only, in fact.
Okay. Okay. David sir, you just tell us about new HSBC, because we have never seen HSBC being so aggressive. You are taking the newspaper flaps, you are telling a lot of things and new products and all. Very briefly, what's the new HSBC?
No, I don't think it's the new HSBC. It's just, I think we're just spending a lot of money. Okay, the easy part we are doing right now, which is spending a lot of money on advertisements, Virat Kohli, sponsorships, events, etc. So the easy part is all done. I think from next year onwards, we now need to see the flow back of customer acquisition. But at a broader level, I think what we are seeing, and partly due to developments in the country, you know, all of us spoke about this wealth effect, right? All of us can feel the amount of number of people who have become, let's call it affluent and mass affluent and wealthy and very wealthy. That population just in the last 4 or 5 years has increased quite tremendously. And that is what typically international banks play at, right? Otherwise, in the very lower down the segment, you do find competition from better players. So that is why what you're calling new HSBC is just a recognition within our management teams that these people need an international bank. They need a bank who can help them when they send their daughter off to study abroad. They need a credit card on arrival. They need an account opening on arrival. You know, India is sending out what? 1 million students plus every year. Half of those will need some or the other service which a global bank provides, and hopefully through these advertisements that thankfully you are noticing, because I still get asked by many people, do you run a retail bank in the country? And I'm saying, this is so many $1 million of ads and you're still asking me. So hopefully we will be able to do justice to that is where.
It's very candid, you know, just, you see, our CEO is saying we are spending a lot of money. Normally people don't say that we are spending a lot of money in marketing. I know you need to leave at 3, you said, so we'll quickly wrap up. My apology to the audience, because we have been running late. She has to leave. We can't just start. We started with 1% minus. Now don't want to end with 1% minus, so we'll end only with all of us. Next 2 things, so you're left, Vaidhi and you. That micro question. Vaidhi, about you. You have invested tons of money in technology. Okay. When you took over, when you meaning that you came over as a CEO and the new entity of Capital IDFC first, whatever you promised to the investment community, you have fulfilled all your commitment except for one, that's the cost income ratio, because of your investment in technology. So can you tell us when do you think that technology will pay off and all? And secondly, you are heavily tilted in favor of retail banks. You are the most retail among the retail banks. If I'm not mistaken, 80% of that is your retail probably, and a substantial part of that is unsecured loan.
No.
Anyway, correct me wrong, I'm just saying. So quickly, if you add this to, I mean, is this the way to grow, or you think you will change the model, or this will be your model? And about when do we see the investment in technology coming up, your cost income ratio coming down? Very briefly, sir, in 2 minutes. I'm sorry because of this.
I'll keep it very
time.
quick. No, the reason why our cost income ratio is high is because the fact that we're a new bank, and to deliver total solutions to customer, we have to provide all solutions that are given by universal banks. So a new bank has to set up savings account which they may have set up 20 years ago. We have to set up a credit card business which they set up maybe 15 years ago. They have set up a cash management system which somebody set up 20 years ago. You have to set up a treasury solution which is set up. So everything is a setup stage of the bank. So branches, you have to put up branches to get CASA. So there is no running away for a setup stage bank to set up all these, and has to be done because we are thinking long, not this quarter, that quarter. So this is the reason why the cost is relatively high and bank is early stage. Now, my quick thing is that it's already paying off in a very massive way. Just to tell you that our bank return on assets was 0 on a core basis 4 years ago. We're already 1%. By the way, 1% is quite healthy for a 5-year-old bank. It's pretty healthy. Banks take maybe 7-8 years to get there. So net, our payback is coming very thick and strong already. And our return on equity on the retail lending business, which is a big part of business, is 20%. 20%. Except that there are liability side branches which are dragging expense down. The short point, therefore, is that we believe that we are setting up a new age bank, and we are at a startup stage. So best to set up on a digital platform which will be able to scale up at time. So benefits people will see over a period of time. I'm genuinely, not just for effect, I'm genuinely not looking this quarter, next quarter, maybe good, maybe bad, that is part of life. But we are looking 10 years, 15 years ahead. And if you want to get there, there's no substitute but to build a good technology bank today.
And you will remain a retail bank?
We will remain a substantially a retail proposition bank. We are a universal bank, like universal I told you about.
Okay.
But yeah, definitely a retail bank, because that space, you'll find it crazy, Tamal. We go to rural India. India has been banking for God knows, maybe 100 years. But any village you go, any city you go, anywhere you go, people don't have credit. People don't have banking, people don't have deposits. So, you know, the other day I went to one small place called Gayazabad in Indore. And we went and visited a village which has some, you know, having cows, buffaloes and all that. We met some bunch of 60 villagers. We asked all 60 of them, 5 years ago, until 5 years ago, not any one of them had taken credit. Now, out of a village of 60 people, 30 people have taken credit from our bank alone, and repayment is 100%. So this is a very crazy big story coming up, and we want to stay there.
Thank you. Thanks, Mari. And ma'am, last question. Again, let's talk. Everybody is talking about retail. Historically, foreign banks in retail rarely has done well in India. You talk about Barclays, you talk about Deutsche, and all. They invested money, lots of money, and they withdrew. If I am not mistaken, Stanchart also invested hugely in retail. But if I see your numbers, the return is probably your 80% plus is from corporate, and then less than 20%. Out of that also, many of them are business loan. So retail exactly is not paying off. You may say it's too early, but at some point, would you also think of withdrawing from retail, or what's the way forward? Very quickly.
No, we are not looking at withdrawing from retail at all. In fact, we are the largest foreign bank in retail, and we have focused on it after I've taken over. And it has improved substantially in performance. And in terms of asset book, it is about 40% now of our asset book. And we want to keep that balance at least at 60-40 or 50-50. Also, it's a great source of CASA for us. And clearly, one of the things that we do extremely well as a bank is wealth. As a foreign bank, we are able to offer a wealth proposition, and we do it really well in my view.
Thank you. My apology to the audience. We can't take any questions because, you know, Reserve Bank of India governance time is fixed, and we need to compress everything within that. I mean, Mr. Dave, Ashu, Zareen, Rakesh Shah, Vaidya, and Amitabh. Thank you. It's a little brief. We could have gone on lots of things to ask, but unfortunately this thing. So the end of the day, the soul remains a bank unchanged. At the driving seat, the banker has to be there because of compliance, because of risk management, because of so many other things and all. There is the Reserve Bank of India watching. But the other part is this, in terms of processes, in terms of reaching out and all. Technology is welcome. That can be done on your own. That can be done through your subsidiaries, or that can be done through partnerships. Is that okay? Thank you, sir. Thank you all. Please.
Thank you so much, Tamal. I'm sure you have asked majority of the questions that the audience were vying to ask. Thank you so much. Ladies and gentlemen, we are at day 2 of the BFSI Insight Summit. Now, one of the greatest takeaway from this session is that banks will need to adopt a digital infrastructure while maintaining a very rigorous trust currency of its customers with solid expertise in compliance, risk, and overall advisory. Ladies and gentlemen, we are going to have the next set of panel discussion in a few minutes from now, and this panel discussion is going to entail all the public sector bank CEOs. So I request you to please be inside this hall to witness another action-packed session that we have planned for you. The big question is this peak set to last and settle as a regular, or does this momentum fade away with time? And to explore the nitty-gritties of this important facet, the topic that I'll be exploring today is, are the good days here to stay? And we have with us a lot of eminent people and luminaries from the world of a public sector bank. So can I request the following set of speakers to please make their way on stage, beginning with Mr. C.S. Shetty, Managing Director, State Bank of India. So if you could please join us on stage. Ladies and gentlemen, I'd request you all to kindly get settled down so that we can have seamless set of conversations going on one after the other. And we'll have to adhere to time. Next up, can I request Mr. Ashwini Kumar, Managing Director and CEO of UCO Bank, to make their way on stage. And Mr. K. Satyanarayan Raju, MD and CEO at Canara Bank, to please join us on stage. And once again, before we get started with this panel discussion, can I request each and every one of you to get settled down? Let's make sure that we pay our time attention to the conversation that's going to unfold on stage. And to maneuver this conversation, we have our very own Mr. Tamal Bandyopadhyay, Consulting Editor at Business Standard. Over to you, Tamal. Ladies and gentlemen, once again, can I request you all to kindly get settled?
Good afternoon and welcome back to India's largest BFSI Summit run by Business Standard. Thank you. This is the public sector banks, and by number, more than 25% of them are present here. You can see that. Only just 3, but there are only 11 of them. And what we have tried last year also, we did that. They represent different geographies. No? Canara Bank boss came from Bangalore, came from UCO Bank from Kolkata, and our own Shetty sir from State Bank of India, largest bank. So subject is this: the good days are here to stay. How long? You know, banker Mr. Kamath had said that this is the best for the Indian banking in the past 50 years. Every quarter you see you are doing better and better and better. What are the contributing factors? You are earning more in terms of interest because your credit offtake has been pretty good for the last 2 years. Your recovery has been very good. You have provided so much, so whatever you recovered, you add to the bottom line. Your fee income also going up. And most importantly, your provision requirement, because of bad loans you had to provide it for, provision requirement is going down. These are the more or less 4 contributing factors. And because of this only, because provision requirement going down, so by default also you are getting the benefit. So in some cases your operating profit is not in pace with the growth of the net profit because of recovery also contributing, etc., etc. So this is the backdrop. Loosely it's the honeymoon, what we say and all. And the twin balance sheet problem, we have overcome that. I mean, corporate balance sheet is pretty strong. And thanks to the Reserve Bank of India asset quality review, you had gone through a very tough time, 2016, 17 and all. But I don't think you regret that because you are now hale and hearty and all. So this was the time, every time we used to say how long the banking system could be on oxygen, etc., etc. But now you are hale and hearty, and the question is this, I mean, how long will it last? Is it for good, or we'll see certain things, etc., etc. So that's and you did the way the stock market is rewarding you. I think all the public sector banks, irrespective of your character, whether it's UCO, whether it's Indian Overseas Bank, whether it's Canara Bank, or whether it's the India's largest lender and one of the top 50 banks in the world, State Bank of India, investors are so excited. And yesterday's market discussions are there that how the PSU sector, PSU banks are doing so well. So just have some preliminary remarks first, and then we will get into certain micro things, the challenges and the opportunities. So probably Mr. Sethi will keep you the last. We'll start with you. And these two, I mean, you took the trouble from coming from Kolkata and Bangalore. Thank you. I mean, personal level, I'm thanking you both. So just tell us, sir. Ashwini sir.
Thank you, Tamal. You have rightly pointed out that good times are there, and the question is now how long, how far, right? Let me put it this way. Currently, when we are speaking here, if you look at the high frequency indicators, how they are moving, like GST collections, like e-way generation, e-way bill generation, that is around 90 million per month. And GST collection around 1.65 crore average per month for last 4-5 months. And your FASTag collections are also hovering around 4,000 to 5,000 crore in a month. Your road build up by the NHAI, that is also at a record level. And if you look at the order book of the PSUs, I was reading one article, that is around 7 lakh crore order book of PSUs. If you look at the order book of 300 listed companies, that is approximately 5 times of their quarterly revenue. So the growth momentum is likely to continue with this all, and the way the government is pushing and encouraging through their budgetary announcements, through the G20 summit, which the benefit we have got. And also, if we look at the PLI schemes of the government, so growth is going to be continue to remain there. And once the growth is there, then definitely there will be a good credit demand for the times to come. And with the growth in credit, the interest income will continue to rise. And yes, definitely along with the growth in demand, there will be a chase for deposits also along with that. And there will be somewhat pressure on the NIM, that will be there. But public sector banks, if I have to say, if you look at the quarterly numbers and half yearly numbers now, they have been managing their cost of deposit well. So going forward, I am sure that the trend will continue. Banks have been following prudent policies, practices, underwriting standards. So the things will continue to shape ahead. Thank you.
Thank you, Ashwini sir. Sir, Raju sir, what's your take?
Good afternoon, Tamalji.
This cycle, how long will it continue?
That's what actually. Before sharing that how long this cycle will be there, to reach this position, the how long we actually have done a good work, actually that makes, that gives you a confidence that how long this cycle will continue. So actually the 2 decades back, because of the new generation banks have come with new technology and all. Initially, these public sector banks were struggling for investment in the technology, meeting the latest requirements of the customers and all. But the last 8 years, the hard work, whatever it has put by the bankers as well as the government as well as the regulator, there is a sea change. The maybe one, the government has injected some corners. People might have told that how long you have to inject the money. But the injecting the money in these is for a good cause. They have changed the working style of that. Maybe simultaneously they have implemented the ease norms, ease reforms. There are so many reforms has happened in that, including from the selection of the topmost board of that, even the total topmost management. There is a sea change in the working of the public sector banks. Earlier, because the public sector banks were not able to meet the requirements of the clients, people used to look at that the private sector banks. But now the public sector banks have come up to there in their both quality as well as the technology or investment. They know that what they require, the client's requirement, they are trying to meet the requirements of those clients. slowly they are started regaining the confidence from the public. So whatever the market share they lost for all these years, I am sure the way it is moving in the present system, the people definitely will come back to them because the sovereignty guarantee, whatever it is there, so what we call it is. You see that the once upon a time it was a seller's market, now it is a buyer's market. And all public sector banks have realized and they have developed their research wings in there inside. Their specializations are there. They know how to do their stress testing frequently. What is happening at globally, if something has happened, and how to take the precautions. All these things, professionalism has come in almost every public sector banks. That has actually they have brought this sea change. It's not that these profits have come overnight. The profits have come for after it's almost 8 to 9 years hard work. Now every public sector bank's balance sheet has been cleaned quite well, and they are focusing on that fee income, whatever the interest income and all, they are effectively managing their cost. That's the reason they are getting the profits, whether it is operating profit or net profit. Again, I would like to answer that the operating profit growth is not in line with the net profit growth. See, the initial stages when the operating profits are at, volumes are less, the percentage of growth will be very high. But when the volumes have been expanded very well, all the public sector banks' operating profits have been expanded very well. So at this level, showing a 10 to 15, 20% growth is a very good growth. That cannot be undermined at all. When you compare even the operating profits of the private peers, so they are competing with that. Since their provisions have come down, as I accepted that their net profits are showing a very huge jump compared to that year on year and all. But the steady growth is there, and I am confident that this steady growth will continue for years together, not coming years, day by whatever it is there.
Thank you. It's great to hear, and I think nobody can deny what you said, that the hard work that you have put in the past few years. Absolutely. Over to you, sir.
Thank you, Tamalda, for having me here. I think it's one of the major BFSI events everybody looks forward to. I think the PSB's performance in particular and the banking performance in general is a combination of many things what you actually narrated in.
Last year's your net profit crossed 50,000 crore, first time in the history,
yeah.
And your net NPA is a decade low,
yes.
right?
Yeah. So I think what we believe, since you mentioned the profit, of course, profit is a derivative number. And there are a lot of things which go into realizing these numbers. And one qualitative change which has happened among the PSBs is that a better appreciation of risk both at the macro level as well as micro level. I think this is a fact which needed to be appreciated. While the macros have definitely supported in terms of the Reserve Bank of India guidelines, the Government of India pushing for reforms, and recapitalization of many of the public sector banks. And more importantly, I think the boards of public sector banks today understand the micros and macros better. I think many a time what happens, we learn from our mistakes. Yes, there were a series of judgmental errors or something which had happened, which had created a cycle of non-performing assets. As you said, the cleanup has happened, and the twin balance sheet problem has now become a twin balance sheet advantage. Both the banks and the corporates have, we have cleaned up our balance sheets and they deleveraged their balance sheets. And both of us are poised for growth. This is about the measures taken both by the banks as well as the regulator and the ownership, the major owner, Government of India, hopefully will sustain this growth for, in market terms, what we call higher for longer, right? So I'll stop there, and there are definitely challenges which you are going to come with, and I'll be ready for answering that.
So all three gentlemen, the bankers from different regions, they say that it's a good time here to stay And we have learned from the mistakes, past mistake. Mr. Sethi was very candid enough. The board has changed its approach, the management has changed its approach, and of course the government support has all along been there. So let's talk about the challenges. I'll start with you on the deposit stuff. You know, State Bank of India continues to pay 4% on savings bank, but there are banks which are offering 7.25, 7.5. There are banks which are offering 9% plus to senior citizen, 9.5%. And under the new insurance law for banks, up to 5 lakh is insured, TICGC cover and all. So if it's not a cooperative bank, if it's a scheduled commercial bank, anybody will be tempted to keep, irrespective of the nature of the bank, it's not the sovereign only. One can keep 5 lakh and multiply accordingly if it's clever enough. Okay. So have you seen in your career, you have 30 plus year, 35 years, something in career, this kind of war on the deposit front, and what is the way forward? Because the savers have so many, savers are not discovering, are becoming aware of the other avenues. As we speak, mutual funds AUM is equal to State Bank of India's deposit base, slightly, probably slightly more. And it's about 48 trillion close to, and 196 trillion is the bank deposits overall. And yesterday all the market guys are pretty gung-ho, it's a question of few years, it become doubles. So in this segment, banking is primarily a liability business. You need to have my money first to give it to them. So how does banking sector, how is it preparing itself for the deposit war? It's no end to it.
Yeah, you are very right. I think, see, first of all, I think the bank branch network itself is a liability franchise. We see the branch outlets as the deposit mobilization points. The delivery of other services, of course, are built into it. It is also true that today the savers have various avenues of investment, not necessarily the financial products, even the non-financial products are there. What we have seen, the shift which has happened is towards the real estate in terms of the avenues like gold or mutual fund, of course, obviously is one of the most important growing financial services product. But among the banks, the fight for deposits will continue for some more time. The structure of banking in India is that the asset buildup is broadly supported by the deposits, unlike overseas where the market borrowings are the major components which support the asset growth. So if any credit growth which has to happen, obviously, the deposit growth has to happen. Coming to the next point, what you raised, what do the banks have to do it? I think
in your career, have you seen this war for deposits?
No, I think, see, we have seen much higher competition for deposits in the past, but it could be handled because the credit growth was not so intense. Today, it gets aggravated because the credit growth is also significant. So the requirement for liabilities is growing. Number two is that a lot of banks also would like to keep their market share intact. Today, if suppose SBI has 21% or 22% market share in deposits, I'm not only looking for an opportunity to grow my asset book by raising deposits, I would like to keep the market share intact. So it's a combination of requirement for liabilities to fund your assets, as well as to keep your market share that actually drives the competition. Then the second point is that whether this competition for deposit is going to raise the cost of deposits. See, we always believe that apart from the savings bank, I think savings bank in our view is an operational account, is not a saving instrument. There is a shift towards from savings to fixed deposits whenever the rate of interest are moving up, and which has happened currently also. We always want to ensure that the savers are compensated properly. That is number one. And the deposit rates are aligned to the market needs. Number two, the interest rate alone will not mobilize the deposits. I think the central point of deposit mobilization, when you have a franchise like State Bank of India, when we have 22,500 branches, what is going to determine is the customer service. And the high quality customer service will ensure that people would stay with you. I think in India or elsewhere, people would not like to change the bank very frequently. While they may change the habit of saving, as it happened in India, I think broadly, even among the private banks, what we have witnessed is, despite the competition for deposits, people are focusing more on enhancing the branch network, increasing the customer quality, adoption of digital technologies, so that the cost of deposits are contained. I think nobody wants to have the margin compression.
Thank you. I mean, you have touched upon a very important component, the customer service, which often the banks don't care for. I think now they are ultimately forced to care for. Rajesh, I'm particularly curious to know your approach because early this year, February, in a western suburb, I found that Canara Bank had gone to this century-old way of somebody on the microphone, on the street, talking about hawking for deposits for Canara Bank. In fact, I did a small video of it, and it went viral on social media. Canara Bank deposits. 90 days, I think 8% or something like that. I don't remember exactly. So over to you.
So I 100% agree with what the CTSR has told, that for public sector banks or any private sector banks, we have a brick and mortar network. We have even a Canara Bank, we have 9,700 crores. And especially tier 3, tier 4 and areas, the people will prefer that brick and mortar system even now. These are all the outlets for garnering the liabilities. Majorly, these are all the garnering for the liabilities. And another one major where I agreeing with the Shetty Saab is the CASA, the percentage of CASA. The percentage of CASA will not always believe that interest rate is the key factor for movement of CASA, whether it's a high side or lower side. By offering a higher rate of interest in the CASA, I don't personally believe that your CASA will increase. Because the CASA is an operative expenses, it involves a huge expenses for the maintaining any customer savings bank account or the current account with the bank. Bank has to invest a lot of operating expenses on that. So they will never think of making the rate of interest at par with the term deposit. Term deposit is a single transaction. They don't need to spend anything. That's the reason actually the offer will be the different rate of interest only. It will never be both same rate of interest will not be there. But then again, I believe that the people who keeps their minimum balances, whatever the required balances to meet that emergencies for the next 1 month or 2 months, only the people will keep that much money in their CASA accounts. They will not keep beyond that because the avenues have been increased a lot. So many avenues have come. Now current days may because of the competition in the market, because of the high credit demand, every bank is going to raise more deposits. That's why they are offering higher rate of interest. That's why there is a slight shift from the CASA to this high interest earning deposits. But otherwise, I don't see that the immediate necessity for the public sector banks that you have to increase your CASA rate so that your CASA will increase. By making a 7% CASA rate of interest on CASA, maintaining a CASA at 50% or even 80% doesn't make any meaning for the banks. Banks has to maintain that because they have to pay the operating expenses. Instead of that, going back to the customer is the right thing. And in Canara Bank specifically, we started introducing a new products, the sector-wise products, salary class. First time we introduced term life insurance to their customers. And we have given pensioners, we have brought some new scheme. In that we are giving them a concession of 25% in their medical expenses, the medicines, whatever it's. That's the sector-wise, you have to identify the demand and you have to create a product. And how that will take care of more of your CASA rather than the rate of interest, I believe that.
Kumar sir, you want to add? Incidentally, banking sector's CASA, I know almost every bank, year on year, has dramatically dropped. I'm not talking about September, I'm talking about June. September probably even further. And in some cases, it's a massive percentage drop. Anyway, please.
See, I agree with both my colleagues.
Sir, if you all agree, then there is no debate.
I'll give you different perspective also along with that. Because these are the main points which they have talked about. My take, I will deliberate on another important aspect about CASA is, in today's scenario, every customer wants all facilities at one-stop solution type of thing, like super app, or so that he is not able to, he is not required to go to here and there for his banking requirements or his daily needs. As we are able to engage him for most of his needs at our app, I think they are not going to shift anywhere, and they are going to, CASA is going to remain strong, because we can, like for a customer, what his requirement is for buying groceries, for buying tickets, buying insurance, buying mutual funds, or maybe dealing with the broking, everything. And also for digital products, making online FDs, taking loan against FDs, or making home loan online. You see, if all these things are available within the bank app, I think then the customer engagement will improve along with the other aspects. Once the customer engagement and stickiness improves, I think CASA will continue to be with the bank. I don't think there will be any need to increase rate or anything, because as we make customer experience more better, I think shift of the customers from the one bank to another bank will not be there. And along with that, if at all we are offering them some differential rate for on different services, I think that will be an added advantage to them.
So an offshoot of this deposit rate war is actually better care for customer. That's what I'm saying. I think everybody here would be very happy to hear that. And you are saying it's 1 or 1.5 percentage point interest rate coming extra. That's just beside the part. But actual thing is this better customer service. So another area of concern or challenge, I would say, and we'll ask Mr. Raju first, is this. We hear that on the banking corridor that there are cracks in the retail segment because of the interest rate cycle. I know RBI had hiked the interest rate from 4.5, I mean, between May last year and this February, 6.5% from 4%. So particularly in the mortgage, etc., there is a massive hike, and if you have not changed the money what I need to pay, actually I am paying only the interest, not even principal. In some cases this is happening. So there are cracks in the retail segment. The so-called SMA, special mention account, where 30 days failure to pay is happening, 60 days happening, 90 days probably not happening, but it will soon happen. And you will see the banks started accumulating new NPAs, fresh slippages, not in a big way, but there will be some beginning probably by the end of this month, end of this year, financial year. Is that the right observation, or I am exaggerating the fear?
No. So I feel that actually the one thing I want to recollect from that before COVID, our repo rate was the same what with the presently what we are having. During the COVID period, to have a control, the government has reduced, and now it has reached back to that. And we were experienced with this type of rate of interest before COVID also. So during that time, the people were paying that. Actually, the people are prepared to pay at the present level. If it is further increased, we don't know what will happen on their income stream and the repaying capacity and all. And another thing, all the banks nowadays, they have a flexibility on elongation of their installments, or either to increase their repayment obligations. So suppose from that earlier they opted for 10 years, now they can increase it to 12 years or 13 years, so that that burden can be absorbed easily. Such flexibility has come in the products. So, and during the COVID also, whatever the regulator has come out with RF1 and RF2, to some extent that has helped public customers as well as the banks also in rephasing those, restructuring of those stressed assets. But now that it has come for the repayment, already every bank has now, they're experiencing it. Some stress is there, but it is well within their appetite. There is no such that it is beyond their appetite. Some stress you can see, but it is well within their appetite.
Seti Sahib, is little theoretical, some stress but within appetite, meaning what? NPA is going up by 50 basis point, 1 percentage point, what? I mean,
no, I think.
Actually, our retail.
I don't know what's your appetite. Like for your appetite,
that's why I'm telling.
No,
that's what I'm telling. Our retail NPA is 1.65%. And what we have seen increase is only in the educational loans. We have seen the increase in that, but we have not seen in that. And as a specifically Canara Bank, we don't have much exposure on the unsecured retail
fair enough,
exposure.
sir.
That's
And
why
you
we
are
are
a
not
listed-
seen on that.
You are a listed entity, so I will not force you to reveal any secret. So tell us, sir. Set it up. You tell us, because you are a proxy for Indian economy. Do you see some cracks? When you do, you meaning State Bank of India nahi, for the industry as a whole?
I think whenever we evaluate the retail book, each of these banks have a different set of retail book. I think it's broad brush approach that, the whole retail book is bad, or retail book is under stress is I think overstatement, number one.
Sir, no diplomacy. Just सब बोलिए ना, कुछ हो रहा है क्या?
No. See, I think the second piece is that interest rate increase is definitely will have an impact on the ability to pay the EMIs. But it all depends on when the banks have acquired this portfolio, whether they have acquired the portfolio during the low interest regime, or as Raju says, it is a longer term. But there are two important factors, Tamal, that I think we must remember. One is my understanding, at least among the public sector banks, the two positives in the retail book. Retail book, when we talk about retail book, as you said, it's not unsecured personal loan, I think, which is much talked about. But it is a whole gamut of retail loans which we have, mortgages. What we have noticed is that in case of mortgages, for example, all our personal loan products are moderately priced. I think this is one thing which we must remember, number one. Number two, the loan to value ratios on the mortgages are very modest. For example, in SBI alone, the loan to value ratio for mortgage book is 55 to 60%. There's a sufficient equity for the borrower to get motivated to pay. Number three is that we are very strict on the NMI to EMI ratios. If you are not taking care of these three guardrails, the book is going to be behaving, in a different manner. So this is what I think we need to understand, that the book has to be evaluated from what kind of acquisition strategy you have as far as personal loans is concerned.
Personally, State Bank of India is, you're not seeing any
I'm also
stress.
a listed company, Tamalda.
Huh? Okay, so you said it. You said it. Sir, boliye.
Sir,
Do you see any crack? Just be, it's within the closed door we are talking.
Yes. I'll share.
Oh, there's no closed door, okay.
See, if you talk about rate of interest hike, I think the last rate of interest hike was somewhere in February, if I correctly remember, February 23. Since then, there has been a pause. And
February, yes.
From February to October now, around 8 months, we have been getting reasonable payments from EMI payments from our customers. Second data point which I would like to share, if you look at the SMA figures of our declared results from different banks, that has not been increasing, there has been a declining trend in SMA figures as well. Third thing which Rajuji talked about, that banks have taken a strategy either to increase their tenure or to go for a revised EMI, and many of the customers have accepted revised EMI as well. Fourth thing which I would like to highlight is that the income levels during pandemic were different. Now the income levels have gone up, so the capacity to pay has also gone up. So based on these things, I am sure that things are not as bad as we are expecting. Things are under control, and I don't see any big impact of this increased EMI or the SMA levels in the times to come.
So there is some impact, but not which
will
bank,
be
and as he correctly said, that
Maybe.
according to your appetite, you can manage it. Yeah. So we don't need to explain what all of them are saying here. There is some. I mean, it's a question of semantics. Call it crack, call it slippages, call it little bit of, but there is something, but which is manageable, right? We are actually a little stressed of time because in between there's a power cut here and all, and RBI governor thing, we have to stick to that. Before that, we have a one-on-one conversation with SBI chairman only. So we'll quickly wrap up. Is there any question from anywhere? One question. There is no customer complaint, huh? Because already he said that customer now is the thing. Yeah, this gentleman, just if you get that, just one question we'll take, and then just 1 minute each we'd like to hear from you, and this will end. Quickly, just one quick question.
One quick question, sir. Actually, whenever we see PSU banks to compete with the private banks, they are 2 steps back.
Okay.
Now, when we are coming up with the co-lending function, why don't we see PSU bank more aggressively working on the co-lending to cater those business which have not been catered so far?
Okay. City sir, you want to answer?
No.
Making a very serious allegation, 2 steps back. Let's, whether you can...
No, I think he's been, generous in saying that it is 2 steps back. But we must understand that co-lending need to be a system-driven approach. I think most of the public sector bank, including State Bank of India, believe that unless we get our technology right, our reconciliation system right, our product parameters are aligned properly, the co-lending arrangements just having on paper is not going to really help. Our idea, we truly believe that co-lending, as you rightly pointed out, helps us to reach to the segments which we are either incapable of reaching or is not efficient to reach to them, cost efficient. Co-lending would be a right model to approach, but it has to be understood properly, parameterized properly, and delivered properly.
For the time, my apology again, because there is not much of time, so we'll just have a last round. We'll start with you, sir, and this thing and all. So you have convinced us that things are okay, things are much better, and that has not happened overnight. You really worked hard, the banking system and all. That's one part of it. At the same time, I mean, you are not being explicit, but yes, there are certain areas of concern. We have discussed that. But all the things are leading to one thing, that you have started caring for customer more because of the circumstances. Starting with you, just 2 questions I'm combining for time's sake. Just 1 minute each you can answer. What can go wrong? What can go wrong? I'm just saying, what can actually abruptly end this cycle? Is there any concern? Because we know geopolitics, we are talking about FDI flow. I'm not talking about from the stock market's perspective. I'm talking about your health perspective. What can go wrong? And second is there anything you can expect from the government? So there was a time of recap that you have got money. There are a lot of talks whether taxpayer money be used or not, but that's history now. You don't need money. You are sufficiently capitalized. Government also trying to help by elongating the tenure of the bosses, and also your retirement age also. So government, is there anything else the government can do? You think that? Any expectation from the government? And what can go wrong? This combination, 1 minute each. We'll end it. Sir.
See, if I have to answer it, let me take you through the level of NPS, because only one thing bank worries about the level of NPS to go wrong in the times to come. As in the initial remarks, Rajuji told that we have learnt our lessons from the past. We have built our risk management practices. Our underwriting standards have improved a lot, and our onboarding through digital channels, more and more data analytics have come into play, and probably going forward the data will be playing more as a collateral than the tangible collateral going forward in the times to come. So the way the banks have built up and recalibrated themselves over a period of time, in the present situation, I don't expect anything big to go wrong in the times to come. And as far as government is concerned, they have been supporting the banks in the bad times. I think in the good times, it is now our turn to support the government by way of a dividend and everything.
Again, earlier also once I discussed with you that the private banks and public sector banks comparison, personally I don't agree with that, because that is a profit making, this is a social banking plus profit making. The roles are different and we are playing that very effectively on that. Straightforward in 2 words, I will say that there is no question of when, again, facing an unexpected threat or anything in the near future, no, literally. The second one, going back to the government for any support, again, I can say confidently that these 11 banks are 12 banks are self-sufficient. Now they are very much confident that they can raise funds if necessary from the public itself. But whenever they are coming to the public, they are raising that funds in the 3 times or 4 times. And literally near future, the dependence on the government will be zero.
Thank you. Sethi sir, what I meant from government, not the funds, but the other thing like they have extended your tenure, they have extended your retirement age, something else. Anyway, sir, over to you.
I think
You have the last one.
I think broadly the government support is very well appreciated and is available. There's nothing much we are seeking in that context. But I think what can go wrong is I would like to take 2 things. One is the proper definition of our own risk appetite, and sticking to that risk appetite is very important. I think we have, all over the world, banks have gone into trouble only when they have not defined what is their risk appetite, and more importantly, the governance to stick to it, number 1. Number 2 is that under-appreciation of the investment in the right technologies. I think if public sector banks, or for that matter any institution here, particularly in the BFSI sector, if they fail to understand where to invest and how much to invest and when to invest in technology, if they don't appreciate this, I think they're going to have problems.
Thank you, Mr. Sethi, and thanks, the 2 gentlemen. You have come from Bangalore and Kolkata. I honestly, I have not seen bankers are so candid, and you are so, I mean, you spoke your heart out. What are the issues and all, Mr. Sethi, particularly you just say that on technology and all. So there are lots of other questions to ask, but unfortunately we are running out of time. So essentially, the good time is here, I mean, to stay. Even when the tide turns, you won't find any banks naked. That's what you are saying. And I wish, all of us wish your honeymoon period continues. And we want your honeymoon with customers particularly, because customer is one very important constituent, but I don't think the banks really do care much. I mean, it's very great to hear that all of you are now talking about customers. I think you have been forced to talk about, so that's a separate story. Otherwise, you take customers for granted. So I think for their candidness and so frank, and I will not call it confession, but everything they said, I think from the dil se bola. So usko jor se taaliyan bajaiye. Thank you, sir. Thank you. We have SBI
Thank
chairman.
you so much, Tamal.
We have SBI chairman immediately after this, and then after that is whoever all you're waiting for, Governor Shaktikanto Das.
maverick and a trailblazing pioneer who actually needs no introduction. A, a maverick from banking industry who deals with behemoth scale, scope, complexity, and massive volumes at every minute of his professional career, spearheading the largest bank in India while also being one of the most big employers in India. To say that he spearheads the philosophy of being a banker to every Indian would not be an understatement. Ladies and gentlemen, can you give a huge round of applause for our speaker, Mr. Dinesh Khara, Chairman at State Bank of India. And joining him for this fireside chat is going to be our consulting editor, Mr. Tamal Bandyopadhyay, consulting editor at Business Standard. So can I request both of you to please make your way on stage?
Hello and good afternoon and welcome back to India's largest BFSI Summit. And at this point, we are with the India's largest CEO of India's largest bank and the only Indian bank which by assets one among the 50 top global banks. It's 4:15 now, 4:45, half an hour just heart-to-heart or candid conversation, fireside chat, whatever you call it. It's just very informal. That's all, sir. Is that okay? Perfect. And after that, we'll have RBI Governor to end this two-day grand summit. So she spoke a lot about Mr. Khara. In fact, one person among us, I will not reveal his identity, he is neighbor and schoolmate of Khara also sitting here. So I know about Mr. Khara from him as well as State Bank of India's history. In the 200-year plus State Bank of India's history, what goes to Khara Saab is he made 50,000 crore net profit last year, highest ever, right? He is also the second chairman in India State Bank's history to get an extension beyond his retirement term. So, welcome Mr. Khara Saab. We will, probably some repetition, but the biggest thing that's staring at Indian banking system at this point of time is deposit rate, war on deposit rate. I am aware that you have created a new position called Assistant General Manager, Deposit, for every zone of State Bank of India. So you are a SBI from the beginning. In your entire career, have you seen this kind of war for deposit? And what is your preparedness? Are you like other bankers said, it's the customer connect that is more important, not the interest rate? Or you think that no, your cost of money will go up? How long it will continue? Can you tell us, give us some sense?
Thank you, first of all, Tamalda, for giving me an opportunity to be in your most important event in the financial sector. Well, when it comes to your question relating to having created a new position, even at our zonal offices, the philosophy behind that is that Indian economy is evolving, is moving from the developing to the developed state. And when I talk about that, deposit is actually the raw material for any bank. If at all they have to grow, they have to generate income, and interest income is the most important. And having said that, unless and until banks are in a position to mobilize deposit and that too at a right price, mobilizing deposit is not a challenge. One can raise deposit, but at what price the deposits are getting raised, that is very important. Because that will eventually decide the trajectory in terms of the lending also. So, in an economy where we are today, there is a competition on both the sides. It's not merely on deposit sides, but there is also a competition for picking up the right assets. So, in order to ensure that the right assets are picked up, one has to keep a tight control on the cost. And having said that, we have to be very cognizant of the fact that thanks to the efficiency in the payment system, the float left out in the economy is hardly any. Be it government, which is now practicing just-in-time funding of the accounts, and be it corporates who have got evolved treasuries, and they ensure that they should be in a position to optimize whatever surplus funds they have in terms of the income which they generate. So these are the stark realities in which the banking system has to operate. So in that context, for a bank like State Bank of India, with more than 22,500 branches and almost about 500 plus regional offices, we serve a very varied customer base. They have very different set of needs. And as we are also known for the trust, so we have to ensure that we showcase the right set of products to them. That is one of the reasons why we felt that perhaps a customer who is operating in Bombay cannot be compared with a person who is operating in one of the upcountry locations, and their needs will certainly differ, and they would have different set of preferences when it comes to the asset class. So in order to promote the idea of having an appreciation for the customer's preference for asset class and guiding him appropriately in terms of where they should look at for the appropriate asset class, this particular position was created. Having said that, we continue to have perhaps one of the highest CASA even today. While I am saying so, I am very mindful that we have to really fight to ensure that our market share in CASA is maintained or even improved. So we are evolving our strategies to meet these requirements of the customer and also of the bank. So that is one of the reasons why we created this position.
So, sir, Khara sahab, is there any, do we see SBI, State Bank of India offering more than 4% per savings bank account? No, it will never happen.
As I mentioned that we have to have a tight control on the cost, if at all we have to underwrite best of the risk. Naturally, we may not be offering the higher interest rate, but when it comes to the add-on frills which we are offering, that is something which is helping us in ensuring that we continue to create value for our customers.
So your advantage you have over others probably that you have a massive investment portfolio which you can probably liquidate and generate liquidity if there's required like that. So what will be your credit deposit ratio at this point of time?
If we look at our domestic book only, then it would be somewhere around 64-65%. But if we include our overseas book, then it would be around 72%. But yes, of course, for all purposes, domestic book is somewhere around 85% of our total balance sheet.
Yeah.
So to that extent, we have a sufficient elbow room in terms of ensuring that we have sufficient liquidity available always to support the growth ambitions of the bank.
Your balance sheet is about 60 trillion now?
Our balance sheet is, about 700 billion, about 60 trillion.
60 trillion, 60 lakh crore.
60
right?
lakh crores.
That's your balance sheet. Sir, I have been asking all the bankers in this panel and all.
Actually, the way I look at it is that we represent about one-fifth of the economy.
20%, yeah, 20%.
So that's how it should be.
You are a proxy for Indian economy. That's what every Indian's banker and all. But tell us this talk about whether it's myth or reality. That you call it crack, you call it slippage. It's a matter of semantics. But in the retail segment, bankers in private, some of them are saying that there are certain issues that so-called SMA1, SMA2, meaning people are not being able to pay off for within 30 days or 60 days. So it's a question of time before we will see some kind of probably manageable, quote unquote, but rise in bad assets or NPAs. Is that correct assessment or I am wrong?
Much of it will depend upon the quality of book which has been underwritten and also the past experience of the bank with the customers. So I think these are some of the determinants which actually define what the stress could be in the retail book. And what we have observed is that when it comes to retail, it looks very easy to underwrite. But the way I look at it is that one should have very elaborate structure in place in terms of sourcing, underwriting, then control and follow-up, and effective recovery mechanism. To my mind, these are the 4 pillars. Unless and until the bank invests well in these 4 pillars, they might run a risk of delinquencies in the retail book. So I think one has to be very mindful in terms of what should be the LTV. One has to be very mindful in terms of what should be the credit score. And one has to be mindful in terms of how the account is conducted. To my mind, this is the recipe of ensuring much better quality in the retail book.
SBI, as we speak, September quarter result you have not yet announced, but June quarter your NPA was a decadal low, right? I think net NPA was less than 1%. Will this thing continue, or do you think no, in the passage of time, next few quarters we may see slight slippages there?
Well, when it comes to NPA, this is a function. There are 2 components. One is the real economy, and second is the practices being adopted by the bank. Yeah. So on this particular aspect, I would say that banks have significantly strengthened their underwriting practices. And when it comes to macro, I would say that macro is doing well. So there are hardly any challenges. But at the same time, I must also mention that at least as a bank, the practice which we are following for quite some time is to ensure that our balance sheet should be shock-free from any such asset-related stress. And we are rather, I would say, much more pragmatic in terms of providing for, or maybe more aggressive in terms of providing for any likely stress in the balance sheet. So I think as a bank, I would say that I would not see any concern relating to the asset quality in the foreseeable future.
Great to hear that. What is the provision coverage ratio, Kharasa, for State Bank of India? Provision coverage ratio?
Yeah, we are at about 92-93%. If we look at the corporate, our provision coverage ratio would be as high as about 96-97%. But herein I would like to mention that when it comes to our retail book, our gross NPA is somewhere around 0.70.
Oh, gross NPA is
Gross NPA is 0.70.
Oh, wonderful, wonderful. Great to hear that from the India's largest bank. So tell us, we had a special session actually, the entire session of the private sector banks were dedicated on technology. Should the banks become tech companies, should the bank have? So tell us, State Bank of India, you were among the public sector banks. I mean, of course, you are governed by a different act under the, not like other banks who are governed by Bank Nationalization Act. Your SBI Bank is different, but you are government-owned, majority government-owned. But you were probably the first one to adopt technology in a very aggressive way. That's what your platform. At some point, your predecessor spoke about actually hiving off, into a separate subsidiary, etc., etc. My understanding is that you have taken, overseas also for State Bank of India, also plan was there. So tell us, is that, I mean, you wanted to spin it off in a different way. So is this, are you complete when it comes to technology, or more things need to be done? I know technology is an evolving subject, but as of now?
No, I think it's a continuous effort to upgrade ourselves as far as the technology piece is concerned. Because when it comes to the customer centricity and meeting the customer's expectation, they are always evolving. And in order to meet those expectations, we have to invest into the technology. We have, when it comes to the customer base, we have the proud privilege of serving 480 million customers in the country. So for all purposes,
48 crore.
48 crores.
So roughly 1 of 3 Indians your customer.
Yeah, I would say that we proudly claim to be the banker to every household, keeping the family size of 3 in a family.
48 crore customers.
Yes. So that's why I'm saying that it's a proud privilege which we have. And herein I would like to mention that when it comes to our digital footprints also, 84% of our transactions are digital today. 97% of the transactions are happening outside the branch. And also, I must also mention that the YONO which came into existence in 2017, today we are at about 70 million customers are already registered users of YONO, and almost 10 million customers are logging in every day. So that is the kind of a volume which we handle. And of late, last year we had underwritten more than 1 trillion through YONO, end-to-end digital, and we are expecting a growth of somewhere around 25 to 30% in this year. So this is the size which we have created, but our ambition is very clearly to create a digital bank within the bank. And with that in mind, we are embarking upon our new journey, which is YONO 2.0. Herein our effort is to step up our computing capacity, our pace at which we can deliver, and also we will come out with the modular structure. We will be in a position to leverage analytics, and also we should be in a position to offer the next best product to our customers while they are on the go.
What's the deadline for this?
We expect that we should be in a position to have the early experience of YONO 2.0 within, say, about another 8 to 9 months.
So we are discussing digitization and digital banks here. State Bank of India chairman is saying that within State Bank of India, there will be a digital bank in the next 8-9 months. Let's shift to another very important issue that not too people talk about, that the HR issue, the attracting talent and retaining talent. Private sector banks in private say it's a very difficult task to retain talent and attract talent. Money will not keep them happy. It's the challenge that's what need to do. So do you also see the same thing? Because at some point of time, people used to think that, there are young youth. I'm not talking about that marriage market, SBI certificate would have been better. But I know a lot of people who preferred State Bank of India to civil service. But is it true even now, or you are finding it difficult to attract and retain talent? Because you can't pay them as well as the private sector pay.
I will just give you few broad indicators. We have advertised for probationary officers some 2,000 odd positions, and we have got 700,000 applications already. One statistics is when it comes to the comparison in terms of the success rate in the common admission test for the IIMs and the selection percentage in the State Bank probationers. Actually, our State Bank probationers percentage is much lesser as compared to the common admission test for the IIMs. So that very clearly reflects that the brand has got is very well received when it comes to the younger generation also. Now the second important indicator which I must share with you is relating to, we have got a cadre in terms of people come in at an early stage as an associate or as a probationer. Otherwise, over the period of time, we have identified the skill gaps and we have started hiring from the market on the market related salaries. So we have seen that we are in a position to attract best of the talent, and not that they are looking for a short-term horizon. They come, stay with us and really enjoy working. So that is a very clear reflection that the kind of scale which we offer in terms of the complexities, in terms of the challenges, and I don't think many other institutions offer that kind of a scale. So that is one of the reasons what you mentioned in terms of you cannot buy the talent through money only.
Right.
We pay money and as well as we offer them challenge, and that is one of the reasons why we are in a position to attract the best in the industry even today.
Yeah, I am aware that you do take people from market. In fact, in the second time in SBI's history, you have taken a gentleman as a deputy managing director, right, on technology, etc. So good. But a related question, you have only provoked me to ask you this. SBI Act does not allow you to take a person back Meaning, if I am an SBI employee and if I leave tomorrow, day after tomorrow, if I want to come back, you cannot take me back. Is there any thought on this? Would you like to change it? Because I'm sure there are many people who left State Bank of India, got richer by experience, and they want to come back.
I think as far as the Act is concerned, there is no such provision. This could be more of an internal rules, which could be there. It is not something which is restricted by the Act.
Yeah.
So, but as I mentioned that, what we have seen is when it comes to attrition, perhaps we have got the lowest attrition. And normally, we have seen that people leave at a very early stage only, and thereafter, if they stay on for about 5-7 years, they don't leave, because looking at the kind of variety which we offer, we are not merely a bank, we are a financial sector superstore, because we offer opportunities to our employees to work in all the subsegments of the financial sector, and also they can get into technology, they can get into treasury, they can get into credit, they can get into wealth banking, you name it. And that is one of the reasons why we may be continuing with under the same banner, but when it comes to the role and also the variety of role, that probably gives employees enough opportunities. And what was mentioned in terms of not taking back, maybe over the period of time, as of now we don't have that, but just because we don't feel the need, we are in a position to attract talent otherwise.
Okay.
Maybe those who leave, they are missing out the opportunity, it is their decision.
Okay, that's pretty frank. Tell us, one of the other things that we are discussing is that the customer service. Typically Indian banks are not, and this is true about not only India, probably in some other places also, that customers, you don't care for much, you take it for granted, I remember you were trying out one experiment called Ratri Shibir, where you are sending your senior senior executives spending overnight in hinterland and getting a feel for the ground, etc., etc. So has it succeeded? I mean, is your approach to customer service is it changing? Does it need to be changed? What do you say about this?
Yeah, we started this Ratri Shiva sometime in the year 22, July of 22, because we had a challenge of COVID before that, and we could not really connect with the customers as strongly as we started doing it from July 22. And this was essentially an effort to ensure a connect in the hinterland of the country. So we have seen decent traction out of that in terms of the better customer behavior, in terms of repayment, better customer selection in terms of when it comes to the rural credit. And also, I must also mention that apart from this, we also started evaluating our various branches on the Net Promoter Score. And that is something which has created a huge competition in the mind of our employees for improving their Net Promoter Score. So I think it's a multi-pronged effort, and as I mentioned, that improving digital offerings, offering customer convenience, improving interaction on ground, reaching out to the customers. So we have taken multiple such steps, and I think there is no meeting of our senior executives with our team members which goes without emphasizing on the importance of the customer service. And if at all there are any complaints which are received, they are being addressed in a very, very systematic manner. And it is not merely, any complaint is not reckoned only as a transaction. We look into the root cause and we try to fix what is actually contributing to that kind of a complaint. So I think I would say that it's not a destination, it's a journey. And we are pursuing that journey with a whole lot of commitment from all employees and the whole of SBIans.
Great to hear that, because 48 crore is your customer, you said, so it's a very critical. One technical question is this: Reserve Bank of India is is creating actually a new chapter for the investment segment from April 2024. Now, shorn of all technicalities, you can buy corporate bonds and keep them in the HTM category. HTM is held to maturity. So this is interest risk you can avoid. There is no M2M or the mark-to-market losses, which was not the case till now. There are many other things, I'm not getting into that. So do we see the banks, and particularly you are a large bank, now shifting, instead of giving loans to corporations, giving, subscribing to corporate debt, or even within the existing portfolio, migrating certain loans into the corporate book? Do you see that? Because that's the globally banks, I mean corporate, that's the way of funding corporate. So do you see that's happening?
This is also actually one of the characteristics when the economy moves from the developing to the developed state. And also over here also, as per the RBI prescription also, the large lenders are expected to raise money from the money market also, the debt capital market also. So I think from that perspective, this new rules which will come into force from 1st of April 24, wherein the investments into the debt instruments will be kept in the HTM category, will actually open up the opportunities for banks, because as of now, banks had a challenge in terms of 23% of their total investment book could have been kept in the HTM. So to that extent, there was a ceiling which was put in terms of...
Now ceiling is completely removed.
Now the ceiling has been removed. So if at all the corporate credit book is not growing, but those corporates are raising money from the debt capital market, that gives a decent opportunity for banks to really invest into such kind of instruments. And actually, if you really look at it, the corporate bond market used to be about 12 trillion in 2013. And today it is somewhere around 44 trillion. But it is still somewhere around 17% of our GDP. As we are moving towards a $5 trillion economy, and we have seen in the global markets, this corporate bond market is somewhere to the tune of about 50 to 65%. So I expect this corporate bond market to grow from the current level about 44 trillion to about 200 trillion. And that too by the year 2027-28. So it is a significant leg up in terms of the corporate bond market. And to really make it happen, I think the banking system opening up of this kind of opportunity is going to go a long way. That's how I look at it.
Mr. Khara, this RBI, that new investment norm, it has to change the way your treasury operates. They have to change their approach because of the technicalities. I'm not boring you with all these things. Second is you need to change the software. Third is you need to also change the accounting practices. So is the banking system in general and you in particular ready for this April thing, or you think that you will ask, or you need some time from Reserve Bank of India for this migration?
No, we have already done the gap analysis, and we are already embarking upon steps to be taken for bridging this gap. And once the comprehensive study is, in fact, we have already done it, but for the system, once it is done, maybe IBA might request for some timelines. But as far as we are concerned, we have already done the spade work, and we are already working on for moving towards what is expected of us.
So you don't need an extension of time, you think?
I don't think so. We will be.
Okay, sir. We have a few minutes, 2-3 minutes. I'll just have one question. I mean, you hate me for asking it, but sir, you allow me one micro question. This HDFC and HDFC got merged with HDFC Bank. And after that, the HDFC Bank CEO has been talking about growing at a very fast pace. The gap, it is much smaller than you, but the gap has now narrowed. So do you, I mean, I'm not saying you should lose your sleep, but are you concerned that at some point, few years down the line, HDFC Bank in terms of assets book will breathe down on your neck and then probably even overtake you? Is that a concern for you and talking in the board and among the senior management?
Well, Tamalda, when it comes to competition, we are a 217 years young bank. And I recall way back in 1956 also, the then chairman has talked about competition. I think we have lived all this while in the evolving financial sector environment. But I think what matters most, one should not lose sight of the growth levers which are required to be built within the organization. If at all we have to avoid the decay, we have to remain relevant for the customers. And that is the effort and the endeavor on the part of the bank in terms of offering product, in terms of offering services, in terms of offering customer convenience. And I'm sure with this base which we have and the reach which we have created, the network which we have created, these are some of the important levers which will continue to serve us even in the days to come. And inshallah, we will live up to this competition.
Very, very well articulated, because you are saying that remaining relevant, that's what the most important part. Yes, remaining relevant. Last question, winding up. So banking sector, everything is good, great. Mr. Kamath said that this is the best banking scenario in past 50 years. Every quarter, you are seeing the banks are getting better and better and better. There is higher interest income, there is lower provisions, there is recovery, there is higher fee income. Everything is good. And investors, we have never seen investors as excited as they are about public sector banks. Of course, you are the king there. So tell us, is there anything that can go wrong? Because we are talking about geopolitics, we are talking about interest rate, we are talking about inflation, we are talking about FDI outflow, so on and so forth. But is there any concern that you think that, I mean, yes, you are a proxy for economy. If some macro economic stability is in danger, you will be definitely affected and all. That's a separate story. You will not create any problem for yourself, meaning the banks, because you have learned the lesson in a very hard way, the AQR and all. But is there any concern which can derail the growth of Indian banks? Not for SBI, I'm talking about, you are representing the entire banking system in that sense. That's
See,
my last
as a banker, it is more like, driving a car. While driving the car, you cannot lose sight of what is ahead of you. And you should also keep in mind that your brake is perfect and you should be in a position to apply the brake at the right time. So I think the judgment is very, very important, and the judgment comes from the experience. So I think the banking system has learned its lessons of the 2008 accident, and thereafter they have only tried to improve their systems. I would say that and also thanks to the regulatory guidance from time to time, we're in a position to take stock of the situation and react in time. That is something which is helping the system to stay resilient all this while. Because I can perhaps relate with what happened during COVID. On day one, when the COVID struck, as a banker, we were all very worried how it is going to really impact the bank's balance sheet. But what we have seen is that banks provided for adequately during that period, and also that has acted as a buffer. So I think this is one of the very major events which we have navigated well. That gives us the confidence that perhaps going forward also, we should be in a position to visualize the risk in good time and strengthen the system in good time. Only risk which is perhaps we all have started really looking at very carefully is the interest rate risk, because this interest rate risk can get converted into the credit risk, and that's why, since the system is already aware of this, I'm sure in the near term I don't perceive any challenge.
Thank you, Mr. Khara. That brings us to the end. So. SBI is a big elephant, but it's dancing. And let it continue to dance for 48 crore Indians and more. Thank you, sir. Thank you for your time. Thank you, sir. Give him a big hand. After this, I think after 10 minutes, we'll have fireside chat with Reserve Bank of India Governor, Mr. Shaktikanto Das. So don't get up and you may miss certain part. It will start soon.
Ladies and gentlemen, can we give a huge round of applause for this conversation? Mr. Dinesh Khara at his candid best, handling a balance sheet of 60 lakh crores, 1/5 of Indian economy with 48 crores customers, 97% transactions happening outside the digital branches, 84% transactions actually happening digitally. I think exceedingly insightful, filled with a lot of insightful statistics, but most importantly, really reflective anecdotes and stories. So thank you so much, Mr. Khara, and thank you so much, Tamal, for navigating this conversation so beautifully. Next up, we have the fireside chat.
Mr. Shaktikant Das, Governor at Reserve Bank of India. Thank you so much, sir, for joining us today. Ladies and gentlemen, as you all are aware that Mr. Das has been rated as the top central banker globally by Global Finance magazine. He's also been conferred with the Governor of the Year award at Central Banking Award 2023. He has cemented his position as someone who is adept at really making critical reforms. He has overseen world's most innovative leading payments and its innovation and stirred India through difficult times and really is playing an instrumental role in catapulting India into global arenas with his crystal clarity, intuitive originality, his analytical mastery, but most importantly, his ability to navigate through clutter and come up with razor-sharp perspectives. Ladies and gentlemen, a big, big round of applause for Mr. Shaktikant Das, Governor, Reserve Bank of India. Thank you so much, sir. And what we are going to be witnessing is a very engaging fireside chat between Mr. Das and Mr. Tamal Bandyopadhyay, who is the consulting editor at Business Standard. So can I request both of you to please grace us on stage, please? Over to you, Tamal.
Very good evening and welcome to the grand finale. India's largest BFSI summit, and what a way to end it. Conversation, candid chat with RBI Governor Shaktikant Das. He is the second governor in RBI's history to have 6-year term. And you don't know whether the 6th year could be 7 or 8 years. We'll get to know a year later. Just before coming here in that special room, Governor was asking me that what kind of bowling you will do, spin or fast or medium pace. There are others. I said that whatever I bowl, this is one batsman, you can't get him out. You just can't get him out. When it comes to communication, I mean, he is the central banker. Sir, this lady already have stolen my thunder, but still officially on this platform in presence of this 750 or 800 people here and thousands of people who are watching this on web, let me congratulate you for 2 things. You are ranked A+ governor globally in the Global Finance Central Bank Report Cards 2023. You also bagged the title of Governor of the Year for 2023 by Central Banking in London. So, congratulations, sir. So, if it's a Central Bank's World Cup, India is champion and you are the captain of the team, right? Only thing, it's not 20-over cricket, it's not 50-over cricket, it's not even a 5-day test match. It's a test match which runs for years. So, and which is a test match which had seen COVID, which had seen everything else. So once again, Governor, and incidentally, Governor is very fond of cricket. So that's why I'm giving the cricket analogy. So let's start with something macro. Once again, another congratulation is due because we are a part of the JP Morgan Government Index, the global index which everybody had been waiting for. India's 10% weightage in the Global Diversified Index in stages from June 2024, 1% added every month. Now, RBI, as a central bank, you have been preparing here for quite some time, 2020. First, you removed the foreign ownership in certain bonds. You call it fully accessible route. You have done that. And then, of course, allowing the banks to lend, margin requirement for foreign investor, etc., etc. But has it come little faster than you waited because of the Russia's inclusion? Because you need to prepare the ground. we need to have more those particular bonds which the foreign investors are allowed to invest in. We need to have more liquidity. And of course, in this kind of geopolitics, always the interest rate risk and the FDI outflow, it can happen once you are integrated with the global segment. So as a RBI governor, tell us frankly, sir.
Thank you very much, Tamal. And at the outset, let me also thank Business Standard for organizing this event and inviting me to participate in the final session of this 2 days event. I think over the last few years, this event, this particular BFSI event has emerged as an important event in the BFSI calendar of our country. So my congratulations and compliments to the entire Business Standard team for achieving this. Now, coming to your specific question, you see, our effort over the last few years has been to sort of expand the investor base in our securities market, especially the government securities market, to expand the investor base, and also to provide, sort of greater opportunity for participation. We have taken number of steps. You mentioned about the fully accessible route. We have also taken several other measures. You alluded to a few. And there is this also things like, for example, we have, permitted the banks, the domestic banks, to offer margin facilities to the FPIs, etc. Now, inclusion of India in the JP Morgan bond index is their decision. And the first thing that has to be recognized in this is that it's a kind of a vote of confidence about the Indian economy and about the Indian financial markets. So first point I would like to mention is that it's a vote of confidence on our economy, on our financial markets. And I do understand from where your question is coming. Obviously, when you are included in a bond index, it works two ways. It leads to inflow. I mean, the JP Morgan, they have given an estimate of $25 billion to come over a period of time, and all that is expected. But the other side, on the other side, it's a double-edged weapon. I mean, it's a double-edged sword. That is on one side. The other side, as you know, when there are, there are quite a number of passive investors who get, who are mainly sort of influenced by your weightage in the index. So the reverse can also happen. When your weightage goes down, the passive funds will immediately tend to move out, or if there is, some other development globally happening, it can, there can be outflow of funds. And in this regard, I would like to mention that RBI has a track record over the years, and especially in the recent period, of handling large-scale inflows and large-scale outflows. Last year, after the Ukraine war started, we did not see the kind of outflow which was there after the taper tantrum. Sentimentally, in terms of market sentiment, I think the overseas investors had greater confidence on India's ability to, the RBI's ability to service the, the outflow of currency. There was never a doubt that RBI will not be able to meet the dollar requirement. That was because of the reserves which we had built up. So our track record over the years, and especially in the last few years, when outflows happened last year after the Ukraine war, it was handled in a very seamless manner. And similarly, when inflows had taken place before that, before the Ukraine war, or in the, let us say during 2019, then particularly in 2020 and 2021, when liquidity was easy all over the world, there was large-scale inflows. And we utilized that opportunity to build up our reserves. So we have a track record of handling both sides of the so-called double-edged weapon of the bond inclusion. We can handle large-scale inflows, we can handle large-scale outflows. So that is the track record. And then also, in the case of India, I would like to believe that given the overall macroeconomic stability and the financial sector stability that we have, even the passive investors, the world has changed. The passive investors are also looking at other aspects of an economy, the nuances of an economy, the strength, the strength and the underlying fundamentals of an economy. So therefore, I don't think we will see that kind of volatility, but should something like that happen, I think RBI has the capacity to deal with it and deal with it effectively.
Thank you, Governor. Very reassuring, and you are, I don't know, it's not even, it's more than modesty. You said that thank you for your participation. Actually, it's a rare honor and privilege for us. You are gracing the occasion, and this is fourth year in a row. Reserve Bank of India Governor Shaktikant Das, he finds time to grace the occasion of BFSI Business Standard Summit. Sir, second is also, it's a very talk of the town, everybody talks about that, and you played a key role, you meaning the Reserve Bank of India, is that internationalization of the rupee. I mean, considering our trade, the size of our economy, the size of our exports and our rating, I mean, is it, how much it's talk and how much is actually reality? What does it mean, sir, internationalization of rupee?
You see, we have, our officers have come out with a paper on internationalization of the rupee, and they have shared some of their thoughts and some of the suggestions. So, and the foremost point to be noted in this context is that internationalization of the rupee, like we have said over the years with regard to capital account convertibility, internationalization of the Indian rupee is not a target. It's a process. And there is a phased road towards, towards greater internationalization of the rupee. So we are not, there is not a particular point of time which we are trying to reach in 1 year, 2 years, 3 years, not like that. It's a process. And that is because the size, the presence, and the impact of the Indian economy in the global, in the global scenario is also expanding. Today, India is, IMF time and again, and particularly they have reiterated it recently in their World Economic Outlook report also, that India is going to be the fastest growing economy, major economy in the current year as well as perhaps in the next year. So the size of Indian economy is growing, and the contribution that Indian growth in India makes to world growth is now in the order of 15%. And recently, I think the Director Asia Pacific of the IMF, in a, in a press interaction, perhaps to Business Standard, he said that by 2028, India should be contributing to 18% of world growth. So the size and presence of Indian economy is growing. The size of Indian economy is also growing. It is expected to be the third largest in by 2027.
2030, sir. Latest time, latest 2030.
Okay, to 2027 I thought, but that's okay. That's a matter of
S&P Global's report says 2030.
It is going to be the, it is now the 5th largest. It's expected to be the 3rd largest. So therefore, in this scenario, the presence of the Indian rupee in various international transactions is something which should also happen, or, alongside that. Now, we are looking at it because dependence on one currency for international trade for any economy has its risks. For a moment, I am not, let me stress, we are not pitting the rupee against the dollar. There is no such issue at all. Some section of the media probably thinks, and they write about it. It's not so. It's not a question of rupee versus the dollar. The dollar is the dominant currency and will perhaps remain the dominant currency for international trade for years to come. But what we are looking at is to increase the footprint of the Indian rupee in the international trade, especially with regard to countries with which India has very close and active trade relations. So we have signed the MOU with the United Arab Emirates for rupee denominated, rupee or in the local currency denominated, rupee or dirham, local currency denominated export-import. Sri Lanka has already recognized the Indian rupee as a reserve currency, as a designated currency for their international trade. We have also entered into similar MOU with other countries. The UPI linkage is also being simultaneously being pushed. So therefore, and we have also provided the facility of opening a Vostro account, and whereby the entire import-export will be settled by using the Indian rupee. So basically what we are trying to do is to expand, widen the footprint of the Indian rupee in the context of India's trade with other countries, you know, with whom we have greater trade relations. And it's a process we are moving towards that, and something which we feel should happen as India becomes you know, a bigger and bigger economy.
Thank you, Governor, for the clarity. Well, I'm bringing another controversial subject. In fact, if I remember correctly, in 2021, when we have It's on Wave Business Standard BFSI Summit, we did have a conversation, of course, in your office at Reserve Bank of India, and that was live telecast and webcast. And there, probably that was the platform where first time you spoke very frankly about your, I would say, allergy towards cryptocurrency. So I'm bringing to the cryptocurrency part. You sort of said that it's over your dead body. You will not allow crypto. Now you banned it. But this, we're talking about latest IMF FSB paper, which talks about not banning but regulating. I am aware recently in Delhi, you said that there won't be change in your stance. But sir, my humble question is this: if following the IMF, whatever the direction they are getting, if the other countries says yes, and the Indians started using their money overseas for crypto, I mean, is there any plan for that? You are a staunch believer in banning it in whichever way, and etc. Can you just give us some clarity?
You see, on cryptocurrency, I would like to say, and I would like to say it with all seriousness, that it's a very serious issue. It's a very serious threat to financial stability for all countries, for global financial stability, especially for emerging market economies. And that is something which has been recognized in the IMF FSB synthesis paper also. And incidentally, the IMF FSB synthesis paper also says very clearly that based on country-specific requirements, especially emerging market and developing economies may, depending on country-specific situations, may impose additional restrictions with regard to cryptocurrencies. So the problem, the risks are well recognized by the IMF FSB synthesis paper. It has been very well recognized by the BIS paper on cryptocurrencies. Everybody understands and understands and agrees that there are serious risks. So that risk has to be looked at and managed very, very carefully. Why I am saying it's a very serious issue, and I think time and again when I am saying it, it's not a question of, I have seen, you know, comments coming from certain quarters, especially those who are in crypto business. I mean, I can understand their concern that they, you know, they are very critical of RBI's stance, and it is quite understandable. I don't hold a grudge against them. I mean, they are entitled to their views. But we have to look at from the overall perspective of the macroeconomic stability, and I am not going into the details of what threat it poses to monetary stability, what threat it poses to currency system, what threat it poses to financial stability issues. We have articulated in the past, and I am not going into it. So, to summarize, let me say that it's a serious financial stability risk. It has to be dealt with properly. The believers of regulation, I have only one question to ask. How will you regulate it? Whom will you regulate it? And regulate what? And before you think of regulating it, let us first understand what is this, you know, what is this cryptocurrency? Is it a product? Is it a financial product? Is it an asset? If it's an asset, what is the underlying? It's not a tangible thing. What is the underlying? what is the definition of cryptocurrency? Till now, I am yet to see a credible definition of what the cryptocurrency is. Second thing is, I am yet to come across any, what you call, any sort of credible explanation of what is the larger purpose that cryptocurrencies serve. The third point which comes to my mind and which is very important, what is it that cryptocurrencies will do for international transactions or domestic transactions, whatever you call it, in the digital mode, which CBDCs cannot do. And the fourth and the final point is the basic question. It's a kind of a new currency system developing. Are governments and central banks across the world, are they comfortable with private currency vis-a-vis a fiat currency, a currency issued by a central bank on behalf of the sovereign? I think these are the four fundamental issues which need to be first understood before we talk of any kind of regulation. And this is something which is very well recognized by the IMF FSB synthesis paper. The G20 summit, the leadership of the G20 has welcomed the IMF the IMF FSB synthesis paper. They have welcomed it because it's a good beginning to understand what are the risks and possibly how to deal with it. How to deal with it. I'm not using the word regulation. I'm using the word how to deal with it. Deal and regulate, I mean, I would like to use it in an interchangeable manner. How to deal with this. So in that way, I think it's a good beginning which has been made, and the understanding should become deeper, and there should be careful, the whole issue has to be very, very carefully addressed. We are not trying to stifle innovation. Innovation which is in public good, which is in the interest of overall public interest, all innovations must be supported and promoted. So we are not against innovation, but innovation should serve a public purpose. Thank you.
Thank you. Thank you, Governor. I mean, you are extremely emphatic that you will not nudge from your stance. Great to hear that. And I'm sure you will convince when your forum with other central banks. Sir, there's a tea or coffee you can, if you wish to have a thing or not. So another thing I think everybody...
I don't want to take a drinks break and give Tamal more time to come with a bouncer or a googly. So.
Sir, your focus, and rightly so, for the past 6 months on corporate governance in banks. You have called the bankers, you have called their boards, and you had multiple meetings, and repeatedly you have been focusing on that. That's the one side of the story. I don't think anybody would find fault with Reserve Bank of India on that. But we do see, like we who are outsider, there are certain problems with certain banks. But you don't talk about that. Unless this is an extreme case where you put your CGM as a board member there, etc. But otherwise you don't do this. Is it because you always talk about that our macroeconomic stability is immaculate, etc., etc., so you feel like you should not talk about that? Because market knows, and stock market accordingly reward or punish the banks, that everything is in public domain. So is there any, sir, can you just explain to us your approach to governance? There are certain, I will not call them rogue, but there are few banks which are ill-governed. Market knows about it, everybody else knows about it. You also know in your corridor there are talks, but you don't talk about it. Is it because you spoke always talking about financial sector stability is immaculate?
The headline is that the Indian banking sector and the NBFCs, the Indian banking sector and the non-banking finance company, the banking and the NBFC sectors at the moment are healthy and robust. You look at the aggregate level, or you look at the individual entity level. Banks, you have the data for all the public sector and private sector banks. We have seen the data. Even NBFCs also, if you look at the top 20 or top 25, which would broadly represent 75 or 80% of the asset size of the NBFC sector, their financials are robust and healthy at the aggregate level as well as at the individual entity level. Now, governance is something beyond these numbers. These numbers ultimately in the long run flow out of good governance. So our emphasis has been on good governance to ensure that these financial norms, these financial parameters which the banks and NBFCs have achieved over the last few years, thanks to number of measures taken by the banks and the NBFCs themselves and by the, by the Reserve Bank, and also several steps by the government, Government of India with regard to public sector banks. Because of a mix of all these factors, the banks are today very robust and they're reporting very good numbers. We want these numbers to continue, and we want, number one, these numbers to continue and improve further. Number two, we want that underlying these numbers, certain basic deficiencies should not get camouflaged. And our analysis shows that what differentiates a good institution, a banking or a non-banking finance company institution from a not so good one, is the governance. And in governance, we are highlighting broadly three components. I have talked about it on several occasions. Risk, that is, strong, robust risk management, compliance culture, including ethics, and the strength of internal audit. These are the 3 points which we have been highlighting. So wherever we see deficiencies at any particular entity, now let me again reiterate that at the systemic level as well as at the entity level, our banks and large NBFCs are very robust. But wherever we see any deficiencies or any deviations or some problem building up somewhere, our job is to immediately, flag the issue with the entity. We don't want to hit big headlines by, making statements that such and such bank has a problem, because sometimes in public mind, in public perception, the interpretation may be disproportionately high or excessively high compared to the actual nature of a governance deficiency. When we take some action, internally, when we take it up with the bank, we know exactly what is that deficiency, we quantify that deficiency, we define that deficiency, and we want the particular bank or NBFC to take necessary corrective measures, which they do. But the moment we start if we want to hit headlines, you will unnecessarily be creating a kind of a crisis of confidence in that particular bank or NBFCs, which will be completely disproportionate to the nature of the internal deficiency. So therefore, we have been, wherever we find deficiencies, our supervision teams are, our supervisory teams are in direct touch with the management of the banks, and it is taken up. I will not mention entities, but let me mention a few examples. Like the IT system. We are now doing our, our C-site team does, they have been now doing a thorough verification, inspection of the quality of the IT system in banks and what kind of cybersecurity facilities they have, what kind of IT systems they have. Wherever we have deficiencies, we have immediately flagged the banks to the management of the banks, and our supervisors have then sat down with the banks, and we have insisted that please give us a timeline by which you will, within which you will take necessary corrective measures. So we are playing, when we emphasize on governance, we don't want to create unnecessary panic, and there is no reason for panic. When there, we don't want to create that kind of a panic. Second, we want to play a constructive role to work with the management of the bank in a manner that the real genuine problems are addressed and addressed effectively, and ultimately it is the quality of governance in a bank or an NBFC which will ensure that the bank continues to be there. You mentioned at the beginning that RBI, that we are at the top and all that. I don't know whether at the top, but we are somewhere there. Now, it's easier to reach there, but it's far more challenging to be there. And this I am not saying for RBI, this I am talking about our financial sector and our financial institutions. So as a regulator and supervisor, we are basically, our approach is this, what I have just mentioned.
Thank you, Governor. So you are doing your job, you know what is there, but silently you don't want to create any noise. Right. Sir, if you don't take any offense, I just want to understand one thing. Governance, you are very concerned about, but you are also looking at the business model. I'm just, academic question, again, don't take any offense. Is it a regulator's job to teach bankers how banking, what should be my business model? Now, the bankers are there, they will never ask you, but they, in private, they whisper into my ears, ask Governor this kind of questions.
They know it, they know it very well, and I doubt whether anybody would have whispered it, but, but even if they have, and since I am addressing a bigger audience and a wider audience which perhaps is watching in the in the YouTube and your YouTube through the YouTube facility, let me say that when we say business model, we are not referring to micro level business models. Why a particular loan is given like this to a particular entity, or why a class of loans, this is the interest rate charged. We are not looking at that. When we say business model, it is from the point of view of the structure and composition, or rather say the structure of the balance sheet of a bank. What kind of risk appetite the bank is providing for, or the bank balance sheet reflects. What is the risk appetite that it reflects, which the bank is, taking? What is the risk appetite in that bank? Whether that risk appetite is matched or backed by adequate risk mitigation measures. So we are looking at more structural issues in the balance sheets. We are also looking at the revenue models of the banks. Short-term risks, short-term gain versus long-term risks. We are looking at issues which every banker does, the asset liability balancing, whether they are appropriately managed, whether they are appropriately balanced, the asset and the liability. So therefore, we are looking at the balance sheet of the banks. When we say we are looking at the business model, we are looking at the business model of the bank as reflected in its balance sheet, or as it would feed into the balance sheet, is more from the point of view of the structure and the strength of their balance sheet. I have said it earlier that a problem which looks small in some corner of the balance sheet of any financial service provider, bank or non-bank finance company, a small risk which initially appears small in some corner of the balance sheet can become highly risky unless it has been properly understood, unless it has been properly mitigated. So our emphasis is more on that. The second aspect I want to say is that, to supplement what I have said, we have now for last several years, we have adopted risk-based supervision. When you are doing risk-based supervision, you have to look at what are the risks which the banks are taking, what are the risks, and whether it has been properly addressed by the bank in its balance sheet. So I have said it earlier, but I am just putting things properly. And the recent developments in the advanced, particularly in the United States, some bank failure, and also in Switzerland, the large bank failure there. I think once again, the central banks and the banking sector regulators and supervisors have woken up to the fact that they need to do much more intensive supervision. There is growing realization that many countries, the banking sector supervisors in several countries, let me say, not say many, but in many countries or several whatever, the supervision had somewhat fallen behind the curve. I can say with confidence that our supervision has by no means fallen behind the curve. It has remained in sync with the requirement of the growing complexities of the financial sector, the banking sector world over. So in US, perhaps, I'm not commenting on US generally, but I think you will now see more and more, or perhaps we are now even now seeing more and more banking sector supervisors where central banks are the supervisors, they are doing it, and in certain countries where there are other dedicated supervisors, they are doing it. They have started looking at the business models of the banks. The failure of the particular bank in the United States had a lot to do with the business model. Yes, I would first say that it is a failure of the bank which goes down that path, because the bank management is the first line of defense. Central bank is not supposed to do risk management. Risk management has to be done by the management of the bank first and foremost. Central bank as the regulator and supervisor is supposed to keep an oversight and point out where we feel there is deficiency. So therefore, when we say that looking at business model, I would like to sort of submit for your consideration and consideration of everybody that we are not looking at the commercial aspects of their business models. We are looking at the overall risk matrix, the risk appetite and the risk mitigation and the structure of their balance sheet. That was a long answer, but
Thank
sorry,
you,
I thought
I think all of us agree, and all of us, we discussed that this is the new RBI. I mean, we may call you in some sense very aggressive, but the supervision and inspection of Reserve Bank of India in the recent time, and you are much more, things are, you are much more aware and you are much more proactive. This is a new RBI. Bankers do admit that. So it's wonderful, and that's, I'm sure, the world recognition only because of that, not for, apart from other things on the macro, whatever you have done. Sir, one more question, which is little irritating. After that, we'll go back to macro. Is this, there's a huge challenge before the banks to attract talent and retain talent. And on the way, it comes something that they say in private, is this the compensation structure? Because you are not liberal at all. We know what happened in 2008 in US and subsequently the global thing and all. But you get into this, if you want to pay more than 20 lakh bonus, you cannot pay that at one go, you have to do this. So these little things, is it possible for RBI to be little liberal on that, you think? Because they think that for attracting talent, RBI is keeping an eye on the salary and parks, etc. comes on the way.
No, you said that they are asking the banks, I don't know why they are not asking me directly. In fact, they do. In fact, they do, not in a meeting, but one-on-one I do meet the bank CEOs. One-on-one I meet anyone who wants to meet them. You can do a secret ballot and find out. They don't have to reveal it. But I do meet them one-on-one. And whatever are their concerns or their points, they always share with me one-on-one. And they do that with the deputy governors or, also of the Reserve Bank. So there is that interaction which is going on. Now coming to this specific question of attrition and the compensation package, etc. Now public sector banks, it is with the government under the law, so we don't deal with that. Private sector bank, only the whole-time directors, that is the CEO and other whole-time directors, only their compensation package comes to Reserve Bank for approval. And you know it, everybody knows it. It is ultimately the NRC, that is the nomination and remuneration committee, the NRC of the bank boards and the boards of private sector banks, which are expected to decide the compensation package of the banking executives. Top to bottom, including the whole-time directors and the CEO. So when they send it, I would say that in almost all cases, excepting a few, where we find that the increase in package is not commensurate with the business growth of the bank. On the contrary, if the bank has reported a negative, compared to the previous year, if the bank performance is going down, you cannot have a situation of excessive increase in the compensation package. So very few cases where we such things, we put some restrictions. Most of the cases we return it to them, saying that please relook and come back to us. So therefore, we don't put any restriction on that. Second, and the most important thing is that First is that the boards of the banks, they fix it and we don't unnecessarily interfere. Second thing is what we have done in our circular on compensation for the private sector banks, it's a principle-based regulation. We have said that the fixed pay and the variable pay, the ratio will be so much. Beyond that, we have not said how much should be the fixed pay, how much should be the variable pay. We have only said that you maintain this ratio. Beyond that, it's a principle-based regulation which we have done. And the Banking Regulation Act expects us to do it. In fact, it mandates that Reserve Bank should approve these compensation packages and ensure that they have used the word, the Act uses the term used in the Act is excessive. It should not be excessive and it should be commensurate with the, the size, the growth and the result, performance, etc. of the banks. So we don't like to, we don't do that. And talking about attrition, I'm just, adding one more point which although you did not ask, we are also looking as a part of our supervision, the rate of attrition which is seen to be high in certain private sector banks. And we have asked them to look at it because they have to really see, because every bank also at the end of the day, has to build up its core team, which should really grow with the bank over the years. But the thinking of today's youngsters has changed. Earlier, if you ask any of the senior bankers how many banks or how many institutions they would have worked in the, let's say, last 20 or 30 years, they would maximum say 2 or 3 institutions. I worked in this bank, then this bank, then now I'm here in this institution for last 10 years or 15 years, like that. But it's not so with today's youngsters. Today's youngsters are thinking differently. With so many opportunities, especially coming up from the fintech sector, from NBFC sector, the youngster, this is a very impatient generation. Nothing wrong with it. Nothing wrong with it. But I think it's for each bank to build up its own, own core team. Because there has to be something called the organizational culture. Like, I have come across many executives who proudly say that, I worked in that particular bank for 15 years or 20 years. Now, that is something which will add to their, the credentials and to the CV. So, I just took it aside and we are now looking at this. RBI has always looked at the attrition rate in various banks. Now we are looking at it very closely because we find that the times have changed and banks also need to give greater focus on this rate of attrition. It's for the banks to really analyze and deal with it. The counter view, in fact, somebody pointed out to me is that so be it. If the attrition is high, let there be a churning. Why should you bother? So therefore, there also we have not prescribed any norms or standards. We have just left it to the bank managements. We feel your attrition rate is high. It's for you to do whatever you want to do because ultimately it will tell upon your organizational, culture, your, the building up a core team over a period of time.
Thank you, Governor. So though if you are enjoying this candid conversation, give him a big hand. And time flies. Time flies, sir. We have met 40 minutes and still I have a few things left. We can continue a little bit, sir, with your permission. And those bankers who have told me to ask these questions, I will not name anybody. I have asked on your behalf. Governor answered. If you are here, you have heard him. So that's it. Beyond that, I don't want to say anything. Sir, the new investment norms that you recently circulated among the banks, that the full and final. I'm not getting into the nitty-gritty, but from April 2024, you have said that banks can have the entire government bond portfolio in HTM category. Now, this I believe, and it's the fact that it's in international standard, it's in sync with international standard. But Reserve Bank of India's approach was actually very different. You have been raising it and coming it down, like it was 18%, then you pushed it up. From 25%, it was brought down to 19.5%. Then during COVID time, you brought it up to 23%. And now the plan had to be bring it down to in phases. Instead of bringing it down, you have said no, as much as possible you can keep it under HTM, which means 100% of my bond portfolio can be in HTM. Now, have a sneaky feeling that will it prompt lazy banking? If I am a banker, why should I try to get auto loan and home loans, etc.? If I am getting good money in the government bonds, I'll just sit on it for 10 years, 20 years, 30 years. I don't need to do anything.
No, on the contrary, you said lazy banking. On the contrary, it will lead to, I feel, active banking. I'll tell why. Today, about two-thirds, if I remember correctly, about 70% of the investments made by the banks, 70% of all their investments are held in HTM category. And it is coming down as the banks have to give more and sanction more and more loans. So 70% is in HTM category, and the rest, 70% of the investments. So obviously it's putting some kind of pressure on the lendable resources available to the banks. And the SLR holding of the banks for the last several years has been well above the SLR minimum requirement. Now in the recent months, as credit offtake has picked up, the banks are slowly reducing their SLR levels. Wherever they had excess SLR, they are reducing it. Now from the point of view of stability or safety or security of a bank, we already have, it's by way of a side point I'm mentioning, we already have the LCR, that is the liquidity coverage ratio, 30 days liquidity in a stressed situation the banks are supposed to keep. There is a LCR requirement which the banks are adhering to. We also have in parallel the what you call the SLR, the SLR requirement, which they are all required to maintain and they are maintaining. We also have the CRR requirement, cash reserve ratio, which the banks maintain. So from the point of view of safety and stability of the, safety of the bank, these are already requirements. Now HTM, you said that, why have we removed the cap? So even if we remove the cap, it's not going to become zero. There will be still HTM because you have SLR, and these have to be high quality. These have to be, what we call HQLA, high quality and liquid assets. For SLR, LCR, and for, CRR, of course, it is cash. Now, so therefore, what is now happening is that as things stand today, the HTM holding of the HTM holding of the banks, that is held to maturity of the banks, the fair value is not determined and is not disseminated. When SVB happened, if you recall our last financial stability report, if I remember correctly, in the last financial stability report which we published in June, there we have given the data, we have done a valuation of, we have done the mark-to-market exercise, valuation of the HTM holding of the banks, and we have shown exactly that even if you do that valuation, still the banking, the balance sheet of the banks are continuing to be quite healthy. And now we have mandated, it's a requirement that the HTM holding, the banks will have to do their own internal risk management, interest rate risk management they have to do. They have to also, risk management they have to do. They have to also do the mark-to-market valuations, fair market value they have to arrive at. Mark-to-market valuations they have to do, and they have to give it out. They have to, that means it will come as a part of their balance sheet or in their quarterly, audited results. The auditor would be required to say that the HTM portfolio of the bank, based on mark to market, this is the plus or this is the minus, this is the appreciation or this is the depreciation. If there is a haircut, how much has been the haircut? So we have made the system more transparent. So I would therefore like to summarize and say that it will not lead to lazy banking. I think we are moving along with the international pattern, international norms, and if anything, it brings in greater transparency to the HTM portfolio of the banks, because the mark-to-market valuations will have to be now done and will have to be published. And internally, the banks will have to do their own interest rate risk management.
And this disclosure also rules out any possibility of having a Silicon Valley bank here, right? Absolutely right. So, so one question is on the NBFC segment. Now you have shifted to, not now, for quite some time, the rule-based regulation to NBFCs. And you have identified the upper class, the top-end NBFCs, which are treated almost on a par with the banks, including the liquidity LCR requirement and all. So, I mean, if I am running an NBFC and I have a large NBFC, what would be your advice? I mean, is actually as an RBI, I can clearly feel as an outside observer that you want to kill the arbitrage opportunities which are existing. But now, is it the RBI's way of persuading the large NBFCs that better to become a bank? Because I am not being allowed to take public deposits the way the banks are taking, but you are subjecting me to everything. I mean, not SLR, CRR, but even LCR, NPA norms, SMA1, SMA2, everything that what is bank subjected to. Whereas my cost of fund is far higher than banks.
No, upper layer, the norms are, the norms are obviously stricter than the middle layer, etc. That is because of the size and complexity. And we have explained why we have gone for this, why we have gone for this scale-based regulation, because of the size and complexity of the large NBFCs. Some of the NBFCs have balance sheet size which is much larger than mid-size scheduled commercial bank. So therefore, in the interest of overall financial stability, this was something which had to be done, and we have done it. Now, the entry, you said that they are almost similar, but it's not so. I mean, there are fundamental differences. The entry limit, for example, in bank, a new applicant will have to provide 1,000 crores, 1,000 crore of equity capital he has to bring in. It is equity capital he has to bring in 1,000 crores. Whereas for an NBFC, for a registration, it is still 10 crores. And you may become an upper layer. So it is still 10 crores. Then you have other requirements like CRR, etc., which is a big difference between the NBFCs and the banks. The CRR of 4.5%, NBFCs have no such requirement. So there are lots of differences. And the whole NBFC sector also enjoys a certain flexibility with regard to lending. Now, for example, in the case of banks, the banks are expected to have board-approved policy for sectoral caps, how much exposure, credit exposure they should take to which particular sector. There are board-approved policies, and that is mandated, that is a requirement mandated by the Reserve Bank. Whereas for the NBFCs, we have not done it. But it is different that many, many sort of, what do you call these, the larger NBFCs, they're doing it themselves by way of prudent management. They are doing it. So therefore, there are fundamental differences between NBFCs and the banks. NBFCs enjoy greater flexibility. We have also enabled, co-lending now between the banks and the NBFCs. For priority sector, we have also enabled the banks to provide to do lending through the NBFCs. That window has been given. Of course, there is some narrative being built up that the bank lending to the NBFCs are going up and it can be a risk factor, etc. That narrative is coming. But let me say very clearly in this BFSI event that all these numbers, banks' exposure to NBFCs at the system level as well as at the individual banks level, all these aspects and far more granular details with regard to, are monitored by the Reserve Bank regularly and much more intensively than anyone can imagine. All these numbers are very carefully monitored. And upper layer NBFCs, I mean, anyone is, as you know, it's on, their licenses are on tap. And we are not really, it will not be correct to say that we are nudging them to come as banks or something like that. We are not doing that. But it's always open to any, upper layer NBFC or anyone for that matter to apply for a banking license, because it is on tap. Anybody can apply at any point of time. Then of course it has to satisfy our fit and proper guidelines and other requirements.
Thank you, Governor. You can't be more explicit than in this. I will not ask you about inflation and interest rate cycle, etc. We discussed it thoroughly yesterday's economist panel. There are 6 of the best economists of India presented here. So there are questions from the audience when the rate cycle will change. I will not ask you because you will not give the answer. So I'm not going to ask you. You have been repeatedly says that your focus, and you spoke about Aryuna's way of looking at things, is 4% inflation on a durable basis, not 6%. So it's a great commitment one can have from Reserve Bank of India Governor, because at some point of time there are discussion, we shifted it from 4% to 6%. But you made it very explicit, whatever needs to be done, you are stuck to 4%. And everything else what you have done is aiming in that. But my, sir, very simple question is this. There are a lot of uncertainties. The geopolitics, the 2 regions, I'm not repeating everything else. The spread between Indian papers and US papers shrinking by the day. You spoke about Waymo through auction. You have done some screen-based Waymos in the recent past. Our currency is doing pretty well compared to most other currencies, but if the way the FDI outflow, if it continues, there could be pressure on currency. All these things put together, I mean, can you have an independent monetary policy? Is India decoupled, or there could be situation like that, you need to change, you need to take a different approach?
Now,
are we decoupled?
Yeah, so I'll come to the question, but before that, just a few facts I would like to place. There have been, from the equity segment, there have been outflows. I mean, FPIs have, there have been equity related outflows. But all the outflow that has happened over the last, particularly last 2 months, before that it was, we had heavy inflow in, now we are in almost November. So July and August we saw very, there were very strong inflows into, into the Indian market. FPI inflows were there. It was only in the last, in September and October that there have been outflows. And there have been equity related outflows also. But I want to set the record straight. The outflows are not entirely because of equity related. In fact, the equity related as a percentage of the total outflow is much less. Outflows are mainly related to import related, import payments, payments for imports. It has been repayment of earlier ECB loans. So there are several other components. It's not as if the entire outflow is because of FPI outflow. So that is one record I want to, I want to put it straight. Now, our monetary policy, you mentioned about the difference in the bond yields and all that between us and the advanced country, United States you are referring to. Now, we look at the international factors. We look at all possible international factors because we are living in a globalized world. We will be impacted by what's happening all around. But ultimately and eventually our monetary policy is primarily determined by domestic factors. By domestic factors, I mean what is the inflation growth outlook that we have? What is our anticipation with regard to inflation trajectory, with regard to growth trajectory as provided in the RBI Act? So the inflation growth dynamics, its future outlook is something, in other words, it's the domestic factors which primarily are the principal determinants of our monetary policy. Our monetary policy is not influenced by what is the differential in bond yields or if currency is depreciating. Many countries, many countries do interest rate hikes to manage the pressure on their currencies. Recently, I think Indonesia probably did it. There are other countries in our region who do it from time to time. Singapore has a monetary policy framework where they don't have inflation as a target. They have a band of exchange rate, a band for exchange rate as the principal target. So therefore, we look at international factors, we take them into consideration because we are living in a globalized world. We are impacted by all that is happening around us. But ultimately and eventually our monetary policy is dependent on the growth and what do you call the growth inflation, the inflation growth. Otherwise, some of your friends may say, why governor said first growth and then inflation? So that means the RBI is changing priority. No. Let me say that we look at the inflation growth dynamics. First priority is inflation at the moment, and based on that we decide policy.
Thank you, Governor. I mean, we have never seen. I mean, there are not too many governors we have seen which can communicate so well, sir. We have almost finished our time, but with just 2 more questions. And I mean, your capability of convincing us is so strong. I must, with your permission, I must tell the audience one small anecdote. This happened a few years back, just before COVID. Sir just took over, I think, at that time. There was a book launch of Dr. Y.V. Reddy and another Reddy, I am forgetting his first name, jointly written. And Mr. Das, RBI Governor, I think you are just few months old in office. You came to launch the book at Y.V. Chavan. And after the launch, Dr. Reddy was talking about that there are various people, bureaucrats and governance and all. So there are bureaucrats and governance who will call you to your room and say that I have whatever the proposal is, great proposal, and backslap you, and still you come out of the room not very happy. And there are governors who would say, I'm afraid I can't accept your proposal. But the way he would say that and the way you would explain why not explain, you come out of the room extremely happy and you will never bitch about the governor. And then he he did not name it, then he looked at and pointed finger to Das. Sir, you remember that? Yes. So that is the power of communication. We are just coming to almost end and all this. You have been repeatedly saying that India is the global growth engine. Just for academic, and we are a few months away from general elections, state elections are coming up. This is the geopolitics, this is the currency, this is the money outflow, inflow, whatever it is. So are there any concern at the academic level which can derail the growth engine?
You see, so far as growth is concerned, let me say that the growth momentum in India continues to be what it was. In other words, the growth momentum continues to be strong. The second quarter GDP number, which will come at the end of November, will surprise. I expect that the second quarter GDP number, in all probability, I must qualify because ultimately the numbers, will tell when the numbers tell for themselves when the numbers are released. But looking at the momentum of economic activity, looking at a few early data points which have come in, a few early indicators, I can say that the second quarter GDP number, as and when it is released at the end of November, in all probability will surprise everyone on the upside. That is let me say that. We have, I think in RBI, we have said, just check it up, I think second quarter we have said 6.4 or something like that. So it can be
6.5 is the average.
6.5 is the annual. I think second quarter it is 6.4, but please check up. It's likely to surprise on the upside. So that is likely to happen. And with regard to the concerns, I think the biggest challenge to every country, not just India, is the evolving geopolitics and its fallout with regard to financial markets, its fallout with regard to global growth. New flashpoints are developing, new geopolitical conflict points are developing. So how the geopolitics internationally, geopolitical conflicts are going to play out whether there are new flashpoints coming up. So whole geopolitics, I think, today poses the biggest risk for growth, not just for India, I think for the world as a whole. For India, any geopolitical crisis, we saw it immediately after the Ukraine war. It immediately led to, financial market volatility. It also, to some extent, has, pulled down global growth. So therefore, it is the geopolitical uncertainty which I think is the biggest risk to global growth. But so far as India is concerned, even with all geopolitical risks, I can say with confidence that India is better placed compared to other countries to deal with such risky or such potentially risky situations. We are better placed.
Thank you, Governor. I mean, thank you for exuding the confidence, and we are all, we trust you and we feel very reassured because the way you handle COVID, your unique way of raising interest rate in quick succession, then staying put there, and your reaffirmation of inflation targeting at 4%, everything is so reassuring, and we are happy and fortunate to have you at the central bank in India. I'm just coming to that end. I would like you to what is your message? Because here there are bankers, there are non-bankers, there are insurance. Everybody is the miniature of Indian financial sector, 750, 800 odd people sitting here. And there are thousands of people on watching you. What would be your final message to them? If you want to say anything. And before that, just with your permission, one personal question. I mean, that people ask me, particularly the people from overseas who join you for discussion, etc. They ask me, they're very intrigued your passion for ties. They said, have you seen governor's ties? And they said that they try to gauge the enormity of the situation, etc. by color of your tie and the tie. Is that correct? Like if you are happy, you prefer one color. If you are not so happy, you are little this thing, you prefer another color. Your tie is a mystery. Your love for cricket, everybody knows. Tie, it's a sort of, they try to decipher that by looking at your color, whether you are going for a rate hike or status quo, they want to gauge. So can you tell us a little bit about this, and then we'll,
I think I would be curious to know what is the interpretation they derive from various colors of my tie. It's quite a, I'd be curious to know.
You have a great collection, right, sir?
But, I don't know. But let me say that I don't know if ever I would write a book of memoirs or something. I have never thought about it. I don't take notes or anything to keep it for writing a book. I have never thought about it. But if ever I decide to write a book, I think you have given me some clue that this could be one of the sub-chapters about the color of the tie. And perhaps I can give, after my tenure in RBI is over, perhaps I can give a lecture or a speech somewhere about monetary policy and the color of the tie. So, but talking about, you mentioned...
your message to the financial
A message, well...
Anything, because you can see as a miniature Indian financial system sitting here.
Message, I have been talking about it extensively again and again. I have talked about risk management. Even today I talked about governance. But since you are asking and since we are in a World Cup season, let me just say the message is to all financial sector players and stakeholders, please play long term, play like Rahul Dravid.
Thank you. So I reworked my initial sentence where I said that he is the central bank of the world and he has got all the recognition this year, and this is kind of test match and he's the captain, and test match which was here. So he's not the captain, he's actually the coach. He's actually the coach. So with that note, I would request you to give a standing ovation to Mr. Das, RBI Governor, for an outstanding talk. You cannot be more candid and more forthcoming than this. Sir.
On this note, can I request Mr. Shailesh Dobhal, editor at Business Standard, to render the vote of thanks?
Yeah, good evening, everyone. On behalf of Business Standard, it gives me great pleasure to propose this vote of thanks. We're indeed grateful, Mr. Das, for agreeing to be with us here, despite your super busy schedule, and sharing your very candid and insightful views on a host of issues from governance, geopolitics, cryptos, the internationalization of the rupee, the structural business models that you spoke about of regulated entities. And it was very reassuring to hear from you how our monetary authority has built up capacity to handle global volatility that comes from those copious inflow and outflow of funds. Many thanks once again, Mr. Das, for agreeing to be with us and the trouble you took to come this far away from your headquarters in South Mumbai. Thank you so much, Mr. Das. Thank you.
Can I also request you to present Mr. Das with a memento and a token of appreciation? Ladies and gentlemen, the RBI Governor, Mr. Shaktikant Das, at his candid and meaningful, insightful conversation best. Thank you so much for joining us today, sir.
Ladies and gentlemen, with this we officially conclude the biggest BFSI event in India called Business Standard BFSI Insight Summit, where we had the movers and shakers of the fintech, the banking industry share their perspectives with us. And the final icing on the cake has been the outlook shared by Mr. Shaktikant Das, Governor RBI, sharing his outlook with all of us on the trends that are going to impact this industry. Thank you so much. This is your host, Ridmavali, signing off. Thank you so much, all you have.